China for the pharmaceutical drugs. So I think in their best interest, it should rather remain more dependent on India than increase dependence on China for the drugs. So I
Look at Pfizer.
would believe pharma is not going to get impacted. If tariffs come, they will be passed on, and we don't have any space to absorb the tariffs within our cost structure. We probably are doing low single digit ROE on the commodity portfolio that we sell to the US.
Okay.
So
I just want to address the first ticks coming in, and of course these will settle. But since we are having a very relevant conversation right now, and of course, again, these will settle. This is pre-open rates first tick. Yes, the Nifty is down, expected. But look at Pfizer, look at Gland Pharma, look at Oro Pharma, look at DRL, look at Zydus Life. This is where the safe haven seems to be. Look at Sun Pharma, for example, a Natco, a Wockhardt, Alchem Lab. You pick up anything in that space, and that's where all the action is. The safe haven, so to speak, a Mankind Pharma. Vishal, if I still have you with us for a last call, would you be looking at domestic suppliers more favorably or those that have US exposure?
yeah, so domestics are better off because obviously they don't have any US and there are no concerns there. But we'll have to look at the valuations of the domestic pharma names and choose and pick which ones have the right valuation as of now.
Top pick, Vishal, among the domestic focus players?
So I think Ajanta Pharma is one name. They have little dependence on the US, but they're largely 78-80% branded generic company with sales coming from India and other branded markets like emerging markets and Africa.
Okay, Vishal, thanks so much for this. Thanks for getting us that update. And I believe Shrikant Chauhan is with us. So take a moment to go to him because we need to round off this conversation on pharmaceuticals. Shrikant, thanks for joining in. Before we get to the market-wide call, just a word on the pharma majors, all of which will start off well today, but some of which had corrected quite significantly in the run-up to this, right? I mean, the US generic companies, the Oro, Dr. Reddy's, Zydus, etc. If they start off 4-5% higher today, or maybe more, would you trade them on the long side, Shrikant?
Good morning, Neeraj. Good morning, Tamanna and everyone. See, like for pharmaceutical companies, especially those which have impacted in the last sell-off, I would say that it is better to stay away because they are opening up only because of for the time being, they have exempted these companies. But in the near future, again, they are going to consider these pharma companies, and it is better to always stay away from taking any specific trading view on those companies or sectors where there is uncertainty. But yes, those which are not like heavily impacted, I can say Syngene or maybe Piramal Pharma or Cipla, I think those stocks we need to keep on our watch list along with the hospital stocks. So there we are specifically bullish in that we like Apollo Hospitals, NH. But for these companies, I think it is better to stay away.
Why don't you also get your index view where seeing the rates settle as things stand? Of course, the expectation was for a sharper cut. Perhaps it's not going to come through because some of that information is going through the system. But what is your estimation in terms of where we find support today?
Good morning, Alex.
Good morning.
Yeah, I think, see, like, and I specifically follow the particular statement that buy on rumors, sell on news. So this time it was like more or less expected that US is going to impose between 10 to 25% tariff on India. And maybe because of that, that was discounted in the recent fall that we saw from the highs of 23,800 to almost 23,200 or 100. So I am of the view that after this lower opening, we are expecting market to recover back. I'm not expecting market to sustain below the levels of 23,000 so easily. So yes, we could see some liquidation because of option data and the FIs have short sell position on the market. But broadly, I'm of the view that 23,000 is the area where we should look for taking some contra bets in the market. And I'm expecting market to remain between the range of 23 and 23,500 for the next few days.
So what is the picks today? What are the picks looking like, Shrikant, if any? And you know, you made a good point, expiry day as well. So the strategy there specifically and picks.
See, for large cap companies, it is better to see that how actually the market opens and it reacts after the opening. But there are few companies from the mid cap basket which are doing really well. In that, we like Angel One, which is around 2350. In fact, we like most of the stocks from the capital market segment. In that, we like Angel One, which is around some 2350, 325 sort of levels. It is opening a little lower. So it's an opportunity for traders to create a positional trade on it with a stop loss at 2250. I am expecting stock to move towards 2450, but in the near term, I am expecting stock to move towards 2600 sort of levels. We also like Chambal Fertilizer, which is around some 630, 635 levels. And there also, if we consider the overall technical pattern, it is showing a lot of bullishness. It is into breakout. We can keep stop loss at 610 for creating long positions. And on the higher side, we are expecting 665 sort of levels.
Okay, so the capital market play Angel One and Chambal Fertilizers are what you should keep on your radar. Let's talk about the reaction that you are likely to see on the diplomatic front, because ultimately this is an announcement by Donald Trump. You're likely to see the Commerce Ministry that has already been in action take things to the next level. So what are we hearing from sources from the Commerce Ministry? In fact, we've got our colleague Rishabh Bhatnagar who's spoken to them, and here's what he had to say.
Right. What we're hearing from Commerce Ministry sources is that the analysis and the potential repercussions of the tariffs imposed on India have already been started. The studies regarding the impact have already begun at the Commerce Ministry. Two sets of tariffs have been imposed in India. The first one being a common 10% tariff that has been imposed across the board on all countries that starts taking effect starting April 5th, and an additional 16% reciprocal tariff that has been imposed in India that starts taking effect on starting April 10th. Now, initially, prima facie, Commerce Ministry officials are saying that these tariffs are a mixed bag. There will be certain sectors that have been impacted negatively, but there will also be certain sectors that stand to gain because India will gain a competitive edge against other manufacturing nations like Vietnam and Indonesia. So somewhat of a mixed bag here, given that there might be scope for some sort of a competitive edge in the electronics or the IT or the automotive sector even. Another important point that is there is that the US president, does have the powers to reduce these tariffs as and when certain American concerns are satisfied or countries are willing to negotiate or bring down their own tariffs with regards to the US. So India is already ahead in that scenario, given that India is already on the negotiating table with the US with regards to a bilateral trade agreement, the first tranche of which will be ready by September or October this year, by fall of this year. So India already ahead on that scenario. Number three, what we're also hearing is that a more elaborate statement or an analysis is going to be coming by the Commerce Ministry during the day, and we will stay tuned to that and track that for you.
Okay, so that statement becomes important, and I suppose part of that statement will also be a reiteration that there's a parallel conversation going on. Let's get a market view on how the day should pan out for you. Rahul Arora, CEO of Nirmal Bang Institutional Equities, joining us now. Very good morning to you, Rahul. You know, we had a comment this morning from one of our speakers that said this is worse than the worst case scenario. Is it really?
Morning, Tamanna. Thank you for having me on the show. I think it's a little too early to comment on exactly how this is going to play out because this has happened practically in the dead of the night. So I think even the government of India is going to take some time to understand its complete impact. Lesser mortals like us will probably take a little longer time. But yeah, I think to the extent that 26% reciprocal tariffs have been announced, I think the one thing that is clear, Tamanna, is we're very obsessed with the equity markets. Every now and then it's probably, it doesn't hurt our cause to just veer into the bond market and see what they're doing. And I think if you looked at the 10-year in India yesterday, and the fact that the US 10-year fell by about 3.5% yesterday, somewhere it is indicating that we're going to head into a a massive slowdown / minor recession at some point this year. So I think the bond markets traditionally tend to move ahead of equity markets, and they're probably more accurate in terms of forecasting. So obviously, this is going to have an impact. It's a little too difficult to quantify what the extent of the impact will be. But as I was hearing your colleague, there might be some, benefits to India vis-a-vis countries like Vietnam, etc. But I think the differential with China has by and large been taken out of the window. There's just a 7-8% differential with China on the reciprocal tariff. So we'll have to see. There is no question this is going to be inflationary. There is no question that this is going to have an impact on US consumption, and that the C part of their economy will slow down. And add to that we're not closer to resolving the war situation in Russia and Ukraine. And President Trump is finding ways to be elected for a third time. So I think we're starting the fiscal year on many uncertain notes. It's a little difficult to quantify exactly, how bad this could potentially be. The only one area of ambiguity, Tamanna, if I may, is on the pharmaceutical side of the tariffs. I think I've read a lot of reports since the morning saying that, pharmaceuticals are exempt. I think a slightly deeper read of that may be warranted because India does, of its $46 billion trade deficit with the United States, almost 15% of that is pharma. So if you were saying that reciprocal tariffs were imposed, but pharma was exempted, that's a huge thing. So I'm not sure if that's entirely true. It would require a slightly deeper read, but I think that's probably one headline that people have latched onto, but I'm not sure if that's entirely true.
No, but Rahul, so there is a White House statement which says that things like copper and pharmaceuticals are exempt. So why a deeper read?
I think, Neeraj, if you look at what the president's speech itself said, he said he wants to bring back pharma manufacturing to the US. I think that was the one line that he himself said. So I'd want to read the fine print. I'll be very honest with you saying that I haven't, because it ended at 2:30 a.m. our time. So it probably requires a deeper read. But
understandable.
I just think, Neeraj, this is going to be ongoing, right? I think you've seen this with Mexico. He imposed tariffs, then there were some issues with migrants that were addressed. And I think on a case-to-case basis. But one thing is clear, Neeraj, I think, if you and I were having this conversation, say in October last year, in an era of globalization, nobody thought we'd be going into a world that was inward-looking and protectionist. So I think that's the new reality for the next at least 4 years. And if he manages to secure a third term, then maybe another 8 years. You never know. So it's not going to be easy on global growth. That's a certainty. But like I was telling Tamanna, it's a little hard to quantify. The one thing I'll say, Neeraj, and I'll say this at the absolute outset of the fiscal year, I don't think this is a year we're going back to the new highs, to the old highs. I think 27,000 on the Nifty is a distant dream now for the remaining 9 months. That's one thing I can say with some reasonable assurances, I think.
Fair call. Rahul, we are about a minute and a half left for market open. So very quickly, are there, in a minute if you can answer, and then we'll do in detail, are there net beneficiaries from this? You look at pharma deeply, fine. Anything else?
Not as such, Neeraj. Nothing that will move the aggregate, earnings per se. Because from a market perspective, it's IT, FMCG, banks, and Reliance. That's basically 75% of the Nifty. I don't think it's going to, move the Nifty in a major way. I don't think there are going to be too many material benefits that are coming out of this, is my sense.
I'm going to talk about this in more detail, Rahul, with you, of course. Shrikant, very quick view. We've got a minute left. Anything that stands out that you've seen in pre-open that gives you the confidence to place a bet?
I think, while looking at the bond yield and all, I'm of the view that we should look for taking some contra view on banks, large bank especially. And in that, we like ICICI Bank, which is around some 1335 sort of levels. In case if there is any lower opening, then it will be an opportunity. Around 1300 levels, the stock is having excellent support. This stock can again move back to the levels of 1400. So Axis Bank, HDFC Bank, as well as ICICI Bank should be on the watch list.
Okay. Shrikant, not taking any contra trades, right? Are you? 20 seconds left, aside of banks. Any pharma, anything else? 20 seconds?
Yeah, from the pharma space, specifically we like Syngene. It's a contra play, but I would say that this stock can do really well. It is consolidating around 720-25 levels. And if we consider its technical pattern, then I think the stock can again move back to the levels of maybe 850, 860. So there is a decent upside.
Right. Okay. Shrikant, we'll have to start the markets. So big drop on open. Is it as bad as people thought it to be? 160 on the Nifty. This is actually well behaved, I must say. This could have happened on any day that it's happening on the day after the tariffs have been announced. Pretty good reaction, I would say. This is music to the ears. The Sensex was 800 points on pre-open. It's 513. Now this could change, of course, but the open is very interesting. Yes, IT is feeling the indirect impact. US growth slowdown is being seen out here, which is why another 2.5% for Nifty IT, which has already fallen about 20%, by the way. Bring up mid caps and small caps. I wonder if they are also well behaved. This is extremely strong positive reaction. Anybody would have told that the small cap index will be down only 0.2%, and you would have thought that, you know, the person needs to rewire. But okay, now sinking a bit further, fair enough. We'll wait for the first 5 minutes to actually pronounce how good or bad start it is. But let's get individual stocks and just see what's happening on the large caps at least. A tick of red, a large tick of red. IT is suffering. HCL Tech, Wipro, TCS. If you thought IT had not gotten tariffs, yes, they haven't, but the slowdown impact out there. Bajaj Auto, 2% interestingly. Adani Ports, ONGC, Zomato. So no necessary reaction only to tariffs. Other things are happening as well. And on the flip side, pharmaceuticals, Dr. Reddy's, Sun Pharma, Cipla. Well, that's the bucket of strength out here. Very interesting start, Tamanna.
It's exciting to hear you say, Neeraj, 150 points down is music to the ears. At least not as discordant to note as one would have expected, perhaps. But yes, it's a tough morning, no doubt. I want to just pull up the advanced decline ratio if we can, and then re-look at the sectoral indices to get a sense of the broader markets. And this is what should give you some heart. It's not so skewed. 836 advances to 1409 declines. So this algorithm is not half bad, and this is how, you know, we're looking at where the market is going this morning. Let's pull up the sectoral indices just for a second for you, and no prizes for guessing that the Nifty Pharma will be right on top, but 4.5% up. Healthcare, CPSE is okay. A sea of red. Nifty IT is expected to be a bit shaky. Bajaj Auto and the others have had their updates out. Perhaps that's not something that the street is liking. Plus tariff impact. So you're seeing the tariff impact on one end, but also a market which is seeing some strength coming in at these levels. I want to pull up the top gainers and losers on the broader indices before we get to specific stocks, because that will give you an overall picture much more clearly. And you know, we spoke about Gland Pharma this morning when we spoke about pharma stocks. That's about 9.5% up. Dr. Reddy's, Lupin, Oro Pharma. You can see it's all about pharma stocks right now. Sun Pharma, Zydus, Suvain. On the losing side, Dabur India, because of poor business updates, and that's where the pain is. And then it's a whole bunch of mid-cap IT stocks as well. Persistent, KPI Tech, Emphasis, Coforge, and the like. Sona, BLW, obviously the tariff impact over there. So this is going to be the broad theme that we'll see through the day. And Alex, that's what's going to dominate at least for the first half.
Absolutely, no doubt. Then you've highlighted several names that are reacting from the healthcare and pharmaceutical space in particular. On the downside, we'll speak about Dabur in more detail, but I just want to pull up the small cap index as we're speaking, because Neeraj and I were having a chuckle about this. Look at the small cap index. It is turned into the green. It is trading with gains of 0.25% at this juncture. And at the way that things have opened up, you wouldn't be too surprised if even the texture or the breadth of the market changes over the course of the session for it to favor the advances. At this juncture, of course, declines are favored. But I want to go back to Rahul on a point that he was making with regard to the China differential and that going out of the window. I'm just wondering, Rahul, whether this tariff that has been announced overnight, there's no clarity as to whether this will pile on to the tariffs that were announced earlier. And so if that is indeed the case, then that differential does not go out of the window, right?
Yeah, so I think what is assumed is that it's an extra 16% on what was already announced previously. And I think the total tariff right now rests at 26%. That is our understanding. Again, as I was telling Neeraj a little earlier, this is open to interpretation because it's still early hours. We'd like to hear from the government of India officially as to how they're reading it. But I think if you were to just look at the absolute number of 26 versus 34 on an 8%, I don't see too many companies wanting to move manufacturing or anything like that away from China just on this tariff differential. If it's incremental over and above what you're saying, then that certainly holds. But if it's an extra, because from what I have understood is he's just ascribed a 50% on the value added tax, which is basically the tariff plus the non-tariff plus VAT, and he's just assigned a 50% on that. So I think it's more incremental, and which is why I think that differential at 8%, is not something to write home in a very material fashion. But as your colleague was mentioning a little earlier, I think the differential with companies like Vietnam, Bangladesh, etc., is very large. Now, whether that results in textiles or electronic goods or chemicals moving in from these countries over to India, or even coffee for that matter, because Vietnam is a very large coffee producer, that remains to be seen. But again, like I was saying, I think, the overall trade deficit with India is about $46 billion. So it's not going to move the needle in a very material way from an absolute tariff point of view. I think the bigger indication is on global trade, global growth, and therefore the resultant impact that we're seeing on India. And I think that's why I went back. I started my discussion with looking at the 10-year bond yield in the US and India, where what this implies for residual growth as a result of these measures.
Yeah, and very pertinent points that you're making. Rahul, from that perspective, just to take that conversation a little further, we're talking at a time when Dabur has come out with commentary, and the consumption story that we're talking about from that perspective is not as strong as one would hope, especially in the context of a global growth slowdown, particularly in the US. So obviously, the attention of the Indian investor turns inward, and that's not looking like a very pretty picture yet either. So where do you deploy funds at this juncture? How do you behave?
So I think you've hit on a very important subject, Alex, and I think maybe I'm sounding like a bit of a contrarian right now, and believe you me, the heart is bullish and we want India to do well because my business relies on the markets going up. But I don't think people are factoring in earnings downgrades to the extent that they are supposed to be. And I think if there's one thing that the last 4 quarters have taught us, it's on average 60% of the stocks are getting downgraded across the universe. Now, let's take all the 3-4 pieces of the puzzle which can potentially move the index. And this is what I was saying to Neeraj a little earlier. You highlighted Dabur. I don't think FY26 is going to see even a 10% profit growth for consumer companies on the large cap consumer staples. IT, I think the three of you have been discussing. Again, if you look at the large cap companies, TCS, Infi, Wipro, HCL, Tech Mahindra, again, you're looking at about a 10% kind of earnings growth if you're lucky out there. Now, banks, the credit growth has already, if you look at the scheduled credit growth numbers that have come in just a couple of days back, in the non-food credit, you've already dropped down to 11%. Retail, agriculture, consumer loans are all down to about 11.5%. Industry credit growth is down to 7 to 8%. So if you're going to go into a situation by FY26, you have banks, IT and FMCG broadly going to give you 8 to 11, 12% kind of earnings growth. Even Reliance add to that probably a 10, 12% earnings growth. You tell me how the index is going to move if you value companies on FY20. It is not possible. Now, that is why you are seeing that the entire sell side and buy side has moved to FY27 at the start of FY26, because you're not going to be able to, justify companies on FY26 valuations. Now, look at the auto sales numbers that have come in. PVs are struggling. Yes, luxury two-wheelers like Eicher and Bajaj Auto and the likes have done well. Exports have done well, but domestic is struggling. So what are you left with, right? And I think if you look at the last 2 years, the road awardments that the NHAI has done has been very poor. In fact, the NHAI has not met its own target. So cement growth comes into question, whether you are actually going to get 7-8% kind of growth in cement. So you are actually looking at a year where I have systematically broken down for you sector-wise as to why earnings growth would be a challenge. Now, the only question is, how far does the market want to look out, FY27, 28, and then start justifying valuations? According to me, since you brought up the small cap index yourself, Alex, a few minutes back, I think most small caps in India are still at least 20 to 25% overvalued on a 3 and a 5 year mean. Most of them are still trading at 1.5 to 2 standard deviation above mean, or at least 1 standard deviation above mean. Now, does that mean the market will correct? I don't know. But is there a case for the Nifty to visit 21,000? I think there is a very strong case.
21,000. Wow, Rahul. You are... Okay, we need to have a...
I'm sorry to speak my mind, Neeraj.
No, why should you be sorry? No, Rahul.
It may be an anti-consensus view, but I'm arguing with logic here. I mean, I'm happy to listen to a counterpoint of view.
Rahul, we get you for you speaking your mind because it helps. So thank you for putting that out. Please don't be sorry at all. No, but this is important. Sorry, either of you... I have a question to Srikanth, but either of you want to make a point?
No, absolutely. I was just making the point that, Rahul, so what do you do right now? You're rightly saying IT is looking bad. We have underestimated how painful your quarterly numbers are going to be. So what is the strategy right now for an investor, for a viewer who's watching? What's the outcome of everything that you're saying?
So I think, Tamanna, it's not all gloom and doom. Yeah. Let's look at where earnings growth can come, right? There are two sectors that straight away tell you earnings growth, or actually three that tell you earnings growth can come. One is consumer discretionary. I think hotels are still doing well. Airlines are still doing well. Alcobev stocks are still doing well. I think those are three pockets where we could still buy because I think earnings growth is still going to be strong. I think the one sector that has gone into a different orbit in India, and I think that's large part thanks to the Prime Minister and the Defense Minister, is the defense sector. I think if you've looked at the news flow over the last 30 to 45 days, we've had close to about 1 to 1.5 lakh crores of orders that have been announced and awarded. And I think you've seen the defense stocks rally. So that could be potentially another area. And the third is agrochemical stocks. I think that could also have a very good play. I think valuations have reset. I think if you look at names like Sumitomo Chemicals, which we're recommending, I think you could look at 25-30% kind of growth in some of these names like Sumitomo. I think in defense, we have recently upgraded Solar Industries. We like Hindustan Aeronautics. We like Bharat Electronics. You know, I recently met the managing director of a very large, defense equipment manufacturer. And he said the amount of work that they have done in Russia, Ukraine, and Middle East, that when these cities come up for reconstruction, that's a huge opportunity for some of the Indian companies that have done work there. So I think off the bat, defense, consumer discretionary, agrochem look like three sectors where we could potentially look at. And in auto as well, I think luxury auto, whether it's an Eicher or companies that are strong, exports, also very large spare part components like a Bajaj Auto. I think those could also potentially be looked at. So it's not like you can't be buying stocks. And I also think mid-cap IT, while the growth rates will come off, I still think there'll be at least 2.5, 3x than what the large cap IT companies would give you. So you could potentially look at names like Coforge if that interests.
Wow. Okay, Rahul, that's a nice list and nice summation of almost everything. So thank you so much. And once again, love you for speaking your mind. So please continue doing that.
Thank you so much for having me, Neeraj. Appreciate it.
All right. I have a question for Shrikant Chauhan, but I want to get in Vijay Kedia in the conversation as well. And Mr. Kedia, thank you so much for waiting by patiently. Really appreciate this. मैं आपके पास 1 मिनट में आता हूँ सर, लेकिन उसके पहले श्रीकांत चौहान खड़े हैं और उनके पास से एक टेक्निकल लेवल समझने हैं. Then we want to come to you. Do you see the Nifty at 20,000 as well as Rahul Arora did? But Shrikant, opening thoughts, and I have one pertinent question. Pharma 4.5-5% higher. Is this the extent of the rally, or could there be more, or would you take profits here in pharma?
See, I think it is like reaction to the overall expectations which was there in the market on the street for the sector. So I am of the view that it is better to stay away from taking any exposure in those companies, especially which are like having a very huge export to US. But yes, in that space specifically, we should focus on contract manufacturing companies, especially DVs, Syngene, or Piramal Pharma sort of companies, where I think these companies should do well, and Laurus Lab. So these are the 3-4 stocks on which we are focusing in this particular move. And if there is any correction, then it will be an opportunity for investors to take a specific trade as well as investment call.
All right. Thank you so much, Shrikant, for staying on with us. And this is an important day for our viewers and for everyone to really understand what is going on. And hopefully to help us do that is our next speaker, Vijay Kedia, joining in. Now, he is someone who everyone wants to listen to in terms of what you should do and has the best way to explain what is going on. First, let's come to that, Kedia ji. How are you seeing what's going on, और ट्रम्प साहब क्या करने की कोशिश कर रहे हैं? आप इसको कैसे देख रहे हैं?
नहीं, मेरे को लगता है शायद उनको भी खुद पक्का पता नहीं है कि वो क्या करना चाह रहे हैं. वो तो कभी डंप करते हैं, कभी पंप करते हैं, तो कभी जंप करते हैं. तो उनका अपना अलग ही एक उनका हिसाब किताब चल रहा है. लेकिन ठीक है, अल्टीमेटली जो वो बोलते आए थे कि हाँ मैं इस तरह से इम्पोज करूंगा, उन्होंने जो भी है उन्होंने टैरिफ लगाया और इंडिया को थोड़ा सा बख्शा है, उन्होंने थोड़ा सा कम टैरिफ लगाया है. इसके लिए आपको खुशी मनानी चाहिए.
बट वो खुशी दिख नहीं रही है मार्केट्स में. आप कैसे ये खुशी बनाएंगे? अब जो लोग हमें देख रहे हैं उनको क्या करना चाहिए? What should be the strategy right now? We've already seen some recovery as we're speaking. Kedia sir, in small cap and mid cap. Is this an opportunity for those who are brave to come into the markets and show faith?
Let me tell you one thing. I will put it in a different way. Forget about the market for a while, because market is very sensitive, as we all know that. It keeps on fluctuating. But ultimately, I think that it is good for India. हम लोगों को ultimately ये अपने को self एक awareness हमारा ये create होएगा. और मेरा एक point है that we have been imposed with what 26% tariff, and I read somewhere it is actually 27% compared to 54% in China. तो हमको इतना बड़ा leverage हमको मिला against Vietnam, against Thailand, against other countries. इसमें भी अगर ये blessing in disguise है, मेरे को लगता है इसमें भी अगर हम इसका फायदा नहीं उठा सकें, और अगर हम अपनी मैन्युफैक्चरिंग कैपेसिटी को अगर अभी भी हम इस तरह से वर्ल्ड लेवल पर अगर नहीं ला सकें, तो ये हमारे लिए दुर्भाग्य हो गया. मेरे लिए लगता है कि इसके अंदर में अपॉर्चुनिटी ढूंढनी चाहिए.
Okay, Vijay ji, namaskar. Alex here. I'm just wondering, in a world that seems to be getting more protectionist from India's perspective, of course, there's a large consumption story right here as well. Unfortunately, the initial readings that we're getting from a few companies is not encouraging, at least at this stage. Perhaps it will improve as government spending starts kicking in the new financial year, etc. So, where would you be deploying? And I know that you are a firm believer in the building material space. You have invested in some of these companies in the past. So, how would you be strategizing in the new year?
You see, one thing I'll tell you, we have to find the stories in whatever is happening. हर समय आपको सब माहौल अनुकूल नहीं मिलने वाला है कि सब आपके लिए फेवर का होगा, or every time you will make money. We had been making money for last 3-4 years. Now this is time to consolidate. And second, coming to the story, I feel that is still like tourism is a big story which is going to play out for next 10 years. So, and there are so many proxies to tourism. It could be hotels, and could be airlines, and could be so many other things also. So I think this is what government has also understood, that India has a huge potential. As I had said somewhere, now we have $250 billion of revenue coming from tourism. It can be scaled up to maybe $1 trillion in next 7 to 8 years, or by the end of this decade. And I think government has understood. So I think tourism should do well, and selectively, like other infrastructure, should also do well. And ultimately, electrification is the order of the day. It is going to stay here, whether tariff or non-tariff or domestic or export or whatever. So I think there are few stories which should play out in this decade.
This is very interesting, Alex and Tamanna, because budget last year, mid-year budget, at a post-budget party, Vijay Kedia was negative. And we know markets have largely been sideways to a negative move, especially after December. We are hearing Mr. Vijay Kedia say that now is the time to hunt for opportunities. And therefore, it may well be that maybe the Nifty doesn't do too much, but individual pockets might see strength. And Mr. Kedia, this is music to the ears, right? Because I'm literally seeing a change of stance from Vijay Kedia, the investor, the maverick investor. So, आपने 2-3 pockets तो बता दिए. These are all, at least the response that you gave to Alex's question, वो थोड़े छोटे pockets थे. बड़े सेक्टर में क्या व्यू है, मतलब विच विल एसेंशियली ड्राइव द स्टेबिलिटी ऑफ द निफ्टी, कि बैंकिंग में हुआ या फॉर एग्जांपल आईटी में हुआ या स्पेशलिटी केमिकल्स में हुआ, जहां पे ये टैरिफ्स का इम्पैक्ट है, लेकिन आपकी बड़ी इन्वेस्टमेंट्स है स्पेशलिटी केमिकल स्पेस में भी, सुदर्शन एटसेट्रा, इफ आई एम नॉट रॉन्ग. व्हाट डू यू डू विद सम ऑफ द लार्ज पॉकेट्स?
No, I will keep on holding them, Neeraj. मेरे को उसमें कोई विशेष फर्क नहीं पड़ा. I hold some pharma companies also. I will keep on holding to it. And so मेरे को लगता है sir, government is also focusing on infrastructure, as you said, the large sector. I think infrastructure should do well. Power sector actually इतना स्कोप है पावर के अंदर में, चाहे वो पावर फाइनेंस की कंपनियां हो जो पावर को फाइनेंस करती हो या लोन देती हो या जो भी हो, या ऐसी कंपनियां, उनके अंदर में भी बड़ा मेरे को स्कोप लगता है. पावर से रिलेटेड जो कंपनियां हैं, ये सब हमारी डोमेस्टिक थ्योरी है, सब डोमेस्टिक हमारी ये सब स्टोरी है. इसके अंदर में कोई फर्क नहीं पड़ता है कि इसके अंदर में चाइना क्या कर रहा है या यूएस क्या कर रहा है. तो हमको थोड़ा सा सेफ होकर चलना है, as you rightly put it out. So maybe index wise, I'm not very bullish. I don't see that index is going to, we are going to see a new high in next 2 years. So I don't know about 3 years. So I am not in that camp. So I think index should consolidate here, and individual stock should do according to their merit. And one more thing I would like to add here, Neeraj. As I had so many on so many platforms, I had said that nowadays after 2003, bull markets are longer and bear markets are shorter. I think this bull market made a top in September 2024. From that, just I don't have any money पक्का data मेरे पास में नहीं है, लेकिन I have seen after 2003 that this जो bear market आता है, it gets over in 9 months. So accordingly, एक खाली तुक्का के लिए मैं बता सकता हूँ कि I think so maybe by June this 2025 or maybe next 2-3 months time, this market will make its bottom. That obviously nobody knows, but more or less मेरे को ऐसे लगता है index will consolidate and individual stocks will have their own territory or will chart their own story.
Okay, well, one hopes, केडिया जी, आपके मुंह में घी शक्कर and everything else that you desire. एक छोटा फॉलो अप क्वेश्चन ये केडिया जी के पीपल आर, मतलब हमारे जो पहले गेस्ट थे वो भी बोल रहे थे कि अभी तक द क्रेडिट ग्रोथ एटसेट्रा इज नॉट पिकिंग अप, बट गवर्नमेंट ने जो जोर लगाया, पेडल लगाया है, वो लास्ट कपल ऑफ मंथ्स में लगाया है. आरबीआई इज कंसिस्टेंटली डूइंग स्टेप्स एज वेल, पीएलआई स्कीम्स आर देयर. क्या आपको लगता है कि डोमेस्टिक ग्रोथ इटसेल्फ विल इम्प्रूव? आपकी इंडिविजुअल कंपनीज के साथ आप जब बात करते हैं, आर पीपल टॉकिंग ऑफ अ पिकअप इन ग्रोथ या अभी भी ग्रोथ स्लगिश है?
नहीं, ये डिफरेंट पॉकेट्स का डिफरेंट एक्चुअली नजरिया है, लेकिन मोरलेस मेरे को ऐसे लगता है कि मैं जो भी कंपनियों के साथ में बात करता हूँ उसमें कोई स्लो डाउन की बात नहीं कर रहा है नीरज भाई, कि हाँ मेरा आगे ग्रोथ नहीं दिखाई दे रहा है या आगे कुछ कंफ्यूजन है, ऐसा तो नहीं लग रहा है. हो सकता है जब वो स्लो ग्रोथ की बात कर रहे होंगे ऐसा हो सकता है, लेकिन मेरे को ऐसे लगता है कि आगे जाके देखो 6-6.5% भी अगर हम ग्रो करते हैं, एक बात तो पक्का है कि हम ये 6-6.5% से इससे हम चाइना तो कभी नहीं बन सकते 25-50 साल के अंदर में. इस ग्रोथ से अगर ये 8-10% तक नहीं जाती है, लेकिन 6-6.5% की ग्रोथ भी अगर हम करते हैं, उसमें भी कई इंडस्ट्रियां ऐसी होंगी जो 15-20% ग्रो करेगी, कई होगी जो 0% ग्रो करेगी, जैसे वो कंज्यूमर एफएमसीजी वगैरह जो इनके अंदर में जैसे आप बता रहे थे डाबर वगैरह का जो भी है, हो सकता है वो ग्रोथ नहीं करेगी. तो ऑन एंड एवरेज जो 6.5% की ग्रोथ आएंगी, उसके अंदर में कई इंडस्ट्री है विच विल राइज फास्टर देन द एवरेज ग्रोथ रेट.
केड़े जी, हम भी बात कर रहे थे कि आपका टैरिफ सॉन्ग तैयार है कि नहीं?
नहीं, अभी तैयार नहीं है.
आइडिया दे दो तमन्ना.
आइडिया, हाँ, अब देखो, अब तारीफ क्या करूं उनकी. मैं आपको आइडिया,
अच्छा आइडिया दिया. अरे अच्छा आइडिया दिया यार, सही. तारीफ क्या करूं उनकी जिसने मुझ पे लगाया और मार्केट को डुबाया, मुझको सताया.
क्या बात है,
क्या बताया, क्या दिखाया.
ये तो देखिए ऑन द स्पॉट कोलैब हो गया हमारा. दिस इज अ कोलैबोरेशन,
जुगल बन गई.
बट नो टू कमिंग बैक टू द पॉइंट केडिया जी, जो आप कह रहे हैं कि देयर आर पॉकेट्स ऑफ opportunity. The kind of business updates we're seeing, what we will see in Q4, how important does this become? If we are looking inwards, the world is looking inwards, तो हमें भी हमारा देखना है. From our point of view, corporate India की strength पर आपका क्या व्यू बन रहा है?
देखिए, मैं एक बात आपको बताना चाहता हूँ. मैं ये जो 6-6.5% का ग्रोथ जो चल रहा है ना, मैं पर्सनली, मेरा कोई अस्तित्व नहीं है, मेरा कोई वजूद नहीं है, मैं कोई इकोनॉमिस्ट नहीं हूँ, मैं एक सिंपल छोटा सा इन्वेस्टर हूँ, लेकिन मैं इससे बहुत खुश नहीं हूँ. जिस हिसाब से दुनिया बढ़ रही है और जिस हिसाब से मैं बार मेरा ध्यान खाली चाइना पे जाता है कि हम लोग बार चाइना पे हम लोग अपने आप को कंपेयर करते हैं, तो मेरे को लगता है ये 6-6.5% की ग्रोथ रेट जो इंडिया की है वो सेटिस्फैक्टरी नहीं है. हमको इसको 8-10% की ग्रोथ रेट लेकर आना पड़ेगा. और इसी बोलकर मैंने ये बोला कि इस ग्रोथ में इंडेक्स वापस कोई नया भाव दिखा दे 2-3 साल, ऐसा मेरे को लगता नहीं है कि इंडेक्स कोई नया दिखाए. कुछ पॉकेट में आपको अपॉर्चुनिटी मिलेगी, लेकिन उसके लिए आपको बहुत सजग होना पड़ेगा. यू हैव टू वेरी केयरफुल, यू हैव टू स्टडी रियली वेरी हार्ड कि मैं किधर पैसा लगाऊं, किधर पैसा नहीं लगाऊं, क्योंकि जो इजी मनी कमाने का जो टाइम था वो मार्केट में एक बार ओवर हो गया है. अब जो आगे आने वाला टाइम है वो थोड़ा मेहनत का, मशक्कत का टाइम है इसके अंदर में, और वो पैसा इतनी जल्दी नहीं आएगा जितनी जल्दी पैसा पहले आया था. ऐसा मेरा मानना है. तो जो ग्रोथ है जो इंडिया की वो ठीक है, 6-6.5% ग्रोथ ठीक है, लेकिन हम फास्टेस्ट ग्रोइंग इकोनॉमी कोई मतलब नहीं है. फास्टेस्ट ग्रोइंग इकोनॉमी क्या, फास्टेस्ट ग्रोइंग इकोनॉमी होकर भी आप $250 बिलियन आप ऐड करेंगे. मैं हमेशा बोलता हूँ वो चाइना 5% भी ऐड करेगा, हमसे फास्टेस्ट नहीं है, स्लोवेस्ट बोल दो भैया, तब भी $1 ट्रिलियन ऐड कर लेगा वो. तो मेरे को चाहिए इंडिया का विकास ऐसा हो कि हम 8-10% का, और वो एनिमल इंस्टिंक्ट से होगा. उसको अभी तक समझ में नहीं आता है कि ये आगे ये कैसे होगा, गवर्नमेंट कैसे करेगी, प्राइवेट सेक्टर कैसे इसके अंदर में उनका क्या उनका योगदान होगा। तो ये थोड़ा समझने वाला बात है। इसी के लिए मैं ये बोल रहा हूँ कि ये बहुत सिलेक्टिव पॉकेट्स के अंदर में इन्वेस्ट करेंगे आप, तभी आपको अच्छा पैसा मिलने वाला है।
केडिया जी, जस्ट अ फॉलो अप टू दैट, एंड आई अंडरस्टैंड इट कि हम समझना चाह रहे हैं एट दिस पॉइंट कि एनिमल स्पिरिट्स which way are they heading, right? The base assumption at this stage is that government will start spending more. It has already started. December, January of the turn of the year, the assumption was that they had already started spending much more, and the assumption that they will continue to do so. So that support will be there. In your estimation, the consumption that was expected to come through, and we all spoke after the budget, the tax breaks that will start in the month of April. In your opinion, are there negative factors that are curtailing that will prevent that from having a significant effect, or is it too early to say?
Which effect? Sorry, please.
The consumption story, the consumption benefit from the tax cuts. Are there other factors that are at play to say that yes, this is positive, but उसका impact negative है, इसलिए ये पूरा फ्लो थ्रू नहीं हो पा रहा है?
देखिए, मेरे को ऐसे लगता है उसके अंदर में टाइम लगेगा। समहाउ आप ये समझिए, आप जो 11 लाख करोड़ का हमारा लास्ट ईयर का जो बजट आपने बताया, गवर्नमेंट स्पेंडिंग दिसंबर से चालू हुई, हो सकता है उसका रिफेक्ट आने के अंदर में थोड़ा टाइम लगेगा। लास्ट ईयर भी, इफ आई एम राइट, आई थिंक देयर वाज अ शॉर्टफॉल ऑफ 2-3 लाख करोड़ और समथिंग गवर्नमेंट कुडंट स्पेंड टिल दिसंबर और समथिंग, उसके बाद में उन्होंने किया। इस साल का फिर इनका वापस 11-11.5 लाख का स्पेंडिंग, फिर इनका बजट आया इनका इन्वेस्टमेंट का। मेरे को ऐसे लग रहा है ये प्राइवेट सेक्टर के साथ में होना चाहिए, गवर्नमेंट का स्पेंडिंग भी होना चाहिए और प्राइवेट सेक्टर भी साथ में इसमें पार्टिसिपेट करना चाहिए। जो बार बार हम सुनते हैं कि वो समहाउ कुछ हो नहीं रहा है, तो प्राइवेट सेक्टर कहीं ना कहीं तक कुछ समझ रहा होगा कि वो क्यों नहीं इन्वेस्ट करना चाह रहा है। चाहे उनको चाइना से चिपर उनको इम्पोर्ट के कारण उनको समझिए उनको प्रॉफिट नहीं हो रहा है, या उनको फर्दर आगे कोई डिमांड उनको क्रिएट नजर नहीं आई या समझ में नहीं आ रही है। तो ये थोड़े बहुत सारे इफ्स एंड बट्स हैं। हो सकता है आज के दिन ये जो टैरिफ लगाया है, इसके बाद में थोड़ा सा कुछ मामला थोड़े क्लैरिटी आए, तो मेरे को लगता है इसी को क्लियर होने में शायद और 3 से 6 महीना और इसको लगना चाहिए। तब तक इसके बारे में मेरा अपना कोई राय नहीं।
ओके मिस्टर केडिया, एक शायद आपके पास फिलहाल इसका जवाब हो ना हो, आई डोंट नो, बट आई वुड लव टू टॉक टू यू मे बी अगेन टू sometime in the next 2-3 days. Does the couple of sectors which are a bit confusing, टेक्सटाइल्स हुआ, केमिकल्स हुआ, फॉर एग्जाम्पल, लार्ज इंडिया प्रेजेंस, ड्यूटी लगी है, बट नेबरिंग कंट्रीज विच आर हायर कॉम्पिटिशन हैव अ मच हायर ड्यूटी, राइट? वियतनाम, कंबोडिया, नॉर्थवर्ड्स ऑफ 40%, China may be 34 plus 20, so maybe 54%. So on a relative basis, Indian firms have a lower duty than those. Does that therefore mean that Indian textile companies या Indian chemical companies को बहुत impact नहीं पड़ेगा? Because competitive intensity में वो लोग शायद better match कर पाए।
So this is what I said in the beginning of this interview, Neeraj. This could be blessing in disguise. This is what you should find, diamond in the coal mine. This is what happens, no? ये हमारे लिए कितना बड़ा इंपॉर्टेंट होगा कि आप 27% दे रहे हैं, वो 54% दे रहे हैं, 52 दे रहे हैं, जो भी आप दे रहे हैं आप उसको, ये आपके लिए कितना बड़ा एक अपॉर्चुनिटी है। तो इसको, लेकिन क्या ये इसी बोल के मैंने बोला, ये जो प्राइवेट सेक्टर है, इनको आगे आकर इसका रास्ता इनको निकालना पड़ेगा कि अब हम इस अपॉर्चुनिटी का कैसे फायदा उठाएं, या ये एडवर्सिटी का हम कैसे फायदा उठाएं। तो ये तो मेरे ख्याल से उनके हाथ में प्लेटर में उनको तो गिफ्ट है अगर कंपैरिजन, क्योंकि देखो दुनिया कंपैरिजन पे चल रही है ना, आप क्या बना रहे हो क्या नहीं बना रहे हो। अगर समझो हम लोवेस्ट कॉस्ट प्रोड्यूसर नहीं भी है कई चीजों के अंदर में, हमने तो टेक्सटाइल का मार्केट पूरा चौपट कर दिया ना। आप देखो तो किधर से घुस के 5 साल के अंदर में वियतनाम और बांग्लादेश कहाँ से आ गए। उसके पहले तो हमारा टेक्सटाइल के अंदर था, हम लोगों ने उसको बर्बाद कर दिया। हम लोगों ने कोई भी कारण से बर्बाद किया, चाहे उसको एक्सपेंड नहीं किया या उसको मॉडर्नाइज नहीं किया या जो भी नहीं किया, कोई वर्ल्ड स्केल में हमारा नाम नहीं आया। अभी मेरे को लगता है ये हमारे लिए गिफ्ट है, अगर इसका हम फायदा उठा सकें तो बहुत अच्छी बात है और उठाना चाहिए, मेरे को ऐसे लगता है।
Okay, Vijay ji, I know that we normally actually almost always speak to you about equity, but we're speaking at a time when gold is at $3,100+ per troy ounce. And I think if anybody has made money over the course of the last decade, it is the central bank certainly, and it is the Indian household which continues to buy gold. What is your opinion? In this current uncertain time, should investors actively consider buying gold?
I may be wrong because मेरे को मालूम नहीं है, but I think that gold has also become euphoric. Like stock market was euphoric in last 2-3 years. Same thing has happened in gold also. I read somewhere that we have gotten some how much 40% or 45% gold का भाव बढ़ गया 2 साल के अंदर में in 24 and 25 अगर हम मिलाते हैं तो मेरे को लगता है ये गोल्ड भी बड़ा यूफोरिया हो गया है, या जैसे पहले इक्विटी मार्केट था, रियल एस्टेट मार्केट था या है या जो भी है, gold is also I think has become euphoric. So I will not buy gold at this price.
Okay, don't buy gold at this price, but hang on to your gold, I assume. I think.
गाना सुनाओ.
हाँ? क्या बोल रहे हैं आप?
गाना सुनाओ आप बोलेंगे.
गाना सुनाओ.
वैसे प्लान तो नहीं था, लेकिन आपका मन कर रहा है तो आप मना नहीं करेंगे.
नहीं आगे बोलिए.
I was going to say thank you so much for speaking with us, but Kedia ji, you're always welcome for Ghana, for poetry and for views on NDTV Profit. उसमें कोई शक ही नहीं है.
नहीं तो देखिए, मैंने लास्ट गाना बोला था ये बॉटम है, इस बॉटम का कहाँ है, किधर है, नहीं है कुछ पता, ये एक भ्रम है और इस भ्रम का नहीं है कुछ पता. तो ये बॉटम का किसी को, भगवान को भी नहीं मालूम है भाई कि यहाँ पर किधर क्या मार्केट का बॉटम बनने वाला है और इधर क्या. वो जब जो लोग बॉटम सोचते रहेंगे, लेकर थक जाएंगे, उस दिन बॉटम बन जाता है. जब लगेगा और अब तो डूब जाने वाला है तो बर्बाद हो जाएगा, उसी दिन यहाँ पर बॉटम बनने वाला है. यहाँ पे
ऐसे लक्षण अभी फिलहाल नजर ही आ रहे हैं. So maybe that timing is right. Thank you, Kedia ji. And you know what I love? He always comes prepared with something, with a snippet, with us.
I don't think he's on prepared.
No, it's all
wired.
Verbatim.
On the spur. Yeah, the Tariff song is going to be an interesting one. Thank you so much.
वो बात कर.
Thank you so much for speaking with us. Always a pleasure. We're in uncertain times. What is certain is that gold prices are completely on fire. The yellow metal has soared to an all-time high, and which is why the next conversation that we're having becomes so important. Is this hurting gold financiers? Is there more competition in this space? We will be speaking with George Alexander of Muthoot Finance in just a minute. But before that, my colleague Harsh is quickly setting it up.
Well, absolutely. So gold has gone up 7% in the last month or so, 18% in the last 3 months. So seen a very, very strong rally. In terms of what impact does this have on gold lenders and financiers? So this is how it works. Generally, in a secured gold segment, you'll have a customer come in, submit his or her gold, avail a loan against that gold. Now the price of that gold has gone up. So how are gold financiers dealing with it? Are they seeing customers come in and request for higher value in terms of loans? What's happening on the asset quality front as well, because you're seeing some problems with regard to microfinance, whether that is starting to reduce or taper. And Muthoot does a bit of microfinance as well through its subsidiary Belstar. Also, with regard to when you're looking at Manappuram in particular, you're starting to see Bain Capital look at Manappuram more constructively, and therefore that dynamic and that change with regard to how the competitive environment will likely change as a result of Bain coming in into Manappuram. How is that impacting the lending environment, as well as what can be the impact of that going forward, maybe the next 3, 6, 12 months of this development, and Muthoot will directly be impacted by that. So some of those factors will be interesting to know, and given this quick rise of gold, how are processes changing at a ground level is going to be interesting.
Okay. So all that and more, George Alexander is joining us. He's Managing Director at Muthoot Finance. Mr. Alexander, always a pleasure to speak with you. And today is an interesting day to talk to you, to understand what is happening in the space. Gold prices are soaring. What is the kind of impact that you see on your business? Does this make things difficult for you?
Thank you. Good morning. As you say, right, the gold price is on fire. Probably in the last 1 year, it has gone up by almost 40%. In the last 1 year, it has gone up by 40%. So that is where the gold price is. And that's one fact of the matter. But as far as a gold loan financier, we finance against gold ornaments. As far as we are concerned, what is happening is today a customer need not bring the same quantity of gold for the same loan. Probably, if he wanted a loan of 1 lakh, he had to bring X amount of gold. But now with the price high, he needs to bring little lesser amount of gold. That's for some people. For some who are actually wanting to borrow the maximum, they get more on their existing gold loans. But having said that, there is a Reserve Bank of India or a regulatory cap on how much we can give. We can give is only 75% of the gold price. That's the maximum we give. But today, if you look our portfolio, the average is only 62%. That means people have taken only an average of 62% of the price. Not that everybody wants the full price. They take loans for their requirement. If they require 1 lakh, they'll take 1 lakh. If they require only 75,000, they'll take only 75,000. But there are so many questions of this. So the first part, I think, is how it is impacting. More and more people are able to get gold today. What is it is because the gold price is on fire, every day you see at least 2 articles on gold price in the newspaper. So people are now familiar or really coming to realize the gold ornaments which they have has become more valuable than what it was probably a year back. So they feel that they have a little more valuable asset in their hands. And why not use that, monetize it to take a loan?
Okay, so you're saying that whatever the impact is mitigated by the larger number of people coming in for gold loans. Is that the core message?
Yeah, core message is more and more, the market is improving.
Yeah.
See, everybody is growing their gold loan book. Muthoot has grown, we have reached 1 lakh crore of gold, or AUM, 1 lakh crore we have reached maybe a week back. So we are increasing, we are growing our book. Banks are also growing their book. So the market is deepening, more and more people are using gold loan as a safe or a quick and an easy collateral to get loan.
Tell me what it means for you, or how you are seeing competition shoring up resources, bulking up. Manappuram coming with Bain. You knew that question was coming, Mr. Alexander. So I know you're prepared for it. But you have the big. They're getting the big guns on. So this is getting a more and more competitive space. How are you preparing for that?
So, see, gold loan is a business where the customer needs to feel comfortable parting with the gold and giving it to the lender. So, if Muthoot over the years have got that reputation of a reliable, good, trustworthy lender, and that is why people prefer to come to Muthoot and deposit their gold. Actually, they are giving me 100 or 125 rupees and taking back only 60 to 70 rupees. He actually needs to have more trust in the lender than the lender having to trust him. So the point is that people, first of all, needs a trusted brand, and Muthoot has always been there. But as I said earlier, the market is increasing. More and more people, earlier people who are shy or reluctant to take a gold loan are now coming forward with gold loan. Banks are also doing it. So Bain or a Manappuram, etc. are coming in. It's not an issue for Muthoot at all, because we have more than 5,000 branches. We have the people there where the people trust, and we still keep growing. We should be able to do growth in spite of others coming. But then it is not that somebody is taking away my business or I am taking away somebody else's business. The business is there for customers, and as the market is increasing, everybody is getting a pie. And those who are more in the fight, more prominent there, they will get more business.
Got it. No, Mr. Muthoot, I'm just trying. There is no doubting the fact that the brand name that you've built is excellent. But I'm sure you get enough calls for a large PE firm wanting to take a minority or a majority stake in your business, co-invest, etc., right? Is there a case for refusing those? That's my question.
Okay, well, no, sir, because today our capital adequacy is more than 27, or almost touching 30%. The regulatory norm is only 15%. So capital is not an issue for us at all. Today, even our borrowing or leveraging is only about 3 times. Less than 3 times. So we have sufficient capital with us probably to grow, and we are actually generating good money also. So we have a good profit generation also, which is always plowed back into the company. So as of late, we don't require capital. As you say, of course, there may be people who are wanting to get invested in the company like P's, etc. But I don't think today people realize that we don't need it. So I don't think they are coming now.
Got it. Okay. You must be in a silent period, so I won't probe for too many details. But broadly, has the quarter been of acceptable growth metrics, or were there challenges?
Growth metrics, I don't think today, if you look at the guidance, you've always been giving me very, very low guidance of 15% every year. But usually we do 20, 25, etc. every year. We just say we do 15%. This year, we have already, since our AUM has grown 1 lakh crore, we have already touched 40% growth this year. So probably next year also, if we don't know if things are bright, there can be good growth. There can be good growth next year also.
Okay.
Next year means this year.
FY26. Yes, indeed. I guess I won't probe you for more because I wouldn't want you to violate any of the SEBI norms. So we'll leave it at that and maybe talk to you post your numbers are out, sir, in order to try and figure out what is the good growth number for FY26 looking like. But thanks for joining in today. Really appreciate it.
Thank you.
One business which doesn't get impacted by the tariffs at all, but we'll talk about businesses which do get impacted by tariffs on the other side of this break. Stay tuned. Just keep in mind that the indices which were holding out well, you could argue still doing that except for IT. So IT is completely been bamboozled, 3.5% in trade. And if I can bring up the 6-month chart of Nifty IT, you'll probably see that from the December 11 peak. I mean, it's been a rock, like a rock dropping, or maybe not as steep, but certainly very, very steep. This must be, so 6-month performance is 16%, but from the December peak, this must be maybe 23 or 24%. That's a serious pullback in the IT majors. Probably one sector which has gotten literally decimated. I mean, the last time that something like this happened to a sector was maybe defense in 2024. So bear that in mind. Okay, small caps too in the red now, by the way, and the mid cap index is about 0.6% lower in trade. The one which is the most well behaved is Nifty Bank. But as we said, we've done one set of views, both institutional and individual investors in Rahul Arora, Vijay Kedia. We get in an important sell side view. Sandeep Bhatia, Managing Director and Head of Equity India at Macquarie Capital, joins us on the other side. Stay tuned.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Well, I'm back with India Market Open right here on NDTV Profit, and a delight to welcome in Sandeep Bhatia, Managing Director, Head of Equity India at Macquarie Capital on the show. Sandeep, good having you. Thank you so much for taking the time out, pertinent day to have your thoughts and insights. How have you viewed the spate of announcements that happen at 2:30 a.m. India time? I mean, is this a bad one for risk assets like equities, or is it still a moving picture?
So there's a lot to talk and discuss and understand. It requires much more time. I'll just give you key takeaway points which are important. One, it's bad for all financial markets. It's bad for global GDP growth. It's less bad for India. It underlines the fact that India is not as exposed to global trade flows and US imports as much as, let's say, China, Japan, South Korea are. But if there's shrinkage of global demand, India also sells to other countries, and that will have an impact. I think we are seeing the rise of a new global order, the order in which the US was the consumer of the last resort. It's a technical term. Essentially, if anything happens, the US economy will come in and bail everyone else out by consuming and buying things and products from them. That's now not going to happen. I think it will create significant political and social imbalances around the world, but that's a longer topic. In the near term, India remains more in a better place than almost any other country in the world. That's the key takeaway, at least for the short term. I expect renegotiations. I expect a bilateral trade agreement to come in by Diwali or before that. And to that extent, the tariffs that we are going to see now, 26%, could even fall lower.
Okay.
That's it.
Okay. No, Sandeep, so let's say we will have the time, if you have the time today, to get into details as well. But I love the summation, so thank you for that. Now, my question, though, is this, that if India is relatively better placed than some of the others, but your larger statement was that it's bad for financial markets by and large, does a relatively better placed economy and market do well if the rest of the world isn't, or does everything suffer?
I think everything suffers. We have to accept that. When you say I'm doing better than others, that if everyone is flunking in the class and if you're getting a A grade, that doesn't mean that you got 100 out of 100. It only meant that everyone got 30 out of 100 and you got 60 out of 100. So that's what it is. So that's my key message, that we are definitely going to do much better, but everyone else is going to suffer. And the impact of that will be across the board. It will also mean that financial markets, which look at the US to stabilize every time there's trouble, cannot look at US, both in terms of consumption, demand, and also in terms of supporting institutions to bail out financially troubled regions. So it's not something which is immediately a pressure point, but if there's an accident elsewhere in the world, and who knows, there could be an accident even in the US, each country is on its own.
Sandeep, good morning. Tamanna here. These are strange times where we all turn into economists, geopolitical experts, Trump mind readers, and so on and so forth, as we're trying to figure out what to do. But one scenario painting that is turning out is that US ends up self-isolating. The world tries to figure out how to move on without the US in the picture. As things stand, do you think India and Indian equity will now focus more and more on domestic plays as the world becomes more inward looking?
Well, it can happen that the US completely self-isolates. We'll have to wait and see what are the political fallout of this. It's not going to be easy for the US consumer. Inflation is going to rise, even if half the tariff increases are rolled back eventually. I don't know how long, whether they happen this year or they take longer. There would be impact on financial markets because the earnings of companies will suffer. So all companies who decide to take that hit will suffer. So financial markets, to that extent, earnings growth can come off. And the US also will see a rise in inflation. So the Fed is now in a tough place. The fiscal deficit of the US is at record levels. Indebtedness of the US is projected to go up. The US has always been a indebted country and will continue to do that. So, will you really think that the US Fed can have the strength to bail out the US economy if things go bad? Yeah. So we wait and see. I think in the near term there is a bit of a risk off which will happen. And all of us have to hope that there are no major accidents, but that's no guarantees for that.
Okay, so having said that, if we're going to focus on what's happening domestically and factors over here, Sandeep, if I look at Indian equity, already been beaten a fair bit, valuations have come off, and then you have now Q4 is going to be the next event we look at. Of course, with the tariff overhang. What is your assessment of how corporate performances are going to pan out, and are we setting up for a slightly better FY26 relatively?
So fourth quarter earnings are quite immaterial. I think they're already factored into the market. So I would not think that there's any major negative reaction. For 26, yes, we should have stronger growth coming through. If this tariff had not happened, I would definitely be much more certain. I'm now hoping that we see a quick resolution to the tariff wars. I am also now hoping that the US, also tries to unwind this, and this is a more political positioning rather than economic stand for the longer term. But if this is a minimum 10% duty, in 23, the average tariff that the US charged to the rest of the world was 3%. Even if now it goes to 10%, it's like 3 times more tariff. So there is an impact on corporate earnings. And assuming that none of it is actually passed on to the US consumer, which is also a very brave assumption, it means that corporate margins profitability takes a big hit. And to that extent, earnings growth, even for India, if global demand takes a hit, will come off. I think all this is slightly difficult to immediately factor in. So the markets will take some time. And as I said, therefore, better than the last 6 months is the outlook for financial markets for the coming year. But a lot needs to be seen, and a lot needs to come through still in terms of events and actions.
All right, Sandeep. So, okay, let me isolate and keep the tariff impacted sectors out. Ask you about the indirect impact sectors, right? The biggest loser today is IT. But I was scanning since December peak. That sector is down almost 25%, factoring in maybe fears of AI and disruption, and now global growth slowdown as well. Is it baking in the worst, or do you think there is still some room to go for IT multiples to contract?
I would say yes, they would agree with you always that yes, the worst is probably over for IT. But, if these H-1B visas, we have not seen any impact. But if we see that also come under the scanner, services have not been talked about. And I was very positively surprised that he didn't mention anything. But if they decide to take it under the scanner, then that's a separate thing which will happen. I hope that does not happen. But yes, if there is US growth slowdown, which looks very likely, then to that extent, IT will also get hit. I would say, all things remaining the same, pari passu, everything is the same. We are all through this correction phase for IT for at least 80% of the time. So we need to see if there's suddenly new things thrown into the pot, which we have to factor in. Most of the pain is behind us rather than ahead of us.
Okay, yeah, because the cuts are very, very steep in the session today as well, and I'm guessing that you would believe that's true for both IT and ER&D, because ER&D has a fair degree of Europe presence. Some companies have a large auto presence as well. Would the same hold true for them, because the dynamics for them slightly different than maybe IT services?
Yeah, the same for ER&D. And I think you raised an important thing that everyone sells around the world in the end. And India will now have to quickly move. Unfortunately, we have not been quick enough to do this, but with not only US, but with other regions of the world, such as Europe, we need to move fast and protect our businesses and industry. As I said in the very beginning, we are in a new world order. And you have to think differently from what you used to think. And I think now we need to have individual regional trade agreements for large economic zones and move towards that.
Okay, Sandeep, the other question is around domestic consumption. Now, Dabur's numbers left a bit to be desired, frankly. But we know that from April, there'll be some money that goes into the pockets of the urban consumer, at least the tax-paying consumer, which I presume is largely urban, tier 1, tier 2 at best, maybe. What happens to consumption? And by consumption, I don't mean discretionary, which is still okay or maybe okay, but staples. What happens to that bucket?
So I think staples has been painful. I think we have seen some indications of a stronger rural demand, which is coming through. So as I said, everything remaining unchanged, the pain point of last year is behind you rather than ahead of you. If you tell me that there is going to be something different coming through, there's a big monsoon failure, then I can't predict that. No one can predict it. I don't think even the IMD, the meteorological department, will be able to predict it right now. So let's wait and see. Yes, but consumption should improve, because not only tax cuts, I'm hopeful that there are some GST cuts also, as the finance minister mentioned. I'm also hoping that the RBI gives us a rate cut of 25 basis points, next week. So I'm looking at all these factors to say that broad consumption should get a boost.
Sandeep, in terms of financials, the tried and tested, I'm going to ask you about financials and pharmaceuticals. Pharmaceuticals I'll come to in a bit. It's hot today because of the perceived exemption. But in terms of financials and the private bank play, does that turn into a steady story and a safe island from an Indian equity perspective right now?
Yes, because the rate cuts which have happened will probably be less aggressive than they have been, because US inflation goes up, the Fed cannot cut it. The US also wants not the US, the Trump administration wants a weaker dollar. So rates may not be cut as aggressively as one thought just before this event. Especially if inflation in the US spikes up. It all depends on the inflation trajectory, and if rates do not get cut as sharply in India, to that extent, private banks' NIMs, which has been correctly highlighted, could come under pressure, would face less pressure. The only second-degree impact, which is impossible to quantify right now, is that if there's a global GDP growth slowdown and Indian GDP goes, let's say, below 6%, let's say it goes to 5.5% next year. I'm not saying that's happening, but if that happens, then private banks and credit growth will take a beating. In the near term, definitely private banks especially are a safe haven.
And would pharmaceutical be a safe haven? We're getting a few contrarian views since this morning as well, Sandeep, because on the face of it, okay, exemptions, pharma has dodged a bullet for now from the US perspective. But in the same breath, they are saying that they want to come back to it, they want to review it, they want to make in America. Can you do it? There's just so much of a cloud out there. Is this a space you've ever been excited about?
Well, we love pharma right now. We love Sun Pharma. And they want to make everything in America, right? So they will probably have to pay the same wages in America which they pay here. So I don't think that's going to happen, at least. So the cost structures are going to be different. And the fact that medical costs are a huge pain point for the entire US economy. It spends the most in terms of medical healthcare costs and gets the least outcome for the kind of spending. There are significant entrenched monopolies and actually medical practices in the US which result in overprescription and so on and so forth. So I think pharma will be fine. There could be near-term pressures, but I expect all that to be addressed when we do the bilateral trade agreement by September, October, by Diwali this year, as I pointed out. Everything can be negotiated in the Trump White House, but finally, everyone has economic and political pressures, and those will be addressed.
Okay, fair call. I have one last question, Sandeep, and that is the resurgence of some of the sectors which were thought to not get order flows, and the last 2 months have seen serious order flows. Some infra, some defense coming back and quite significantly. So the order books are still looking okay. Are these pockets of interest largely insulated if indeed Europe is going through this whole expansion of both defense spending and as well as otherwise maybe some Indian companies benefit out of that as well? Is that a pocket to maybe study more?
Of course, I think everyone will have to fend for themselves. That's the first thing I said. Not only economically, but also in terms of their own security and their borders. So defense spending across the globe goes up. And India will also be part of the same trend, and Indian companies will benefit. Yes, so that trend continues. Even capex and infra, I don't think that that is something which India can do without, or the rest of the world will also build out factories. So to that extent, that hard assets will come. So always saying that we can live without hard assets and we can do only value add work. It seems that America also wants to do, the grunge work, which the rest of the world was doing for it. So good for them. But it also means that capex, infra, and defense continue.
Sandeep, we've focused so much on equity, and of course that makes sense. That's what you look at. That's what we all look at. But do you think that this is the time for other asset classes to also come to the fore? And we've all been having the gold conversation, the debt market conversations as well. Do those start looking more attractive as this uncertainty lasts?
Yeah, gold is a safe haven asset, it is the only safe haven assets which remain, which I think US dollar and treasury bills were seen and continue to be seen as a safe haven assets. But we also know that US is going through a huge fiscal deficit and indebtedness problem. If this results in GDP slowdown in the US, tax takes take a beating. It's unlikely that the fiscal path the US has set itself on, even before Trump came to the White House, is going to change meaningfully. Actually, as I said, then this means that the benchmark asset, which is the US Fed, may not necessarily be the benchmark asset. So we'll see. It's impossible to say anything of this order right now. I hope we never face that situation.
Yeah. We live in times of uncertainty. I mean, interesting times, exciting times, but definitely uncertain times. Thank you so much, Sandeep Bhatia, for joining us today. Always a pleasure to speak with you and hear your thoughts, especially when the world is trying to figure out what's happening. Meanwhile, a quick look at markets before we get to our next conversation, and we're dissecting what's happening with tariffs. Yes, Nifty IT, worst hit, about 3% down on that index, but look at the Nifty 50, and we'll pull up the intraday for the Nifty 50. Signs of recovery there. The Bank Nifty now in the green, just about mildly. So you could see some signs of recovery over the course of the next couple of hours. But let's talk about LT Foods. We're taking stock of companies that have exposure to the United States and what the impact for them is going to be. But before we get to that conversation with Ashwini Arora, let's go across to my colleague Mahima.
Right, so LT Foods is one of the companies which might see an impact of that 26% tariff on Indian imports. The company is engaged in milling, processing and marketing of branded as well as non-branded basmati rice, and it operates several brands like Dawat, Royal Heritage, etc. Now, in terms of geographical split, in terms of revenue for first half of FY24, around 40% of their revenue comes from USA, followed by 29% in India, and then Europe around 17% and Middle East around 6%. So in terms of overall impact on LT Foods, since 40% of the revenue comes from USA, they might see the tariff impact. So the case for chat here will be how overall the tariff will impact the performance of the company as well as how the top line will be impacted. They've also planned to target capex of around 150 to 200 crores going forward, and a USA facility will be up and running in the month of May next year. So we'll also have to see as to how or if any impact will be there on this particular facility that will come into picture. And lastly, also in terms of geographical split change, if any, will take place going forward with after the tariff announcement. So all these things will be point of discussions for this particular chat today.
Most certainly, and Mr. Mahima, thanks for that. Mr. Ashwini Arora, MD and CEO at LT Foods, joins us on the show to give us some insights. Mr. Arora, thanks for joining in. What did you make of the tariff order? for yourself as well as for the sector?
Morning, it's too early to comment, the impact of this tariff. We are, strategizing it. So in a week's time, we will be clear on that. But the good thing is, in Basmati sector, we have only one competition, which is Pakistan. And, they have a higher import duty. So there is no competitive disadvantage. And the second good thing is, what we have seen, when the last time, the disruption came of freight and all these things where, the inflation goes up. So we have not seen the impact on the food consumption. So, but, the detailed things, we are working on that, and we will be very clear in a, week's time.
Okay. So, Mr. Arora, you are saying, while you still assess prima facie, if indeed the place of competition for you is slapped with higher tariffs, if anything, it could be net positive for you. Prima facie is what I'm taking from your opening statement.
So, that is only 3%, like India is 27 and Pakistan is 30. So that is not a big, so that's why, it's not advantage, but more is, we were worried about, the disadvantage. So we will not have disadvantage, so the minor advantage may come here.
Mr. Arora, I'm just trying to understand what this does to your capex plans. And will you have to undergo a geographical shift? 41% of your revenues, the bulk of your revenues are coming from the US right now. Will you have to undertake a geographical shift? Because at the end of the day, you'll have to pass on these tariffs to consumers, isn't it?
Yeah, so that's why I said, it's too early to comment on that, So, so I told you two good things, which is one, we have not seen historically in terms when the inflation came and there was no impact on the consumption. So that's the good thing. And second, I told you about Pakistan. So we are not, but we are still evaluating the...
Sir, but if you can just give us a sense, what is the current pre-tariff? What was the duty on your export?
That was on per kg, that was coming to around roughly 1.5% to 2%.
Yeah. So
that was the duty.
So we are going from 2% to 26% as of this moment.
27, that's what we are, reading is 27, but the clarity will come in more 2-3 days time.
And this product is not on the exemption list that has been put out from the White House. So as things stand right now, because they've made it clear that they're starting with imposition of tariffs immediately, we've gone from about 2% to 27%. I know there are a lot of things that will pan out, Mr. Arora, but the first things first, this gets passed on completely to your consumers and to your clients in the United States?
Again, I'm saying it's too early to comment. So give us a week's time, but we looks like we are in control here.
Okay. One question, Mr. Arora, that is whether okay, I know again it might be too early, but I'm just trying to understand. Would you believe that there are any risks to the 12% growth rate that you had forecasted for, obviously not for Q4, but for FY26?
Again, I'm saying it's
too early. Which is why I said, I think you will give me that answer, but I was just trying to understand whether,
it's too early.
Any changes to the capex plans or even that is still in the off?
Not yet,
Not yet, okay, fine.
Not yet.
Okay, Mr. Arora, we'll leave it at that. Thanks so much for taking the time out. I appreciate you coming in though, to try and give us some assessment, but too early.
Fair enough. It's literally been a matter of hours, and for a company to relook at their capex plan. Having said that, everyone knew this was coming for a month, and it was definitely going to be higher than 2%, which is the current tariff. But if the idea is to make in America, you can't do that with basmati. You can't start growing basmati in the US. Even if you wish to, you will have to import it.
Or medicines. At least for the time being.
Medicines, maybe at some point you can. Geographically, I don't know if you can start growing basmati in the US. So some things will have to be imported. Having said that, I just want to mark the recovery in the markets. We spoke about the Bank Nifty a few minutes ago. Pull up the Bank Nifty once again, 166 points in the green now. So you are going to see some recovery perhaps coming in. Even the advanced decline ratio is something that we should pull up. I want to pull up the small cap index and the recovery in the Nifty. Yeah, there you go. The advanced decline ratio has actually turned positive now, 1465 to 833 in the red. Let's pull up the Nifty intraday chart and Nifty contributors. Small cap is also in the green, by the way. What is driving some strength and recovery in the Nifty is something that I would be interested to see, because you have had a sharp enough recovery from the day's low. Yes, pharmaceutical companies are ruling the roost, but along with the Sun Pharma and Cipla, you have Shriram Finance and an Ultratech coming in. It is the IT pack which is dragging down the market. So an outsized impact of IT truly, if you go to see Niraj, and even beyond the pharma names which was expected, we spoke about it in the morning, we told everyone in the morning that pharma is going to going to boost. You're seeing quite a slew of other names that are coming back into action as well. So this is interesting this early on. Whether it's a Tejas, an Acme Solar, some other names also coming in. I see textile stocks also buzzing. Maybe more fine print required on what's happening with textiles.
Yeah, again, must be the Vietnam-Cambodia angle that the duties are, the tariffs are so high out there. But just before we wrap up, just one quick word. I mean, it's rare to see Persistent Systems cracking the way it has. It's the largest fall that you must have seen on the stock in a really long time, 8.5%. for this one. So clearly the US growth slowdown impact being felt on some of the most well-behaved IT names. So, well, watch out for this one. Anyways, by the way, viewers, it's not a mid cap. I just checked the market cap of Persistent, Tamanna. We call these companies mid cap. It's 75,000 crores of market cap. So relatively,
yeah. But yeah, it needs a rejig for sure. Well, that's all the time we have on India Market Open. It has been a power-packed morning, but our coverage definitely does not end here. Ask Profit up next. That's the space where you can ask about your specific stocks and holdings, and we'll try our best to answer your questions. Stay tuned to NDTV Profit.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Real estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew and with me is Mahima Vachajani, and we'll take you through the next 1 hour of trade. What a morning it has been already. The so-called Liberation Day in the US and everybody else has had to stand up and take notice around the world.
Yeah.
I think everybody is woken up a little earlier than usual
Yeah.
to try and understand what the implications are. And we've been speaking to experts from morning, market experts and otherwise, and they all seem to be trying to understand the mathematics behind the tariffs that have been announced. And of course, some have gone so far as to call it 6th grade math. Well, be that as it may, seemingly in the Indian equity markets are taking this in a sanguine manner, because you have the benchmark Nifty 50 that's trading at, in fact, the high point of the day, though it's down about 0.2% or so, and it's been a pretty narrow range. All things considered, you were expecting there to be a 400 plus point downtick or gap down for the Nifty 50. That didn't come to pass, and in fact we've recovered quite a bit of ground. There's been quite a bit of chop and churn in the broader markets as well. For a brief while you did move into positive territory, but then you gave up ground, and once again you're seeing a bit of a recovery. So 1/3% or so lower, and actually you have a green on the screen for the small cap index. I don't want to look at the advanced decline ratio as well, because in the morning it wasn't looking very pretty, but then it has turned quite dramatically, and I said that I would not be surprised if this did take place about an hour back, and it has indeed taken place. This, if anything, is something that you've seen all through the trading week so far, where despite your seeing cuts on the benchmark Nifty 50 and even to a certain extent for the mid caps, the market breadth is tilted in favor of the advances. So you have a few names on the small cap side that are gaining right now. Take a look at the contributions on the Nifty 50 and see what is moving. And IT at the bottom of the list. In fact, you have Infi, TCS, HCL Tech contributing the most to the losers. Reliance Industries once again languishing. It was that way in trade yesterday as well. And the pharma companies on the top that are contributing the gains right now, those are the top gainers as well, Sun Pharma, Cipla, but the entire pharma pack. And in fact, let's pull up the pharma index constituents just so that you can get some perspective. Something like a Gland Pharma, Ipca Lab. The fact that there is no negative is being seen as a positive, because in the tariff announcements that took place, the one exception that was very clearly focused on from the Indian context was pharmaceuticals, and that really is being seen well this morning. I'm sure a lot of you have questions about the implications for Indian stocks. Of course, in the context that you're expecting US growth to slow down and you're expecting there to be an impact in tech there, you have the IT pack as a whole that is under pressure today, and considerably so, down about 3% in trade right now, and led by the likes of Persistent, which is losing as much as 8.5%. Coforge, which, by the way, Rahul Arora was speaking to us earlier, and he said that you can actually perhaps go into mid-cap IT, and Coforge maybe looks like an opportunity. So if you've got a question about those mid-cap IT companies, then please do go ahead. Any other stocks that you're looking at?
Absolutely. Some names that are buzzing on the back of business updates coming in. Yes. So Dabur is something that is seeing the real pressure. The company has said that there is rural revival, but overall the picture doesn't look good where it comes to the volume growth, and that's why the stock is seeing the downtick of around 7%. Let's also pull up the NSE 500 and see what counters are actually buzzing, in the broader end of spectrum. Apart from IT and pharma names, of course, a lot of pharma names in the green, but something like Avanti Feeds is also seeing the pressure on the back of Trump tariff, down by about 10%, because seafoods, we are the exporters of seafoods, which is why we're seeing that pressure. Okay, all right. So you have a few stocks that are reacting obviously to business updates and otherwise, and Tejas doing particularly well. Vardhman Textiles, Raymond, all of this actually is reasonably positive. I'll tell you why, because the interpretation of the tariffs that have been imposed on something like a Vietnam, where 46% tariffs have been imposed, your neighbor is getting impacted more than you, and so from that perspective, net positive is what it is, right? Wouldn't you agree? Absolutely. That's the reason why all these textile companies are in green and up in trade today. Something like a Vardhman Textile, KPR Mills, Raymond, as well as something like Welspun Living should also see positive impact on that. Other than that, Tejas is something that's doing well. Ipca Labs is doing well. Restaurant brands, this is on the back of a couple of brokerages coming in which are turning positive on the QSR space. Restaurant Brands is up around 7%. But on the red side, it's the IT names or the names that have been impacted by the tariffs. So we have likes of Coforge, KPIT, Navin Fluorine, SRF. Again, SRF, Navin Fluorine have exposures in chemicals, which will see an impact of Trump tariff of 26%, and which is why we're seeing pressure on those names as well. So these are the counters which are buzzing in trade today. With that, let's also welcome in our guests for the day. We're joined by G. Choklingam and Kush Bora joining us today on the show. Welcome to both of you, gentlemen. I'll go on to our first caller. Arun from Bengaluru is calling in. Arun, a very good morning to you. How can we help you?
Good morning, ma'am. Very good morning. So my question is on the persistent system. Like my average price is 5,125. I bought in 20 shares. So my it's a long time horizon, 3 years. I'm looking for 3 years. The thing. So persistent has beaten up badly. So it's almost 8% down.
Right.
So wanted to check the view on persistent or any other IT sector I can shift to.
Okay, got your question, Arun. I'll take your question with Mr. Chokalingam. A very good morning to you, Mr. Chokalingam. Your view with respect to how IT is doing today, it's under pressure. A lot of brokerages are downgrading the counter. And your view with respect to persistent as well.
Yeah. So one good thing about yesterday's tariff war is that IT services are not penalized through any non-tariff measures or directly through any tariff measures. That's a positive. But then problem is that even before the start of the trade war, Indian IT sector has been growing in a poor single digit in dollar revenue term. And that's for more than 2-3 years. And that's not going to change. With deflationary signs are in place because of the trade war, as the market is perceiving, the discretionary spend would come down, so there will be a little more pain. So in this scenario, persistent, is already trading at a rich valuation. Of course, partly justified because tremendous growth it has been posting. But in my view, the P valuation was much more than what growth would justify. So therefore, my suggestion is that I would give a hold and I would exit in case the stock moves up, anywhere around 5 to 10%, because the wealth creation story is over at least for next 1 to 3 years from the IT services company.
All right, that's a view. Good morning to you, Mr. Choklingam, as well as to you, Kush. Kush, the first question to you is from a viewer who's writing in on WhatsApp. Lakshmi is writing in from Andhra Pradesh, and she's asking about NMDC, which she's bought at levels of, 16. Is that even, okay, I can't remember when the last time was. I haven't seen the stock at 16, but she's bought at 16 and she's holding 400 shares. She's wondering what to do. Should she hold or sell? Kush, what's the view?
Hi, morning, Alex. Morning, Mr. Chokalingam. I think must have been somewhere around September 2022 or thereabouts. If that's the rate, that's the last time the stock was, at that rate. With that kind of a holding capacity and with that kind of a view, I think you should continue to hold on to this stock from a near-term perspective. There isn't much wrong with it. Of course, the stock has actually corrected quite a bit from 90, went down all the way up until 60. But now the recovery is quite quite stark on a good footing. It hasn't had a vertical run. It's a smooth, gradual uptrend. Plus, a lot of these metal names are starting to shine again. So I think you should continue to hold on. If she's got another 12 to 24 months kind of a horizon, I won't be surprised to see the stock go back to 80 and then perhaps 90, 95 odd levels, which the stock had seen as previous highs. So a very clear hold on this one. Positional stop loss comes in just below that 50 mark where the stock had made a recent low and taken support. So maybe 58 can be a positional stop if at all you want one.
All right, so that's the view coming in on NMDC. The next counter that we're talking about is Jammu and Kashmir Bank. Ravi Kumar from Hyderabad is holding 350 odd shares at an average price of 114 a piece, and he has purchased this during the last 8 months. He wants to know whether he should hold it for some time or add some more shares at the present lower price or book a loss. He is ready to hold this for 1 year is what he's saying. Mr. Chokalingam, I'll come to you on this one. Jammu and Kashmir Bank, what's the view like for the next 1 year?
Definitely it is positive. A, the stock has corrected a lot, and B, its quality of asset is far better than many banks. And third, this is one of the few sectors to grow in double digit. Most broad sectors like FMCG, IT, cement, automobile, they are all growing in poor single digit. So the banking is one of the few sectors to continue to grow its business in double digit, and therefore JK Bank would be a beneficiary. Lastly, we are seeing a lot of economic activities focused on J&K state, and that also should be positive for the bank. So therefore, I would give a buy recommendation from my research perspective on J&K Bank.
A buy recommendation on J&K Bank, and I would hazard a guess, Mr. Chuklingam, despite the correction, and we've spoken multiple times, I think, over the last 1 year, I must give you credit. When we were asking you questions about 8 months back and you were looking at valuations, I remember very clearly that you said nothing is looking attractive. And so, rightly so, because you saw the correction in valuations that take place, and kudos to you for calling that out. So I'm glad that you're now giving some buy recommendations. That bodes well, I think, for our viewers tuning in as well. Easy trip planners. We've got a viewer that is asking, Manu from Bengaluru is asking about this. He's bought at levels of 16.6. The stock is currently at 12.25, and a lot of people are bottom fishing here. The question is, would you hold or add more at this juncture? Kush, what's the view?
Well, definitely not add. I mean, we've all known what what all transpired with the stock and kind of fall that it has seen. It's now starting to just see some sort of time consolidation. There isn't anything to support a positive up move or at least a big one at that. Now, since his buying price is 16, I'm not saying the stock's very close to it, but if you put it in context, the stock actually fell from about 28 odd levels. Some recovery is underway. He could continue to hold on to this one. However, I would suggest a stop loss at 10. If that is breached, then you must exit this stock. But yeah, continue to hold on. It might take some time. Start exiting closer to 14.5 and 16. Your closer to your buy price. Not hoping for a big profit in this one, but some consolidation underway. Could see some better days.
That's the view coming in on Easy Trip, and hold is the view coming in from Kush. Yash is writing in from Gurgaon, and he's holding 220 shares of Elecon Engineering bought at 5 and 6 a piece. He wants to hold this for the next 2 to 3 years, and he wants to know whether this company is good fundamentally or not, is his question. I'll come to you, Mr. Chokalingam, your view with respect to Elecon Engineering.
Yeah, it's a quite decent company. Also, stock has fallen a lot. So I would give a hold recommendation. In case it falls by 10%, then it can be a good buy as well.
Okay, so good buy as well. If you said, Mr. Chokalingam, did you give a target for that?
No, but definitely, even from current level, around 10% is possible. Okay. Somewhere around 500 is possible.
Okay, so that's the view with respect to Elecon Engineering. We have our next caller. Gulzar is calling in from Maharashtra. Gulzar, a very good morning to you. How can we help you?
Yeah, very good morning. Very good morning. Very good morning.
Go ahead with your query, Gulzar.
My query is about STL Tech, Standard Technology, 2,000 shares at 140.
Okay.
So can you give me some suggestion? We should hold or sell? Or we can do we can vote more on that. We can average something like that.
Okay, so did you see the charts while buying this counter, or did you check the fundamentals of the company?
When I bought, it was a fundamental and it was a good recommendation from one of our broker.
Okay.
And it was the best fundamental. I mean, the news was good, but suddenly I don't know, the market is falling down and the price is coming down.
Okay. All right, got your query, Gulzar. I'll go to Mr. Chokalingam. Mr. Chokalingam, your view with respect to something like a Sterlite Tech?
Yeah, unfortunately, this stock is always highly volatile, not only in terms of stock price, also in terms of the fundamentals. So my humble suggestion is that, even if you get tip from a person like me, you always do some basic health checkup. Why I'm saying is that if you look at the performance, it's quite extraordinarily fluctuating, and the last year it has posted losses as well. So this kind of business always see a structural trend of realization for the end products keep going down or sometimes extremely volatile. So I would say that since stock price also crashed a lot, tactically one can hold and hope for some recovery, because that also happened in the last 10 years. Whenever it got crashed, it also gave a good recovery. So therefore, not from fundamental point of view. I would say tactical perspective, one can hold a Sterlite Technologies.
Okay, all right. From a tactical perspective, hold on is a view on Sterlite Tech, though it's seen a sharp correction over the course of last 6 months, in fact 3 months on the charts. We've got Axis Bank that we're talking about next, and Subhadeep has got this stock in cash, and he's also got an option strategy that he's trying to implement. I do not have the details, Kush, of the option strategy, but he's losing in that strategy. He's got Axis in cash at 1,100 levels. He's got 509 shares. So can you give him some perspective on the trajectory that you see the stock taking in the near to medium term?
Sure. If you see on a daily basis for the last 5 sessions, the stock's making a lower high, which suggests that it has been under pressure for some time. That is why if you rank it, in the private banking space from a momentum perspective, then it will rank fourth, after the likes of ICICI, HDFC, Kotak, and then HDFC Bank, because even in a rally where the financials are doing well, this stock isn't really participating with all the gusto. However, since his buy price is not too far off, about 1100 or so, it's not a bad idea to continue to hold on to this one and exit at cost or maybe at a mild, at a mild profit. Support zone comes in at 1055. On the way up, the stock could face resistance around the 1110 mark, and once that is taken out, 1140 mark. The momentum is missing on this one, so I would suggest an early exit, perhaps at cost or maybe in minor profit.
Just to follow up, in case you have a view on this strategy, he's got one lot of the 24th April call at a strike of 1,120, and so he's incurring a loss at this stage. What would you do with that trade?
What's the price of that option, Alex, that he bought it at?
The price that he bought is 17.31.
Yeah, no, I would suggest an exit on that one. The 1100 call, as he can see on his option chain timeline as well, is seeing a very heavy congestion. So the 1100 strike will act as a bit of a resistance. If you do get that breakout, then as I said, 1110, 1140, these are some of the levels which will start acting as a near-term, resistance. While the financial services space is doing well, this stock hasn't participated. Not a bad idea to exit right now, rather than incur, more losses, as time decay more than anything else.
Okay, so that's the view with respect to Axis Bank and the call option as well. Our next caller, Shankar, is calling in from Chennai. Shankar, a very good morning to you. How can we help you?
Oh, very good morning.
Good morning. Go ahead with your query, Shankar.
I want to know, GAIL and SAIL is the right time to stop for my portfolio?
Okay, got your query, Shankar. I'll take this up with Mr. Chokalingam. Mr. Chokalingam, he wants to know whether this is the right time to buy GAIL or SAIL shares. What's the outlook like? Or both?
I believe it's possibly ideal time to buy GAIL, not SAIL.
Okay.
The global deflationary conditions are emerging thanks to tariff war. Indian steel demand also slightly slowing down. So that will be negative for SAIL. But GAIL, after the steep correction, it's very attractive, single-digit PE. But its business outlook is far superior to steel industry. And also GAIL is getting into petrochem business in a significant way. All this would augur well for GAIL.
Okay, fair point. Mr. Chokalingam, I'm coming back to you on Maruti Suzuki, specifically on today's tariff announcement. Dasaradi, who's writing in from Vijayawada, wants to know whether there's any impact on Maruti Suzuki. At least from our perspective, there doesn't seem to be, because as we all know, it is India's largest four-wheeler manufacturer and primarily focused on the Indian market, though exports have been going up in the recent past, not to the US. So he's actually bought at levels of 1,965, which is impressive in and of itself. So he's sitting on a substantial gain. Should he hold on?
I would suggest that one can sell Maruti and shift to M&M. You are absolutely right. It's got at least exposure to, or nil exposure to perhaps to US market. The point is that the domestic automobile sales have slowed down. Unfortunately, even the automobile business has joined what I call single-digit growth syndrome in terms of volume term. So therefore, I prefer M&M because the SUV growth was driving companies like Maruti in terms of overall growth, but that has slowed down for Maruti. But M&M is still doing phenomenally well, and it's also diversified in practice, which is making a lot of money. So therefore, in automobile space, Also, based on the latest last 2 months of monthly sales volume, I prefer M&M to Maruti as well as to Hyundai.
Okay, prefers M&M as compared to Maruti Suzuki is the view coming in from Mr. Chokalingam. Our next caller, Sunil, is calling in from Mumbai. Sunil, a very good morning to you. How can we help you?
Good morning, ma'am. Good morning to everyone in the studio. Thank you so much for taking my call.
Our pleasure, Sunil.
My query is with a stock called Sirma SGS.
Okay.
I bought about 1,275 units at the average price of 542 rupees.
All right.
I have net loss of about 88,000 as of today. My investment horizon is long term.
Okay.
I can wait for the next 1 to 2 years.
All right.
I don't mind. But I just want to know, it's a fundamental question, how does this company look? What are the long-term perspectives? Shall I continue to hold on to the stock or sell some? So if you can help, that'll be really nice. Thank you.
I don't want to compliment you on the clarity of your question. You speak very well.
Thank you. Thank you so much.
You can visit us in the studio if you want, and we can.
I would love that.
All right.
Thank you. Thank you so much. Thank you.
Let me go across to Mr. Chokalingam on this one. Sirma SGS, bought levels of 542. The question is pretty clear. Would you hold for a period of 1 to 2 years?
Yes, perhaps one can, because valuation is extremely stretched, but the stock also has fallen. But I would give a hold call because the growth has been quite impressive. And therefore, for 1 to 3 years perspective, one can hold Sirma SGS.
Okay, hold is the view coming in on Sirma SGS. All right, our next counter is Wonderla Holidays. Aniket is writing in and wants to know the entry price for this particular counter. Kush, I'll come to you on this one. What are the charts indicating for Wonderla? Is this the right time to enter?
Yeah, not a bad time to start accumulating. I wouldn't say go all out and buy. The reason is that the stocks definitely moved higher from the lows of 590 or thereabouts, but it's now facing resistance at the 685 mark. So you could start accumulating this one at the current price also, maybe about 50% or so. But once the stock crosses 685, that's when this ascending triangle resistance will be broken and the stock would gain momentum and heads towards the 730 mark. So yes, this is a good time to start accumulating, but I would stagger it 50% now, 50% after the 685 threshold is taken out. And on the downside, stop loss comes in at the 640 level.
Okay. All right. So that's the view on Wonderla Holidays. Seasonal play is what a lot of people call it. Unicommerce e-Solutions, it's a 1,300 crore market capitalization company, recent listing, and it is in the e-commerce space. Sohail from Jaipur has bought at an average price of 146, which is not too far from the current market price of 130 or thereabouts, but he's bought a significant quantity, Mr. Chokalingam. Do you have a view on this, first of all, and would you hold for a period of 2 to 3 years?
Unfortunately, I have not tracked this company, so I may go wrong if I give my view.
Okay. So let's avoid doing that then. And Sohail, forgive us for not giving you a specific view because we don't want to give you, or I'm sure Mr. Chokalingam does not want to give you advice that can be to your detriment. We've got Subramaniam Kothagodam from Telangana who's writing in, and he's got JSW Holdings, which he's been holding at a buy price, if I'm not mistaken, or if he's not mistaken, of 5,000 rupees, 3 shares. The stock is currently at 25,772. Should he hold or exit? Any view on this one, Mr. Chokalingam?
Yeah, it has done phenomenally well. Now the holding discount also has come down. Normally, industry average holding discount is around 50 to 55%. I think it's a great opportunity to book a profit in JSW Holdings.
Okay, so that's the view coming in.
The problem is the equity is very small and retail float is very low. So tactically, this kind of stocks can go to any level. So fundamentally sell, but the investors need to take his own decision whether to sell in a phased manner and try to capture the tactical opportunities which are possible.
Okay, the point is well made. And Kush, since there are only 3 shares, not too much in the way of tactics, but he's made a lot of money. So from that perspective, how should he plan and what levels would you say are appropriate?
I mean, even with those shares, it's a 75,000 rupee, holding.
Yeah,
at the
nothing
moment.
to sneeze at.
Yeah, absolutely. My suggestion would be continue holding on to this one. And it's a phenomenal buy. Kudos to him on holding on to this one, from the levels of 5,000 up until now. There are some minor, support zones that I could discuss, predominantly one at the 22,750 mark. But other than that, it's got everything going for it right now. It's had a brief period of consolidation and rebounded from there, after a three-month kind of a consolidation period. So it's got all going for it right now. I would suggest continue holding on. If at all you want to, then consider a trailing stop loss at 22,750. If that level is broken, it could perhaps see, a medium-term downturn. But yeah, as I said, right now it's got all things going for it. From a technical standpoint, continue to hold.
All right. So continue to hold on the technical front. Fundamentals, as Mr. Chuklingam said, you could book profits, but then tactically you should take a call. Senthil is calling us from Chennai. And Senthil, very good morning to you. I think you want to know about Radico Khaitan, and you've got a very attractive price. When did you buy this?
That is 3 years before, I could able to buy it up 3.5 years before. And I could able to track the stock which has been moving around somewhere around 5,200 to 5,500 for the last 6 months. It's been in a consolidated phase or something like that. I just want to understand whether I just want to keep it hold or should I book some profits or something. Is there any breakout is going to happen about 2.5 or 2.6 or something? I just want to understand.
Okay, so based on the question you're asking me, Senthil, I'm interpreting that to say that you want a technical view on this stock, right?
Correct. Should I hold it, or is it going to be the consolidation phase, or is there be any breakup or breakdown or something like that?
Got it. Kush, what's the view on the charts? He's sitting on handsome profits at this stage. Should he take some money off the table?
I would suggest not, because while the stock did see correction in line with what's happened to the markets, the recovery has actually been much sharper, much faster. Right now, you're seeing a brief period of consolidation over the last 2 to 3 sessions, mind you, not any bit longer. So continue to hold. My suggestion would be continue to hold on to this one, despite the kind of handsome profits that he's looking at. A trailing stop loss comes close to the 2250 mark. But to answer his very specific question, where are the resistance levels and beyond what level do I see a breakout? That level is 2600. That's the recent swing high that it had made. And once past that, a rounding bottom formation resistance will come to an end, and that will be broken, beyond which the stock could actually accelerate further and move to levels of 2850, even 3000. What I would suggest is that because he's got this medium to long term kind of a time horizon and fairly decent position, he should actually continue with the idea of trailing stop losses rather than booking out early, or maybe even booking out partially. So continue to hold right now. Resistance at 2600, beyond which the stock could head to 2850 and 3000 levels also.
So hold is the view coming in on Radico Khaitan where charts are concerned. But with that, it's time to slip into a short break. But we'll be right back answering more queries on the other side. So stay tuned.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance.
Welcome back. You're watching Ask Profit, a show that gets all your stock-related queries answered, whether they're fundamental or technical. For viewers who are just tuning in, you can either call us or WhatsApp us on the numbers that are flashing on your screens right now. All right, moving on to the next query. Puneet from Gurgaon is writing in, and he's holding 700 shares of Balmer Lorry, bought at 257 a piece. He's sitting on a loss of around 46,000 rupees right now, and he wants to hold it for the next 3 months if the potential looks good. But in terms of technicals, and he wants a fundamental view as well. So I'll take a quick view with Mr. Chokalingam as well. But Kush, with respect to the charts, how are the charts faring for something like a Balmer Lorry?
They're faring all right. I wouldn't say great shakes. The recovery is from the oversold territories, but now the stock is facing resistance around that 195 to 200 zone. Once past that, the stock could move higher towards the 215 mark. Not sure if it has enough steam from a 3 months time horizon to actually move higher, because on the days when the volumes have picked up, the stocks actually ended lower. So my suggestion would be to perhaps keep exiting at these intermediate levels, wait for 200, 215 levels to come about, and then start exiting gradually, especially if the view is 3 months. If you want to stop loss at the current juncture, then 175 is the level to watch for.
Okay, and quick fundamental view on this, Mr. Chokalingam?
Yeah, certainly. I've been tracking this stock for more than 2 decades, and initiated, closed more than 3-4 times. Right now, again, we have a buy recommendation. Stock is down 40%, and which made a dividend yield very attractive. Cash-rich company, PSU, and it is more than 150-year-old company. There are rarely few companies in the country among all listed companies of over 4,000 to have an extraordinarily rich real estate assets associated with the logistic business. Not only that, it has got a JV, particularly one JV in UAE, which is making more than 100 crore profit every year, and that was started several decades ago. The real estate asset of that JV and the profitability is amazing, and expanding the logistic in Visakhapatnam. And so, considering all that, I believe the way it created wealth in the last 20 years, 3-4 times, once again it will create. I may be wrong. Because I also personally invested after recommending to my clients. Economics also hold the stock. This is one of the topmost high conviction stocks for us.
Right, so that's the view coming on Balmer Lorry. Interestingly, charts don't look attractive right now because Kush has given a sell call, but fundamentally the company remains strong, which is why Mr. Chokalingam has given a buy call on the counter. Moving on, Benson is calling in from Mumbai. Benson, a very good morning to you. How can we help you?
Hey. Good morning to you all. My question is on transformers and rectifiers.
Okay.
I had purchased it at 396 last month.
All right.
Currently, I am in profit, but I just want to know, will it go upwards or is it right time to sell now?
Okay, so that's the view, that's the query on Trill. Kush, I'll take this up with you. What are the charts indicating for something like a transformers and rectifiers?
A fairly strong upward momentum. However, the last 1 week or so, the stock's been in consolidation, but that's all right. And it's moved higher from those 350 levels in a very short span of time. So some breather is absolutely, understandable. Now, it's got a gap near the 560 mark. That's the first level that, should come about and, could act as a speed bump more than a major resistance. So I would continue to hold on to this one. 560 is the first level. Once that is taken out, perhaps 610 as the next target. So for me, most of the stocks to do with the power sector are a hold or an add. In this case, since his buy price is so low and he's continuing to hold, I don't see a reason for him to sell. However, a trailing stop loss, starting from the 475 level should be considered. Every time the stock moves higher 3 to 5%, the stop loss can also be trailed upward.
Okay. All right. Let's talk about NCC because this is a question on WhatsApp. And Sarvanan from Chennai is asking about this. He's bought at levels of 214 and he's looking for the 6-month time frame on whether or not he should sell at this juncture. Stock is at 213, very close to the buy price. So essentially he's asking whether to book out right now before he sees downside. Kush, what's the view?
No, I would suggest continue to hold. This is just consolidation, but that too with a positive bias. The relative strength is apparent because the markets were volatile and the stock has actually stood its ground in the last 3 to 4 sessions, very close to the buy price. So not a bad idea. I mean, if I were to initiate a view on this stock at the moment, it would be on the long side. So why not continue holding on to this one? 199, place that stop loss around that mark. On the way up, the stock could see the first target as 230. And beyond that, you're looking at a 250 also. I'm just rounding it off. So 230 and 250 are your targets on the upside. 199 is the stop loss. So very much continue holding on to NCC.
All right, so that's the view coming in on NCC. Our next caller, Ravi from Hyderabad, is calling in. Ravi, a very good morning to you. I believe you have a query on Vedanta.
Yeah, very good morning to all the guys.
Good morning, Ravi. Go ahead with your query.
Yeah, just want to know whether it's time to buy Vedanta. Actually, I'm looking, it has a good amount of dividend and also it's demerging.
Right.
So will this have an impact on, Trump tariffs?
Right, okay. Got your query, Ravi. I'll take this up with Mr. Chokalingam. Chokalingam, I don't believe there will be an impact on Vedanta per se where Trump tariff is concerned. But what's the view like, outlook like? Is this the right time to enter the counter?
Hindustan Zinc is better than Vedanta in terms of the balance sheet quality as well as business model because Hindustan Zinc has got a silver business. Worldwide, that business is getting very high valuation multiples. And as I said, balance sheet is very strong. And today, the media also reported that zinc has produced a record level of metals for December quarter. So all this would augur well for the Hindustan Zinc, and also in no way it is inferior to Vedanta in terms of dividend payout as well. And also the government stake is there, that also adds to a lot more on governance issue. So therefore, I have a buy recommendation on Hindustan Zinc.
Buy recommendation on Hindustan Zinc from the metal pack. All right, Mr. Chokalingam, one more question coming to you. This is on Lupin. And we've got Subramanian from Navi Mumbai who's asking about this. He's bought 40 shares in 2021 at a price of 954. Should he sell or hold at this juncture? He's holding at a decent profit.
Yeah. So that was the time we also had a coverage. We closed it later. And, but I would give a sell call on Lupin at the current price. It has played out from the bottom in the last three years. It has almost tripled, and also, little peculiar pharma company in terms of business as well as fundamentals. It fluctuates quite widely. Not only that, since stock also played out phenomenally well, I would, suggest looking at the FDC, which has got 82% of the business coming from the domestic markets. So I prefer at this juncture, although pharma is exempted, I am not very confident the earlier threat of 25% duty is absolutely cancelled forever, or it will revisit from the US policy. So therefore, I prefer FDC Limited to Lupin. I would give sell call on Lupin by FDC. Just as a disclosure, we have invested personally in FDC Limited.
And the point is well made. In fact, we have had other commentators, Mr. Chokalingam, today also voice a note of caution. Having said that, pharmaceutical companies themselves are saying that it's not so easy to shift supply chains. And any increase in tariff would essentially be passed on to the US consumer. And seemingly the exceptions that have been made to the tariffs are those that would very dramatically impact the US consumer. If you're talking about oil products, if you're talking about copper, if you're talking about pharmaceuticals. So perhaps let's see how that plays out. We've got Ekambra calling us from Hyderabad. Hi sir, thanks so much for calling us. How can we help you today?
Yeah, good morning. See, I'm holding the Tejas Network shares at a rate of 1265.
Okay.
Now, I came to know from you people only, there is a heavy resistance at 850. Now it has already crossed the 850, it is moving towards the 900.
Yes.
Do you suggest me, is it the right time to average or accumulate?
That's a good question. That's a good question, and since it's moving on the upside, I don't think that Kush is going to take too much umbrage at the word average. Kush, what he's asking essentially is whether to add on to his position right now, considering that it has made its bottom seemingly and it is moving higher. It is in fact over 10% higher in trade today. What's the view on the upside?
I think a repeated masterclass on averaging is starting to stick, right? And not only in terms of, whether to average or not, but when to average also. And yes, I do agree with you. It's not a bad idea to start averaging this one because the stocks moved higher. I'll go back to that question. If I were to consider a fresh allocation towards stages, what would it be right now? And it would be on the long side. So yes, you could go ahead, add Tejas. I must also congratulate him on, reading the charts very well. 845, 850 indeed was, a medium-term resistance for the stock. It's broken that. And on the back of good volumes, it needed these kind of volumes and this kind of push for the stock to move, past that 850 resistance, and it has done now. Even on the weekly charts, if you see, it's making higher high, higher low formations for the last couple of weeks, and that's a very healthy sign. So from a positional standpoint, continue to hold on to this one. You could consider, averaging it as well, adding some more at the current level. However, I do see some resistances, around the 1,000 mark. And once past that, you're looking at the 200-day moving average close to the 1175 mark. So those are the levels that you might want to consider, perhaps going a little light. I know those prices are still below his buy price, but that's where you might want to start considering going slightly light on your positions. With the averaging, if it's 1:1, then your buy price will actually be significantly lower, and you might actually exit in profit.
So that's the view coming in on Tejas Networks, and averaging is a good idea in this counter as per what Kush has said. Moving on to the next query, Vijay wants a view on both IOC as well as ONGC at the current levels. Is it good to accumulate now is what he's asking. He's holding 356 units of IOC bought at 115 apiece and 222 units of ONGC bought at 234 apiece, and he's a long-term investor. Mr. Chokalingam, I'll come to you. One is an upstream company and one is a downstream company. What's the view like, and which one do you prefer?
I find it difficult to have a very solid long-term view on these stocks, because when oil price goes down, the gas price also goes down, and these kind of companies suffer. And when oil price and gas price go up also, they don't get the full benefit of higher realization. So I would prefer, stock like Coal India to IOC and ONGC. Coal India also has fallen a lot, and very high dividend yield it gives. And FY25, they missed out on growth, almost stagnating, but definitely FY26, they have to increase. The government is after them because, otherwise you will have to spend billions of dollars for importing coal. And a lot of developments are also happening in expansion of coal capacity. And this morning, we also saw that Coal India is evaluating acquiring lithium assets in Australia. That would be a big positive. So considering all that, I have a strong buy recommendation on Coal India, and I prefer to these oil and gas companies.
Very, very interesting call there, because we were talking about it just yesterday. The fact that the production numbers have actually declined in the month of March, and in fact for the full year they've missed their guidance and their revised downwards guidance as well. So point well made, Mr. Chokalingam. So watch out for Coal India on the fundamentals. We've got Ram Mohan calling us all the way from Dubai. Ram, thanks so much for calling us. How can we help you today?
Yeah, good morning. My question is regarding Kaplan Point Labs.
Okay.
Which I bought it around 1,230, about 150 shares.
Okay.
And I'm holding it for more than almost a year now. More than a year. Should I continue to hold? My plan is to hold for another 3 to 5 years. And is it the right moment to add more?
Okay. All right. And what's the time frame that you have?
3 to 5 years.
Okay. Mr. Chokalingam is already sitting on a significant gain right now. What would you advise with regard to Kaplan Point?
Yeah, the stock has played out in a very big way and slightly stretched, but definitely for 3 to 5 years one can continue to hold, because the management has delivered consistent growth over the last 10 years. It's amazing the way they created equity wealth for the public investors. And I believe they would continue to create, maybe not by the same scale how they've done it in the last 10 years, but definitely compared to the market, they will be able to create a better wealth over the next 5 to 10 years. So therefore, I would give a hold recommendation on Kaplan Point.
Okay, hold is the view coming in on Kaplan Point. The next query is on Zydus Life Sciences. Raghav from Ghaziabad is holding 100 odd shares bought at 1020 a piece, and he wants a view on this particular counter, and he wants a long-term view. So, Mr. Chockalingam, I'll come to you again. What's the view like on something like a Zydus Life Science?
Yeah, the Trump factor has been priced into a large extent. So definitely one can hold the Zydus Life for long term.
Okay, so that's the view coming in on Zydus Life Sciences. The next query is on Tata Motors. Yashoda from Bengaluru has purchased 10 shares bought at 650 a piece, and she wants to know as to what the charts are indicating for the counter. Kush, what are the charts saying for something like a Tata Motors?
Well, not all that encouraging. The only silver lining I can see is that the stock is above her buying price. If only by a very little margin. I would suggest an exit. On Tata Motors, if she wants to, she could consider something like M&M. But Tata Motors at the moment, is a very clear exit.
Tata Motors an exit. All right. Let me stick with the auto theme and ask about Hyundai. Or Hyundai, as it is called in Korea. Pradeep Rao is asking this question. He's bought at levels of 1,987, very elevated levels, and in fact the stock has not done well at all since the listing. He's writing in from Udupi in Karnataka. He's got 112 shares. He's wondering whether to hold or exit at this point. Since it's not been very long since the listing, I'm going to go to Mr. Chockalingam on the fundamentals. The numbers are not terrible, but for some reason the street has not looked at this stock with favor. Is this a valuation story that has gone wrong?
Yeah, it's a great company. The valuation story has gone wrong. The management, the promoters of the company have done well. They have rewarded themselves in terms of offer for sale and excellent dividend before listing. Of course, there's nothing wrong. That's the way the promoters get motivation, build a successful business and unlock value. The point I am saying that post-listing opportunities are limited because the listing coincides with downturn in the automobile sector sales. As I mentioned earlier, now the whole industry is going in single digit. In fact, a month back in one of the industry association meeting, it was officially quoted on all media that big players are expecting even 1 to 2% volume growth for passenger vehicle in FY26. So yes, unfortunately there is a possibility of further 5 to 10% correction in the Hyundai motor. Of course, the automobile sector is always cyclical. Once in 2 3 years it comes back, nicely. So till that time, one has to monitor. And anytime if you sense a reverse cycle, then one should rush to buy stock like Hyundai and Maruti. Otherwise, I would not buy the stock now.
Okay, so that's the view with regards to Hyundai Motors. Our next caller, Koteswar Rao, is calling in from Hyderabad. A very good morning to you. I believe you have a query on Suzlon Energy.
Yeah, correct. Good morning.
Good morning.
I bought Suzlon Energy 800 shares at 56.65.
Right.
With a long-term horizon of about 1 year to 2 years.
Right.
And my query is, if it is, should I add it or should I sell it if there is a dip?
Okay, and I believe you did not buy this long time ago. It's just bought recently.
No, actually, I was trading bit and off late I was selling and everything, but based on the order book values of the Suzlon Energies, then I bought it for a long-term perspective.
Got it. Okay. Got your query. I'll take this up with Mr. Chockalingam. Mr. Chockalingam, what's the view like for Suzlon Energy for the next 2 years?
No, it's of late has become more of tactical. Of course, I don't want to undermine the achievement the company has made in the last 2 years in terms of turnaround. I said tactical because if you look at the annualized EPS, the stock is extraordinarily stretched in valuation. So I would sell, but there is a risk by any chance, since a lot of big players have entered the renewable energy space, if at all this company joins any consolidation process, then there could be a significant upside. But otherwise, standalone on its fundamental basis, it's a good sell now.
Suzlon is a good sell at 57. Man, that's not going to be something that a lot of people who bought at slightly elevated levels are going to be happy to hear. Shriram is calling us from Puducherry. Hi Shriram, very good morning. How can we help you today?
Morning, Matthew. I'm a big fan of you. I'm holding 1,500 NHPC shares at an average price 103.
Okay.
So my query is, should I hold for a year or should I exit at current price?
Okay. All right. So, and you've been holding for a year, but how long did you intend to hold it for? Is it a long-term play that you have?
Yes, 3 to 5 years I can hold.
Okay. You bought at levels of 103, right?
Yes, average price.
Okay. You said you can what?
Hold for 3 to 5 years.
3 to 5 years. Okay. Since it's a fundamental question in the power space, would you prefer? And I know that Mr. Chokalingam, you've talked about Coal India, so I would think that you're positive on thermal power as well going forward. But NHPC specifically?
If you look at the consolidated earnings for the last 4 years, it is in the range of 3.2 to 3.6 rupee EPS, almost stagnation. The second problem with a company like NHPC is that it is idle power based. There is a natural limit for quick expansion. Very difficult unless you get the right place in terms of geographies. You can't expand capacity. In many other power generation cases, if you have a lot of capex, if you have a lot of resources, you can expand to any level. So here there's a lot of limitation and profit also stagnating. And if you look at earning EPS P also, it's somewhere around 28, 29 P. So yes, hold in case it stock recovers another 5-10%, one can sell this stock.
Okay, so that's the view with regards to where NHPC is concerned. Our next query is on Mazagon Dock. Vijay wants to know whether the current levels are the right levels to enter the counter. Kush, do you think that the charts are attractive enough to enter into something like a Mazagon Dock right now?
I'd wait a bit. The reason for that is that the recent move has actually stretched the stock quite a bit on a daily chart. You are seeing some sort of a negative divergence play out. So I would wait. Also, what's happened is that the stock is now coming up to the all-time high resistance levels of 2,800, 2,900. So the upside and the risk-reward ratio from here doesn't really seem as favorable. I would prefer perhaps to get in closer to the 2,500 mark, 2,450 mark, with a stop loss near 23.25, and then you play for all-time high levels of 2,900. So perhaps at dip is when you should consider Mazagon Dock, especially if your view is anywhere from 6 to 12 months.
We got Prakash N, who's writing in from Bengaluru. He's ventured into Jio Financial Services. He's holding a very large quantity, 15,000 shares, at an average price of 322, as a result of which he's incurring a significant loss of as much as 13.8, nearly 14 lakhs. He's wondering what to do. He says that he can hold for a period of 5 years, and he's wondering whether to accumulate even at these levels. Mr. Chokalingam, there are a lot of good prospects for this company. A lot's been said, but we've not seen anything very materially pan out. So what would you say?
Yeah, certainly. Even person like me gone wrong. We initiated at the bottom and we failed to successfully close the stock at peak because we were oversold by the futuristic, but that did not happen. But as you said, it is true, not done much. But there are two insights. One, the stock has crashed a lot. And second, in various verticals, the platforms are ready. In fact, in the last quarterly results, in the press meet, in the con call, they clearly mentioned that all verticals are now ready in the different segments of financial services. And I also believe in that. I think for next 1 to 3 years, the stock should definitely play out. And valuation also very attractive.
Okay, so continue to hold is a view from Mr. Chokalingam. All right, it's time, gentlemen, to hit the rapid fire segment, and you know what this means. We'll throw as many questions at you over a period of 2 minutes. Do keep your answers as crisp as possible. Gautam from Mumbai wants to know about Bikaji Foods. Speaking of crisp, he's bought at levels of 837. He's wondering whether to hold or sell. Kush, on the charts?
Continue to hold, but keep a tight stop loss near the 640 mark.
Okay, Suman from Hyderabad wants to have a view on Cochin Shipyard. She's holding 56 shares at an average price of 1674. What's the long-term view like, Mr. Chokalingam?
1600 is a fair price. One should sell at 1600.
Okay, if you're holding Sun Farm, I'm not very sure of the price, but Cornell wants to know about this. He's bought 430 shares. Should he hold or exit at this point? Based on what you're saying, Mr. Chokalingam, should he hold?
sell now. Wait for more clarity from the US.
Okay.
All right. Subhash from Muscat, Oman is holding 500 shares of Nalco at 194 a piece, and he wants to know whether he should average at the current price, but his time horizon is 2 years. Is that the right strategy to adopt, Mr. Chokalingam?
Yes, one can buy Nalco at current price.
Okay, SIS Limited is the name of the counter. Deepika wants to know about this. She's bought at levels of 501. Stock is at 334. Would you hold, Kush?
It's an exit.
Okay, Senco Gold is the next counter. Divya is holding 200 shares, bought at 421 a piece. What should she do? Hold or sell? Kush, on the charts?
Senco Gold is an exit. Targets are 360 and 400. Stop loss for this one comes in at 275.
Okay, Ashwini Kumar is asking about IDFC First Bank. Mr. Chokalingam bought at levels of 53. Significant quantity, 10,000 shares. Should he purchase more at the current price or hold for the long term?
I would prefer either Bank of Maharashtra, that's my first option, or Canara Bank to IDFC First Bank.
All right, fresh entries in BEL. Is this the right time? Ashish Pathak from Jodhpur is asking it. On the charts, Kush?
Yes, it is. Stop loss comes in at 270 is the range play, and your targets are also very clear, 305 and 325.
Okay, all right. That brings us to the end of the rapid fire segment. I know there were 2 seconds, but impossible to get your view on anything in that time frame. Kush as well as Mr. Chokalingam, thank you so much as always for taking the time. Always a pleasure having you on the program.
Thank you.
All right, that brings us to the end of this action-packed Ask Profit edition from Mahima and myself and the team that put the show together. Thank you so much for watching. Do stay tuned. Up next is KYC, and this is NDTV Profit.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Real estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
Hello and welcome. You're watching KYC, Know Your Company. Here it's a show which is designed to give the regular investor powerful, actionable insights into a single listed company daily. Now, today we're going to zoom in on PDS Limited. It's a very interesting play with regard to textiles. In terms of what the company does, well, it manufactures, it's into trading of garments and also designs and develops as well as helps in marketing of products and consumer products is broadly what it deals in, more so textiles and garments. The sourcing and distribution of ready-made garments is what the company does. It works with leading retailers. Let's probably put some names there as well, a Sainsbury, a Ted Baker. It also works with a Primark, a Walmart, a Tesco, a Kohl. So you have all of these global giants with which PDS works with. It manufactures products for these players and provides them with product. These are largely the products that they deal in, at least for the moment: menswear, women's wear, children's wear and essential wear. That's broadly the way they categorize their products. In terms of manufacturing facilities, they have 3. They have 2 in Bangladesh, 1 in Sri Lanka. The 2 facilities in Bangladesh are fairly large. In fact, nearly 80% of their facilities are based in Bangladesh. So sourcing largely happens from there. The clientele, of course, as I did mention, is spread across companies, but also across geographies. You have North America, Europe, UK, as well as Asia as key geographies that the company deals in. Even the split in terms of geography is more skewed towards a UK and a Europe than towards a North America. But nonetheless, given that tariffs is really the news of the day, we'll obviously want to understand what the impact of this is on the company as well, in terms of what the US tariff impact on the company is. That's the split with regard to geography. If you can see, nearly 72% coming from UK and Europe, just about 12, maybe 16% now skewed towards North America, 68% from UK, Europe, and thereafter the balance is around 15 to 16% coming from Asia at this point. So that's how the company is split up. So this 16% largely will get impacted basis the overnight news that we got. That's how it looks like in terms of the pie chart. A bulk of that coming from UK and Europe, right? Currently the order book is quite high. It's at around $425 million dollars. So around $500,000 worth of order book which it sits on at the end of 9 months FY25. So that's the sum and substance, frankly, of the company. Let's try and now break down the numbers and let's try and zoom into the metrics we'll be looking at. And in that sense, let's quickly pull the metrics up. We'll look at the income statement, balance sheet, cash flow, and the return ratios. And thereafter, we'll look at shareholding, street cred, valuation, as well as street coverage. It's interesting from a sense that it's a smaller company in relative terms, as we always do in KYC, just a 6,000 crore company in market capitalization. And joining me now is Mahima Vashrajani, who's going to help us break the company down. Welcome, Mahima. Busy day for you. You've been on screen pretty much all through the day. So, so thank you for this. But let's quickly break down the income statement.
Right. Pretty strong numbers where, all the 4 metrics are concerned. Revenue has seen overall an 18% 3-year CAGR. 9 months, it stood at around 9,000 odd crores, which was around 10,300 odd crores in FY24. EBITDA overall has seen again an 18% 3-year CAGR, which stood at around 318 odd crore in 9 months FY25. Margins have slightly come down from 3.8% to 3.5% for 9 months FY25, but we'll have to wait and watch out for as to how Q4 pans out and how overall margins pan out in FY25. Net profit overall stands at 167 crore in 9 months FY25, which is lower than that of FY24, which stood at around 203 crore, but we'll have to again see as to how Q4 pans out. But overall 3-year net profit CAGR has been 20%. So overall 3-year CAGR for all of these metrics are strong, which is why we've given a thumbs up for this counter. In terms of the metric that is gross merchandise value is important for something like a PDS, which has increased around 31% YOY where 9 months FY25 performance is concerned. Overall top line growth is also at 26%. EBITDA growth at 14%. Order book, as Harsh earlier also mentioned, stood at $425 million, and this is a growth of 11% year on year. And in terms of segmental performance, well, there are 2 different segments where the revenue comes from for something like a PDS, which is sourcing, where around 94% of the revenue comes from sourcing, and second is manufacturing, where around 5.7% revenue comes from manufacturing, and others is around 0.3 odd %. In terms of geography-wise split, as Harsh earlier mentioned, the UK overall geographical split has come down to around 34% from 40% earlier. Europe has remained within that range of 34%. North America has increased to 16% from 12%, and if it it is increased as compared to last year by around 4 odd %. We'll have to wait and watch out for as to how this percentage now either improves or decreases because of the tariff impact. Asia and Middle East is around 13% of the counter, and in terms of category-wise split, menwear is 37% of the overall sales, followed by women, which is also at 37%. Children wear is around 21%, and essentials and others is at around 5 odd %. So this is the revenue category-wise breakup as well. So this is the overall view as to how P&L and income statement metrics are concerned, and it's definitely a thumbs up where all the 4 metrics are concerned. Harsh?
Yeah, absolutely. So strong in that sense in terms of the overall numbers. But let's look at the balance sheet, in fact, because this one's an interesting one. And Mahima, you have views on this as well. So I'd like you to chime in with regard to the views. In that sense, your net worth stands at around 1,600 odd crore. But you look at your gross borrowing, and this is the long-term gross borrowing which we're currently talking about. Around 120 odd crore. Looks small, right? But the short-term debt is what is really, really large. Of course, it sits on a healthy cash and bank balance as well. But the short-term debt is extremely large. Now, to contextualize, it's likely that some of that debt has been taken up to lock in inventory that the company sits on. But also try and understand that given the kind of balance sheet size, that's a large amount of debt which is payable in the short term. It also has cash balances to take care of that, so that also not a concern. But just the number looks large. Mahima, you want to contextualize that?
Right, absolutely. So as you rightly mentioned, the short-term debt could be higher because of, and this is first half of FY25. And generally, textile companies or garment companies, build up inventory ahead of festive season, and because of that, they do take short-term debt, and which is why the short-term debt in the first half generally goes higher. But we'll have to, of course, ask the management as to how debt has panned out so far post first half of FY25. Overall, in terms of net debt to equity, it stands at around 0.21 times, which is not a problem right now. And net debt to EBITDA also stands at around 0.8 times. So that's the view where balance sheet is concerned, and we've taken a conservative approach because short-term debt is higher and given it a neutral rating. In terms of cash flow, cash flow from operations have turned negative in the first half of FY25 to around 32 odd crores, which was 22 crores positive earlier. And in terms of net cash flow position, however, that has improved, which was a negative 328 crore in first half of FY24, which has improved to around 268 crore in first half of 25. So just taking a conservative approach here again, because the net cash flow from operation right now is negative, we've given it a neutral rating, but of course we'll have to wait and watch out for as to how overall FY25 pans out, and whether this negative 32 crore turns into a positive number or not. So that is why just because of that negative 32 crore number in first half of FY25, we've given it a neutral rating for now. But in terms of return ratios, they are healthy but on a decreasing trend.
Yeah, and that's the other concern, right? Whether capex is really creating that overhang with regard to return ratios or otherwise. But point being that return ratios are on a declining trend. They were at the higher end of the band over the last couple of years. But a 22% return ratio, not bad at all in a space which is capital intensive in that sense. So we continue with a neutral on this. We're being a little harsh here, but we're going to continue with a neutral on this. And the return on equity though, when you're looking at that number, it's come off significantly. And that's one of the major reasons why we hold a neutral stance on this one, that the ROE number is just about 13%. The trailing 12 months in terms of ROC is sitting at 25%. So that's the other angle to look at this in, and broadly that metric stands decently in terms of its shape compared to the 22% FY24 number. But you want to take us through shareholding?
Right. So in terms of shareholding, well, definitely a well-held company in terms of how things have panned out for the counter. Promoter holdings has gone down, but it still stands at around 61.5%, which is well above the regulatory requirement, and which is why it's a strongly held company. And it's overall also from a longer term view also, it's just come down from 65 to 61, which is not a problem. FIs have increased their stake from 3.4 to 5.1%. DIs have significantly gone up and bought this particular counter. It's gone up from 0.6 to around 5.7%. And overall, public holding, of course, has slightly come down. That public holding has probably moved to the DI space, where around 20, which was around 30 odd percent, which has come down to 27 odd percent. But overall, FIs are buying, DIs also investing in the counter, and promoters have slightly reduced their stake, but well above the regulatory mark, which is why it's a complete thumbs up where shareholding pattern is concerned.
Yeah, complete thumbs up. 2-3 things to be kept in mind. Sorry, I'll chime in here a little bit. So one is the shareholding has reduced because of thin selling by the promoter, yes, but the other piece is also because of an equity raise which happened first half of this year. So something to be kept in mind. The other piece is with regard to both FIIs and DIIs, why their stake has gone up. We've had some exits, especially on the FII count. DIIs, of course, in terms of significant DIIs, you have a couple of mutual funds which have bought ICICI Prudential, ELSS Tax Saver Fund, and Aditya Birla Sun Life Insurance. Both of those as DIIs have bought. You have, in terms of public holding, and this is very, very crucial according to me, you have a Mukul Agarwal which holds this company. You have Vallabh Bhansali who holds this company. Inam has a stake as well. So you have several marquee investors, but their holding also is on a slightly reducing trend line. So Mukul Agarwal at his peak was holding 2.75%, currently holds just 2.5%. Vallabh Bhansali also at 1.8, now at 1.1. So something to be kept in mind as to how the shareholding pattern is evolving. Of course, we give it a thumbs up because the promoters continue to have very good skin in the game. But outside of that, these are some other aspects which you might want to keep in mind.
Absolutely.
So yeah, that. You want to go ahead?
Yeah, sure. So where street cred is concerned, well, this is probably the only metrics where we've given it a thumbs down, because overall stock performance does not look very attractive. 6 months, it's down by about 15.7 odd percent. Year to date, the stock is down by about 27 odd percent. And of course, this is on the back of markets also facing the pressure in terms of in the past 6 months. Overall, in terms of 1 year, the stock is down about 14.5 odd percent, and 5 years return also. If we see, the stock is given returns of only 33%, which is why we've given it a thumbs down, because overall the stock has not been performing well. And even in terms of valuations, Harsh, you may want to take that. Valuations for the counter definitely are expensive, and we're seeing that the decline, however steep, but the P ratio, as per what Bloomberg suggests, is
going to compress.
Is going to compress.
So you're going to see better earnings visibility over the next year or two, at least. That's what analysts seem to be suggesting. And there are just two analysts which actually cover the counter. Right. So that's the other piece that you'll want to keep in mind. That there's no significant coverage per se. So a neutral on both those counts, actually, Mahima. But you want to take us through the valuation as to what the growth expectation is for the company, because that will hold the key to the way in which this valuation picture evolves, if you do have a perspective on that.
Right, for sure. So, like we've seen that the 3-year CAGR for the company has been around 18% where top line is concerned. So, if you continue to see that CAGR growth going ahead also, compared to that, we're seeing that there will be a steep decline in valuation. So, at some given point of time, if this continues, valuations might become attractive over a period of time, but that will happen 2 years down the line, because next year we're expecting the PE to go down from 39 to 34 only. So not next year for sure, as per what Bloomberg estimates suggest, of course.
Fair.
And we'll have to wait and watch out for if that growth is beyond that 18% growth CAGR, and see as to how valuations pan out there.
Correct. So that's the larger expectation. Let's quickly sum it up, actually, in terms of all the metrics, and that's how it really stacks up. The balance sheet in terms of short-term debt, we spoke about cash flows, return ratios, all of these aspects we actually covered. Let's talk about shareholding, street cred, valuation picture, and street coverage. So that kind of caps it off in terms of the rating itself, and we're left with around 4.5 on 8 on this one, PDS Limited. Of course, based out of India, manufacturing in various locations and selling largely to Europe as well as US. Let me welcome on board Mr. Sanjay Jain, Group CEO at PDS Limited. Welcome, Mr. Jain. Great talking to you. I'm Harsh, and very quickly wanting your take, because it will the current need of the hour is to understand how US evolves with tariffs and what's the impact on you. So before I go on to the larger business, let me talk about the risks emanating from tariffs on your business.
Hi, Harsh. Morning.
Hi.
I think all of us have woken up to a very exciting morning today. So I think for us, what is unfolding seems to be, kind of leading to more opportunities ahead. As you know, the way we have organized a model, we are relatively asset light. For me, what is important is to serve the customer from the best available factory in the world. So having said that, today, US is about 15% of our total sales. So, if I talk about as on date today, it's just a relatively much smaller percentage. And our own manufacturing, what we sell to US market is closer to about 20% or so. So to that extent, the impact on an immediate basis, is not anything very significant. But given our model, given the fact that we are serving our customers from various markets, for example, we believe in the tariff situation that is unfolding, Turkey could be a beneficiary, and Egypt could be a beneficiary. So PDS already has a strong footprint in Turkey. It has recently invested into developing resources who in turn are in touch with factories in Egypt and Latin America. So we tend to benefit from that. And lastly, I believe while there is additional tariff on India as well, but the tariff on some other, exporting nations like China or, Myanmar, etc., have actually got much higher tariffs coming their way. So to that extent, exports from India, should benefit. And PDS has recently done an acquisition of majority stake in a factory in India, plus have deployed more resources in India to enable more exports from India, from Egypt, from Turkey. So net-net, from the present metrics, not much impact. As things unfold, we should be a beneficiary of whatever is happening.
Sanjay, just to follow up on that, hi Mahima also joining in. You said that this could possibly have a positive impact on PDS. Right now you said almost 15% of your revenue comes from USA. Do you expect that percentage to significantly go up in the next 1 or 2 years? And if yes, how will that pan out? Overall from 15%, where will you be at?
Yeah, hi, Mahima. We have got a strategy rolled out whereby gradually we see US to be somewhere closer to 30% of our total sales in about 2 to 3 years from now. And when we are trying to fulfill those sales, we concurrently went ahead and invested into resources in Egypt, in Latin America, as I just said, as part of the previous question. And these geographies, should be in a much better position to cater to demand coming in from US. So as a result, we've been very well prepared to capture this anticipated 30% of top line. So and also I just said that given our model, given our asset light model, given our agility to quickly contract factories across the world, we should be in a very good position to realign and cater to this, changing dynamics in the world. But realignment is in future. Even the last 18 months investments into Egypt, into Latin America, into India, that gives us the confidence that we should be the beneficiary from this, unfolding of tariffs.
Understood. Okay. So give us context with regard to how certain is the order book and how certain is visibility in terms of clients. How long are contracts, and therefore is there a risk in that sense of losing clients at some point? And how does pricing work in an environment like this? Do you expect an impact on pricing? Because across the board there are tariffs. There are 180 countries where tariffs have been levied. Do you believe that there's going to be a change in pricing?
No, I think firstly, in the 9 months up to December 24, we have had 20% plus growth. And as things stand today, we've just entered the new financial year. Our order book is closer to $600 million, which is almost like, close to 25% plus up for the same period last year. So we've actually entered the year on a stronger footing. So that gives us the confidence that maintaining growth in the coming year is a distinct possibility. And in terms of, we've got a very well diversified customer base. We take care that no single customer should constitute a very large proportion. Our customer base is very well diversified across reputed and credit-worthy customers. For example, if I talk about UK as a market, just as an example, Primark, Tesco, Next, Sainsbury, Asda, these are some of the large accounts, and these are pretty much stable companies. And if at all there is any turmoil, they should be the one who should be benefiting from this. And these relationships have been built over years. In fact, in US as well, as we are wanting to, expedite more and more sales into US, the relationships are with Walmart, with Kohl's, with Costco, with Target, with TJ Maxx. So again, I think these are very stable customers. As I said, relationship built over years. So therefore, while the nature of the businesses that you are discussing with customers for the coming 2-3 seasons ahead, but the past relationship, the track record of service delivery, the track record of catering to the design gives us the confidence that the business is here to stay and grow as well. And talking in terms of pricing power, I think if at all, given the tariffs across geographies, the manufacturers in some geographies may come under pressure. And if PDS is getting almost 80% plus of its sales from UK and Europe, that means I am actually in a good position to fill those factories, which are otherwise, getting impacted, if at all, by more sales to US. So that should give me some leverage in terms of pricing power when it comes to sourcing from factories.
Okay. Mr. Jain, you also talked about a recent acquisition, and that is the Knit Gallery India Private Limited, and this specializes in baby clothing. I want to understand as to, how, this entire acquisition will play out. How much will it add to your top line? From a longer term perspective, if you can give us a view, let's say 2 years down the line.
I think, Mahima, today's event probably gives me the best position to explain the strategic rationale of this acquisition. We touched upon tariffs coming on some existing exporting nations. And I talked about India to some extent having relatively much lower tariff as compared to other nations. From a global sourcing strategy perspective of a retailer, they look upon India as a country from where they want to source more. And as a result, we went ahead and did the acquisition of a company which is into knits, into baby wear, doing circa $40 million, very blue chip set of customer base like an Unsting family, TJ Maxx or a Primark. So to that extent, this investment in a facility in India gives me strong credentials to showcase my strength to global retailers that I know what it takes to manufacture in India. So I think, therefore, this acquisition should be seen in the context that when we are doing our own manufacturing of about 90 million in Bangladesh, I'm actually exporting circa 800 million plus out of Bangladesh. If I have a manufacturing of $15 million of a facility in Sri Lanka that I own, I facilitate $95 million of exports from my partner factories. So therefore, if this is about 40 million acquisition top line in India, I think it should unfold into slowly PDS getting into a position of at least $500 million of exports coming out of India from the partner factories. So that's the strategic rationale of the acquisition we have done with good customer base.
Right. Mr. Jain, so how should we look at the business? Can we expect your top line to double in the next 3 years? Is that very, very reasonable to expect, and will you be able to maintain the margins that you do?
Harsh, we've said about close to 18 months back that we are aspiring towards 555, which is like in 5 years. And I think 18 months have passed in the journey. We should be 5 billion GMV, which means about 3.5 billion top line. And we are at about 1.8 billion top line. So we're on that track, to get to that 3.5 billion top line. And we've grown 20% in the first 9 months of last year. Our order books are good, as I just mentioned. So we feel very positive that we are progressing well en route to get to what we aspired for 555. So I think we feel confident. I think profitable execution would be key. But in terms of our business model, the way we are organized, I think the order inflow has been steady and it has been positive.
And debt levels will get maintained, Mr. Jain? Sorry, very, very quickly because we are running short of time.
Yeah, we've been having net debt to EBITDA on a comfortable level. I think our aspiration would be to maintain at that level. Yeah.
Fair point. Thank you so much, Mr. Jain, for coming and speaking with us. Super helpful in understanding PDS Limited. Very interesting company operating, of course, from India, but playing the Europe and US consumption theme.
Absolutely.
So on a day like this, great to get those views. But with that, completely out of time on this edition of the show. From Mahima, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side. He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is, actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Real estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
Hello and welcome to Markets at 12. This is Malika Mishra, and we have been waiting to get some clarity on how the President of the United States goes about imposing what he calls reciprocal tariffs. And now we finally have heard the word. 10% baseline tariffs on all countries has been announced, and India will be charged a total of 26% reciprocal tariffs from the United States of America. But in contrary to the President's earlier hint of charging exactly what other countries charge, the United States of America has taken the seemingly lenient route by imposing partial or discounted tariffs, meaning they will charge approximately half of what other countries charge them. But again, how did they calculate these tariffs? And what factors led to the final number on each country is yet to be understood properly. As of now, pharmaceuticals, semiconductors, copper, and lumber have been exempted from these tariffs. Basically, everything that America needs has been exempted as far as India's exports to the US is concerned. And a clear 25% tariffs have been declared on auto imports. Meanwhile, a reaction is currently coming in from the Minister of State of Finance, Pankaj Chaudhary, where he said that the government is currently assessing this impact. Let's hear him from him.
देखिए यूएस का काम है, उनका अमेरिका फर्स्ट है, ट्रम्प साहब का, तो मोदी जी के लिए इंडिया फर्स्ट है. अब उसकी हम लोग समीक्षा करेंगे, फिर क्या उसका असर पड़ेगा, कैसे उससे निपटना देखा जाएगा.
And as I mentioned before, these tariffs, these reciprocal tariffs that have been announced by the United States has been something that we have all been looking forward to. We've all been waiting for, and they were announced at the dead of the night at around 1:30. He came up with a list, a long list, tariffs imposed on 180 countries so far. And there are many arguments that are currently being discussed around all news channels and media, where some people are saying that yes, United States has seemingly said that they're going to take the lenient route and half the tariffs. Basically, they're going to charge half of what countries have been imposing on imports made by the United States to these countries respectively. But how did they come to that number? Because, in the chart that Donald Trump showed to the media, 52% was the final amount, and then he halved that to approximately 26%, and he said, we're going half with it, and we will charge India 26%. So what is the rationale behind the number? That's yet to be discussed. But to discuss the implications of these tariffs further on Indian engineering exports, I'm being joined by the chairman of the Engineering Export Promotion Council, Pankaj Chadha. Hi, sir. Thank you so much for giving us your time. I would first want to ask you, how do you think the Indian government can support businesses affected by the US tariffs? Because you argue that 26% tariffs is high enough to significantly impact Indian businesses, regardless of the fact that China faces an even higher tariff rate.
No, I agree that 26% is high, but we must look at it from the point of view of engineering exports. we already got hit by 25% for Chapter 72, 73, and 76. That was done under Section 232 on 12th of March. So if we have 26% now as a reciprocal, it's only an addition of 1%. Because if you see his clarification also, Section 232 is subsumed in this. So effectively, we've got charged 1% more. But let's look at it from a positive angle. Is the positive angle that I would look at is that not only have we been charged, but if we did a number crunching of the top 5 export items of Indian engineering, where India has a major stake from in value point to USA, and we looked at the numbers of our competitors who are also doing the same items, they are at similar numbers. So effectively speaking, in the top 5 items of engineering export, we look at the 5 competitors were China, there was Mexico, there was Canada, there was Japan, and there was Korea. And let's say the 6th one is EU. So if you look at the top 6, who are our competitors in our top 5 items, all of them are hovering around between 20 and 34. So effectively, and China is even more. So when you look at that point of view, we are in the same position. It's like we are all sailing in the same boat. The boat is not very even, but it's the same boat. So how does it? I think eventually, if they have to import, which they have to, because they have been importing these items from all over the world, not only India, then I can only assume one thing, that the American customer will end up paying anything between 20 and 26% to buy this item, and so be it. This is something that the government of America had to factor in, because I don't think you can set a steel plant up for similar items in 5 years, by which time the president of America would have changed, and maybe the policy would change.
So again, I completely agree with the point, and I see you where you say that it's definitely going to take a lot more time. There are logistical issues, there could be regulatory approvals that companies might require to set up their plants in America, and if that's the intention from where Donald Trump is coming, imposing high tariffs to sort of enrich domestic production, domestic manufacturing in America, it's going to take time to transpire. However, speaking of all of this from a solution point of view, which alternative markets do you believe hold the most potential for Indian engineering exports? Because as you rightly mentioned, the top 5 countries exporting steel and aluminum products, including India, will face similar or higher duties. And in your words, we're all sailing in the same boat, ultimately passing the cost to American customers. So which alternative markets do you find attractive from this given point of time for India? And to what extent do you see customers getting impacted by these tariff charges?
Now, as far as the percentage of export, like 20% of engineering export is to USA. The next down is 19% is to EU. And I think with the EU president just visiting India along with 27 commissioners in February, and there is a statement at the highest level that we need to have a free trade agreement within 2025. So logically, I would look at having a FTA with EU, and that could possibly make us sort of de-risk our exposure to America and have it to EU. We also have another region which is coming up a lot, which is 18% of engineering export, which is number 3 is WANA region. But I think WANA region now may not be that easy to capture because of the fact that I'm sure China is also looking at alternate markets, and that's where we will see an increased push of Chinese exports to the WANA region. So I would hedge my bets with EU, and hopefully if we have a FTA signed, then whatever business we hope or we presume will get lost in USA, because not because of the fact that our prices are out, but The business loss to USA I can see is that if an American customer has to pay 25% more, I'm not sure whether he's going to take the same volume, because it is a significant amount to pay extra. So in that respect, we would, in let's say in the short term, I would say in the next 1 year, we would lose about anything between $3 to $4 billion of exports to USA, which I'm sure we will make up in EU.
Right. So, actually, I was coming to that. What strategies then do you think Indian businesses can adopt to mitigate the impact of US tariffs? Because you mentioned that you predict a 4 to 5 billion drop in engineering exports to the US in the first year due to tariffs. And of course, there are so many SMEs as well involved in this business across sectors. What strategies can now Indian businesses adopt, and how should they exactly tread this path in the future?
See, 50% of engineering export comes out of the MSME sector. 60% of our membership base is the MSME sector. Even in the overall Indian export basket, I think around 45% sits with the MSME sector. So the MSME sector, which is the backbone of Indian industry, definitely plays a very important role in this thing. Now we have to de-risk. We have basically, I would say, I'd put it into three options. One is definitely we would have to sign an FTA with EU and like-minded partners, so we increase our export share to those. Two, I'm sure we are in active negotiation with USA for a BTA, bilateral trade deal. So let's see how that pans out. I mean, the fact is that maybe with a BTA, our duty of 26-27% may drop. But that is something we can look at it with optimism, but not the fact that that can happen or will happen. So we'll look that as a point of view that, okay, maybe that can happen. And the third point is that we will have to also look at some sort of a strategy where we will have to do some trade deals with some more countries. And that's the only way out, because we will have to sort of place our eggs in far bigger baskets than only USA, which at the moment.
Right. So, Pankaj, are you still with me?
Yeah, I'm still with you.
Okay, thank you so much. So, right, very well said that we will have to place, or we might have to place our eggs in multiple baskets, given the kind of friction that we're seeing coming in from the United States of America with regards to these tariffs. But, and you did say that EU could be a sort of an alternative right now. But which
the fastest
sectors?
Alternative.
Okay.
The
So let's say that fastest alternative. Also, geographically speaking, that makes sense. But which sectors do you see getting impacted the most, and where all could we see that diversification happen? And how can Indian businesses, especially that come from the SME space, handle the competition that could trigger out of these tariffs in the global market as well? Because right now, I'm asking from the context of when this is happening with America, and America has gone ahead and imposed these tariffs on multiple countries, all countries across the world, definitely there will be a diversification scene, there'll be a change in supply chain scene. It might not happen immediately, but even if that happens later or through the course of the next couple of years, we're going to see some change happen and global competition intensify. Therefore, from that point of view, how do you see competition being handled by Indian businesses?
I agree with the fact that, like we are in this boat, most of the countries are in the same boat. So everybody is looking at diversifying their trade basket. And which means that wherever we were, let's say, slightly more well-placed, we'll see a lot more competition. That's there today. And that's there to stay. I mean, there's nothing that we can do about that, because everybody thinks the same way. Everybody wants to de-risk from the USA. Now, from a competitive point of view, we will have to, I think, pull up our socks. I mean, I can't say that we can be as complacent as what we were. And from the government of India, we can only hope that if there is some sort of support that they can give for the MSME. I mean, one support that I would definitely look at is the MSME is always short of capital. His rate of interest that he pays is far higher than the others pay and far higher than his global competitors pay. So now we are going to be running with the other global competitors in hunting for alternative markets. So we have to be put on a even keel or a level playing field. And in that respect, I would request at least the government to reintroduce the interest subvention scheme, which was there till 31st of December, and which was so far discontinued, but is maybe coming back in a new form. So I think they should expedite that. So at least the MSME sector has the borrowing or the interest costs of similar to his foreign competitors in the other parts of the world. The second is also, we are also asking the government that since we will now have to tread into, I would say, not so known markets, they must introduce back the MAI scheme for the MSME sector, wherein the MSME can go to alternative new markets, unexplored markets, so that they can sell in those regions. Previously you sold to the USA, everything was okay. You didn't venture out to, let's say, Latin America, Central America, and other places. Now we'll have to do that. There is no other option. So for that, for the MSME sector, we would need some hand-holding support for exhibitions, for buyer-seller meets, etc., so that we showcase brand India in these markets where we have not been that active as before, because we had the US market, so we were not that active. That would be point number 2. And point number 3, we will have to also look at some sort of I would say, activization of all our global missions, which are in a little far off places, so that they can then help us look at the MSME and help us find newer markets. So I would look at it from these 3 factors: the interest, the MAI scheme, and also some activation from the missions abroad in not so known places, so that we can sell alternatively what we would possibly lose the market share in USA. I would particularly look at Latin America. I would particularly look at Central America. And I would also look at maybe some part of the North Africa region, because that's some place where we have not been that strong. In that, I would only urge that maybe we may have to now give a credit, because it's something, when you have to enter a new market, why would somebody want to buy from you unless you have something more to offer to him? One of that would be credit. So maybe ECGC will have to step in and help handhold our MSME units and give them credit insurance coverage, so that they can at least go into the, let's say, more risky markets to sell our products.
Right, Pankajji, so you have actually consumed the 2 questions that I had planned for you. I thought of asking you, how do you see government intervening, and what kind of trade interventions would you want or expect from the government in order to support MSMEs and SMEs and Indian businesses in general to compete with global markets? And you've mentioned that and explained that quite clearly. I would also want to ask you from a place of just curiosity. The first leg of FTA the first leg of the bilateral trade agreement and negotiations that's happening between America and India currently is we're expecting some kind of clarity to come in by November. But are there any voices that you're hearing in the industry itself with regards to engineering exports, and do you see any reliefs coming in on that front?
The point is, we already got hit by 25% Section 232 on 12th of March. That already came in, right? That came in before this reciprocal tariff. So all I can say is we have been treated as all the others are being treated. So I am not hopeful that we can get a far better deal, but we always hope that our negotiating team can get us some better deal. How much better it is? Well, let's see. Time will tell.
Okay.
But the time has come for us to de-risk our export basket from the US.
Right.
Because it's something that we need to now, it's a wake-up call for us. Sometimes when you are in a very comfortable position, you try and live within your comfort zone. I think we'll have to go outside our comfort zone, especially the MSME sector, to try and find alternate markets.
Right, Pankajji. Thank you so much for having this conversation with me and giving us some clear takeaways as to how Indian businesses are posed currently. And I think my biggest takeaway from this conversation is the fact that you suggest that Indian businesses should diversify and look at other markets to export and expand globally. Thank you so much, Chaddaji, for joining this conversation and giving us your time.
Thank you for having me.
Thank you.
I mean, it was great talking to you. Thank you.
Same here, same here. Well, viewers, amidst the ongoing tariff saga, we caught up with Marco at BCA Research and market expert Ajay Bagga to understand the implication of this turmoil on global economics. Listen in to their comments.
Not only is the algorithm to calculate this tariff sixth grade mathematics, it appears that for each and every country, effectively what they did is they took the nation's trade deficit with the US and simply divided it with the exports to the US. Like literally, this is where they get, India's tariff on the US, and then they half that. So is it a negotiating strategy? I mean, yes, it is. However, the issue is that if you ask for a price that's so high, sometimes the customer just walks away. And so I think that because this is worse than the worst case scenario, and because the math used to generate these tariffs is basically, nonsense, I think that many countries may just walk away and say, we don't know how to talk to you. And that's the risk.
And now we're shifting focus to a significant deal. Star Televenture, which operates in the telecommunications space, has acquired a majority stake in Ticona Infinite through a share swap deal. Now, through this acquisition, Star Televenture expects to enter the broadband sector, expand its service offerings to include high-speed broadband, fiber optic connectivity, and advanced 4G and 5G solutions too. I'm being joined by Rahul Sahdev, MD and CEO at Star Televenture, and also my colleague Varsha, to help us understand the rationale behind this particular deal better. I'd like to start with the first question and set the stage for you, Mr. Sahdev. What made you choose Ticona Infinite, and can you walk us through the key details of this swap deal, like the share exchange ratio and other important metrics?
Yeah, good morning, everyone. We, Star Televenture Limited, we are an IP infrastructure provider. We have been primarily into the IP infrastructure, whereby we set up passive towers and lease it back to the operators. So Ticona, we saw a lot of synergies between Ticona, because they're also an infrastructure provider into retail and enterprise space. And we see a lot of synchronization between the two, and we want to leverage the same. They already have an existing setup of 7,800 small cell sites in top 25 cities of India, which gives us a quick access to the sites, and we can offer them to operators as a second or third tenancies. So we see we saw a lot of synchronization, and by virtue of this takeover, we would be coming at a number 3 position in terms of our overall positioning in the market when it comes to enterprise and retail segment after Airtel and Tata.
Sahdev, this is Varsha. Welcome to the show. I believe that you have done 2 more acquisitions. Now let's just talk about the financials. So with Ticona and the other 2 acquisitions, one of them is FusionNet. Where do you see your top line to go when it comes to FY26?
See, with the acquisition of FusionNet, they were also into enterprise space, and but into retail
segment. Ticona is into enterprise space, into the overall business segment. So we saw a lot of synchronization from the perspective that we can provide end-to-end infrastructure services to our clients and increase our overall base. When it comes to the financials, top line, what we are aiming for is we are aiming for 700 CR in the next financial year as a top line. And then eventually we'll see how we are moving, and as we multiply and grow further, then we'll take it forward.
Got it. And also just wanted to have an update on margins. Where do you see your EBITDA margins go? Because 700 cross top line in FY26 with EBITDA margin of?
We're looking at an EBITDA margin of, let's say, about 25 to 30% overall, because the business is such that, it involves the capex initially. Then after that, it is, an ongoing business, and on a regular basis, the revenues keeps coming in with a fixed operations cost. So that is what we are aiming at.
Okay, 25 to 30% of EBITDA margin. Also, one of your clients, Vodafone, so there was this recent news wherein the debt has been converted to equity, and the investors' view is that now the capital expenditure plan for Vodafone will increase. Now, have there been any talks regarding, addition of towers?
Yeah, Vodafone is very aggressive now. You must have seen their ads coming in all different channels, that they are adding towers every hour, which means they are increasing their network capacity, which is a good sign for us, because that is what we do. We help basically the operators to increase their network capacity in a faster way, because the acquisition of sites, as in towers, is in itself is a big thing. It's not a small thing. It is a challenge. So basically, that is what we do, and we basically help them to increase their network faster by providing them a portfolio of towers with us, and we are increasing them continuously on a regular basis. So we see a big opportunity there with Vodafone.
Right. So Rahul Sahdev, thank you so much for joining us, sir. And I'm afraid that we have lost out of time. And thank you so much, Varsha, for joining us in this conversation. We wish you all the best with this acquisition. And viewers, that's all the time we had on the show. But do stay tuned to NDTV Profit. A lot more is lined up for you right on the other side.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is, actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter.
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Real estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV.
Chronic trade deficits are no longer merely an economic problem. They're a national emergency that threatens our security and our very way of life. It's a very great threat to our country. And for these reasons, the United States will implement reciprocal tariffs on other nations. India, very, very tough, very, very tough. The Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. In other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charged anybody anything, but now we're going to charge.
Hello and welcome to the special edition on Trump's tariff wars on NDTV Profit. I'm Hiral Dadia, and with me is Anushi Vakharia. An interesting day for the markets, not only in India, but across, is what you are watching out for. Overall, the day of tariffs is finally here. After months of speculation and volatility, US President Donald Trump announced sweeping tariffs on countries across the world. Tariff on India has been set at 27%, although no one is quite sure what the calculation and rationale behind the tariff numbers are. However, the good news is that there just might be a silver lining in all of this. India at 27% is in a much better position with respect to the rest of the Asia. And this is good because it just might mean that our exports, especially in textiles, toys, and other sectors, could turn out to be cheaper than our Asian peers. Let's quickly take a look at this table on your screen. China and Taiwan have been slapped with more than 30%. South Korea is facing only slightly lower tariffs than us. But look at Cambodia, almost 50% tariffs. Vietnam, another big competitor to India in the textile space, has been hit with almost 50% tariffs. Myanmar and Thailand too face tariffs that are way higher than that of India. Malaysia, if you see, is almost on par with us, slightly lower than us, in fact, but Indonesia is in the 30% bracket. Only Philippines and Singapore have significantly lower tariffs than India, but from exports from these countries are quite significant as far as India is concerned, Anushi.
Right, Hiral, but the biggest impact that we are seeing is in terms of the economy, right? And what could be this on the impact of economy is something that we should start assessing in real terms. My colleague Pallavi, who has been speaking to several economists, has quantified the impact on GDP and export losses. Pallavi, over to you.
Right now, US President Donald Trump announced 27% retaliatory tariffs on Indian imports pretty much across the board, with some exceptions such as industries such as pharma. Now, the impact of these tariffs, according to very preliminary estimates by economists we've spoken to so far, is expected to be anywhere close to about 30 to 35 billion USD for India. Now, in terms of GDP growth, this would translate into a direct impact of almost about 0.8% of GDP growth. Now, India's exports to the US could drop by about $30 to $35 billion. And this is not adjusting for cross-country hits. Let's remember that the US is India's largest destination for exports. It single-handedly accounts for almost about 18% of India's merchandise exports. That's for the latest, that's according to the latest data we have available for FY25. Now, also beyond the direct India impact, there are worries of what these retaliatory tariffs could mean for global trade. We do expect some economies to retaliate. That would mean some slowdown in global growth as well, in global trade as well, and the overall impact as such could be even higher. Now, what we also need to remember is that India is already in the midst of trade negotiations with the US. So one sort of option going forward could mean that the impact could actually be negated once India and the US manage to reach some agreement or some consensus on these trade negotiations, which would mean that the impact could be lower eventually.
Thanks, Pallavi. Two interesting numbers that I'm picking up from you is $30 to $35 billion in terms of the impact on export losses, and 0.8 to 0.9%, that's 0.8% to 0.9% in terms of the GDP impact is what we should be watching out for. But moving on, how will the Indian government now respond to this kind of an impact that these tariffs will be an important factor to watch out for? In fact, Union Minister of State for Finance, Pankaj Chaudhary, has now responded to these tariffs announcements. Let's listen into that conversation.
देखिए, यूएस का काम है, उनका अमेरिका फर्स्ट है, ट्रम्प साहब का, तो मोदी जी के लिए इंडिया फर्स्ट है. अब उसकी हम लोग समीक्षा करेंगे, फिर क्या उसका असर पड़ेगा, कैसे उससे निपटना देखा जाएगा.
We have been speaking to a host of experts since morning about the impact and what this may mean for global economy. What has left many puzzled is the methodology President Trump has implemented to come at these tariff rates. Let's listen into BCA Research Marco Papik and market expert Ajay Bagga to understand their view on these tariffs.
Not only is the algorithm to calculate this tariff sixth grade mathematics, it appears that for each and every country, effectively what they did is they took the nation's trade deficit with the US and simply divided it with the exports to the US. Like literally, this is where they get, India's tariff on the US, and then they half that. So is it a negotiating strategy? I mean, yes, it is. However, the issue is that if you ask for a price that's so high, sometimes the customer just walks away. And so I think that because this is worse than the worst case scenario, and because the math used to generate these tariffs is basically nonsense, I think that many countries may just walk away and say, we don't know how to talk to you. And that's the risk.
Worse than worst case scenario. So it's rather than America first, it's America alone. And they are very irrational numbers that have been put out, 52% for India. The footnote says currency manipulation, trade deficit. They have put out a formula also just now, which makes hardly any sense, very subjective. So I would say worse than the worst case scenario. And on top of that, the hedge fund manager who now masquerades as their treasury secretary is warning sovereign nations that don't retaliate. I don't want any retaliation. I think all nations should take a sovereign view on this. And this is, I think worse than worst case scenario.
An interesting one coming in here. Rather than America first, it is America alone. But let's also go across to Mihika and Mahima to understand how the tariffs will impact overall sectors and the kind of exposure India has in terms of US. Mihika, over to you first.
Let's take a recap. Trump has imposed 27% of tariffs on Indian imports, and he says that India charges 52% on US imports, and Trump has stated that these are discounted reciprocal tariffs that are imposed on a country-wise level. Now, the expected loss for India in terms of its exports to the US, well, at a 25% tariff rate, MK estimates a loss of $31 billion. And then let's look at the top exports to the US, which stand at risk in terms of sectors. Electronics at the top of the list, 14.3% share in our total exports to the US. This is followed by gems and jewelry, exported a total of $9.9 billion in FY24. You also have nuclear reactors, parts and machinery, as well as refined petroleum products. But there are certain exceptions in this sector. You also have articles of iron and steel, textile articles, auto and auto components, non-knitted apparel, organic chemicals, knitted apparel, seafood and plastics, and these are your top sectors in terms of what we are exporting. And lastly, key exemptions. One is copper, second is pharmaceuticals, semiconductors and lumber articles. But Mahima, why don't you come and tell us what kind of stocks could be impacted?
Right, so I'll start with the textile space. The entire textile space is buzzing positively today because the tariffs that have been imposed on other countries as compared to India, other Asian countries, are higher. That is why they're reacting positively. But some counters that will see the impact include something like a Welspun Living, which has 63% exposure, Alok Industries around 45% exposure, Trident around 38% exposure. Some other names which could also possibly see some impact include Indocount as well as Arvind Limited. In terms of the chemical space, there are some more names which might see impact in the textile space, that is Vardhaman Textile, Page Industries and Raymond Limited as well. Moving on to the chemical space, two counters with high exposures, UPL as well as SRF, around 25% for UPL and 20% for SRF, followed by Jubilant Ingrevia around 9%. These could probably see some impact of these tariffs. Some other counters in the chemical space that could see impact include Aarti Industries, PI Industries, Atul Limited, Navin Fluorine, as well as some counters like Gujarat Fluorochem as well. Now, in the seafood space, however, companies have high exposure when it comes to US exports. Something like Apex Frozen Food has 63% of the revenues coming in from US, so that might see some impact. Waterbase with 40% of revenue coming in from US, followed by Avanti Feeds at 14%. In terms of the overall consumer space, rice exporters will see the impact. LT Foods, KRBL and something like a Tata Consumer could also see an impact. In terms of some other counters that will see impact in the engineering goods space include Kirloskar Brothers, L&T, Thermax, Cummins India. For solar makers, Vari Energies as well as Premier Energies might see some impact. In terms of power equipment makers, stocks like Trill, Silchar Technologies, BHEL, GE&TD, ABB India, Voltamp might see some impact of this tariffs being implemented. And lastly, in the consumer space, something like Britannia or Mrs. Bector's, which exports biscuits, something like Nestle India, Haldiram's, which exports a lot of snacks to the US, might see impact. And lastly, some names to highlight, Vadilal could also see some impact because a lot of exports of ice cream for Vadilal takes place to the US. So all of these counters will eventually see an impact of the tariffs being implemented.
Well, thank you, Mahima. Thank you, Mihika, for that interesting breakdown that we are seeing in terms of the sectors which are in focus. A lot of these sectors already buzzing in trade today. But let's talk about the auto sector, which is arguably getting impacted the most as Trump announced a major shift in its US auto policy, charging 25% tariffs on all foreign automobiles. Let's bring in Puneet to tell us more about the potential ramifications of this move on the Indian auto space.
So we're definitely looking at the data for all these companies, as you rightly mentioned, but just a couple of questions at the end, which investors will be left by after today's session opens. So first, of course, 25% blanket tariffs on foreign autos. That does not impact the Indian automakers, but Tata Motors get impacted because of the JLR imposed from UK and Europe that they do. So definitely a potential impact expected there. US is also putting a 10% tariff on UK, so that again is an impact on Tata Motors. When you look at the numbers in terms of revenue share, they had roughly 23% of revenue for Tata Motors from FY24 just from the USA. While this is only an annual disclosure, the number would have increased because of the volume increase as well in this year. Sona BLW is another one. They already have a factory in the US, which is a sizable one, but definitely a very high share of revenue from the US as well. Bharat Forge, as well as is on a consolidated basis 25 to 28%, but on a standalone basis it's upward of 35% of revenues for Bharat Forge from the US. Samvardhana Motherson, again, it's an annual disclosure, so 18 to 20% revenue from one big country is something that's an impact there. The other ones, Ramkrishna Forging is the other one, which has a big sizable impact along with Balakrishna Tires, because both of these have no plants in the USA, so it's all exports from India that they do, and definitely an impact expected there as well. Let's just deep dive slightly a little bit into the companies, because Tata Motors, as we spoke about, 70% of revenues coming in from JLR itself, and that's 78% of the EBITDA. So even any kind of impact on this will be hurting the margins going forward. When you look at the volume picture as well as the revenue picture specifically for USA, we've seen volumes are roughly about 33% from the USA in FY25, the 9 months, and in terms of revenue, it's roughly about 23%, while volumes are 26% for FY24. And Kotak had a very interesting note on this today. They mentioned that volumes in USA can decline by 25 to 35% because of this, and they roughly export 1 lakh cars from the USA. That's 25% of their, so definitely an impact there, and it could lead to EPS cuts of 15 to 20%. Investec is also not estimating over the next 2 years any kind of EBIT growth. So another key negative there. When you look at Eicher Motors, and this is a name that's not talked about in terms of exports. Eicher Motors, Jefferies has a note that they had export sales of 1 lakh units in FY25, and roughly about 35% is to North America. While smaller on an overall share, we might see some impact on Eicher Motors as well. The other ones, Sona BLW, and we've spoken about that as well in today's discussions about the company. They have a plant operational in Mexico as well, while another one is in US for 10 lakh units, so Starter Motors. So while they have a 40% share from the USA, how much is locally manufactured is a key question, and hence, while we might see a negative reaction today, the stock's already down 21%, so watch out for that one. The Kotak has mentioned specifically that there could be an impact of 400 to 500 basis point on the profitability for Sona BLW in the short term. Definitely starting wise will be negative, but very interesting play going forward. Samvardhana is the other one I want to just mention briefly. There could be an indirect impact because of the imports from Europe specifically. So they are a big supplier to BMW, big supplier to Mercedes, and while 18% of revenue is coming from the USA, how much is that from the US internally and how much is from the factories in Europe? So it's going to be, the stock price has corrected almost 20% in the last 3 months, and there is the variability of how much impact would we see on that aspect. Bharat Forge and Ramkrishna Forging, we mentioned 35% of revenues coming in from there. Kotak is specifically mentioning that tariffs can have a severe impact on margins for the forging companies, and this is the second key negative after the US EPA is deferring the pre-buy essentially in FY26. And just finally on 3 to 4 other companies, Balakrishna, Timken, as well as Seat, they have roughly 10 to 18% coming in specifically. That's what Kotak is mentioning. So essentially the two questions for investors for Sona BLW, as I mentioned, they have a plant in Mexico, but they also have a plant in the USA, and players like Samvardhana Motherson with their global outlay it's something to watch out for. And finally, on the China factor, higher tariffs compared to India, could that be an opportunity? That's something to watch out for.
Right, so that's with regards to the auto pack. But one exception that is seeing a strong up move today is the pharma pack, because the sector has been exempted from Trump's reciprocal tariffs. Now, which are the companies that are set to benefit from this? Let's bring in Varsha to tell us the same.
Thank you for that. So, a few days ago, everyone was of view that pharma will be the segment wherein you will see the tariffs coming in because, Trump had said that this time this has to be a pharma. But now there are no tariffs. Trump has levied no tariffs on Indian pharma companies. That's why all the pharma companies, if you see the likes of Aurobindo Pharma, Gland Pharma and, Dr. Reddy's, Zydus Life Sciences have actually, we have seen the stock prices going up. Now, just on the data points, if you see, India charges 10% tariffs on US pharma imports, while US does not charge any tariffs to Indian pharma imports. And just talking about the companies, Indian pharmaceutical companies who has highest exposure to US, if you see, starting with Gland Pharma, Aurobindo Pharma and Dr. Reddy's have the highest exposure to US market, ranging from 45 to 50%. While if I were to talk about Torrent Pharmaceuticals, has the least exposure of 9%, and that's the reason we have not seen that uptick when it comes to Torrent Pharmaceuticals. If I were to talk about the pharma sector performance, over from January to April, in the year to date, if you see, the pharma sector was down almost 11%, but in the last 1 month we have seen rally, which was up 5.5%. Let's see the ahead of this announcement of this Trump tariff, how these shares, how these stocks have performed when it comes to year to date performance. So if you see, Aurobindo Pharma was down 14% because of this tariff announcement by Trump, while Zydus Life Sciences was down 8.4%. And lastly, if you see, the Torrent Pharma was down only 6.3% in year to date because of the lower exposure when it comes to US market. But let's see what are brokerages saying on this, what are their views. So Kotak says that the tariff saga is actually exempt for now, yet too early to rejoice. The tariff might come back, and the key question according to Kotak is that now for how long the pharma will be exempted. That's the key question that we need to ask. And they are also expecting uncertainty to prevail, not just till the formal announcement, but post that as well. Even Jefferies has the same view, wherein they said that they are saying that the sweeping reciprocal tariff exempted the pharma industries just for now, but pharma specific tariff order on a later date can't be fully ruled out. And lastly, if you see, they see minimal impact of to Indian pharma companies, and the rally in the US focused generic pharma stocks is likely to play out as per Jefferies.
Well, thanks for all those details, Varsha. But IT is also the next sector that we are assessing the impact on. Let's get Puneet to tell us what are the brokerages making of the IT space.
Well, the Trump tariffs have had an effect, or at least so, in some of the key sectors which have been seen impacted by the tariffs. But one sector that has not seen a direct impact of tariff is the IT sector, but the index is down in the dumps today. We've seen stocks such as Persistent Systems down almost 9%, while someone like KPIT Tech is also down 5%. And the view is that because of the tariffs coming in, the discretionary spending in the US will go down effectively, and that will lead to slow decision making for its clients, effectively, affecting the IT companies and their orders going forward from the US. Now, we've had some brokerage notes come in this morning on the IT space. We've seen Bernstein downgrading, the IT sector in their model portfolio, but Jefferies also had a view. They mentioned that, slowing GDP going forward because of the tariff impact may lead to some earnings impact for the IT space as a whole. They've also said that, the manufacturing, logistics, as well as retail verticals of the IT companies may be the most impacted because of the tariff ecosystem. They've gone on to say that while HCL Tech and Tech Mahindra among the large caps have favorable vertical exposure, having limited space in this particular exposure sectors that we spoke about. Amongst the mid caps, they mentioned IKS as well as Agility to something watch out for on the upside going forward. They've also said that the US real GDP growth expectation matter more going forward versus rate cut expectations for the IT space as a whole, and that's because they mapped the last 20 years effectively, and they've said the revenue growth for the IT companies are more correlated with the GDP growth rather than rate cuts as a whole. They finally mentioned that they see potential onshoring opportunities, essentially increasing employment in the country, in the USA itself, as one of the key opportunities to watch out for. But currently, it is a sector that's affected because of that. Bernstein has downgraded IT. They mentioned that the US is a recession risk is now looming more than ever, and they mentioned that in the wake of these measures, of course, and they've gone on to say that they are expecting a big loss to eventually come in and hit all these IT companies specifically and their discretionary spending as a whole. Finally, they mentioned that the medium-term consequences for the economy will also be something to watch out for if the tariff war heats up between the countries. But overall, while it's a negative start on an indirect impact for the IT companies, going forward, there is going to be a lot of volatility to see. But the commentary in Q4 will be something to watch out for.
Absolutely. It's going to be an interesting space to watch out for in terms of IT. But let's now understand, thank you, Puneet, for that. But let's also understand what brokerages are making out of this in terms of a macro impact. Let's start with the Bernstein. Overall, what they've said is that US has not really been nicer, and the tariff rates are significantly higher. However, they might not sustain in the second half of this financial year. Apart from that, they're expecting inflation to increase in the US markets, the demand to be depressed, and there could be a chance of US getting into a recession. They're saying that this is likely a starting point of several months of back-channel negotiations that could happen with different countries. Moving on, you have a JP Morgan who is saying that from the 5th of April, they will see the 10% tariff that will come into effect, but the major impact will come in from the 9th itself. The tariff hike could actually lead to a tax increase of almost $660 billion, or 2.2% of the GDP in the US. And the impact on inflation also will be substantial. And this will lead to substantial macroeconomic shock. And if the tariff hike sustains, it will likely push the US and global economy into recession. So 2 notes talking about recession. Citi has said that the country-specific tariff rates are higher again than expectations. And outstanding question is, what gets rolled back and how soon does this take place? Because the level of tariffs that have been announced would reset the global world order of trade, and they're expecting earnings to be cut in terms of 2025. The estimates is what we're talking about in the next few weeks, so that will be a downtick as well. Nuvama is saying that with all of these sweeping tariffs, Trump has actually gone ahead and escalated the global trade war. There will be growth concerns from here on that will dominate the inflation concerns. Fed's policy choices are going to get complicated as well. And the market valuations are not pricing in the earnings risk. The key questions are, what Nuvama is asking is, how other countries would respond to this tariff war, or will they negotiate or retaliate? How will the Fed respond? And thirdly, with regards to the financial stability risks, what will they look like? Because there could be high yield bond spreads and the emerging market forex rather than the dollar index. So these are a few questions that Nuvama has been asking as well. That's the macro picture. Anushi, how are you looking at it in terms of the India impact?
Right. So now that we are looking at the bigger picture remains on what are the implications on India that we are looking at. Firstly, let's get in the brokerage views on what Bernstein has to say. It's a mixed view that we are looking at in terms of what the Bernstein is saying, that they believe India will largely navigate through these tariff concerns which are there, and India more likely to engage in negotiations rather than escalating trade war is something that we should be watching out for. While immediately we can see some kind of pressure in terms of where the Indian markets are concerned, it's the second half where they're more optimistic on recovery being on cards. That is something that we should be seeing. Now, what Nuvama has to say, they have a more bearish approach as compared to what Nuvama is, compared to what Bernstein is saying. Now, they will see that direct and indirect impacts on sectors are likely on sectors like machinery, electronics, textile garments as such is huge. Direct impact, while that seems limited, the indirect impact is something that is substantial for a country like India. That is what we are seeing. This indirect impact could lead to a global slowdown. As Hiral pointed out, there are higher chances of recession now on the card. So because of this weaker global demand overall, there is huge risk of EPS, earnings cut risk that remain large for the company. Lastly, coming to what Prabhudas Lidadhar had to say, India is one of the least tariff Asian exporter. That is what we are looking at, given the size of tariffs that other Asian countries have been imposed on, India is on a relatively better position is something that we are seeing. So it is likely to position itself as a China +1 hub for US-bound protection, which is there, and gains a relative edge as the lowest tariff major Asian exporter that is there. Within Asia now, India holds the most favorable tariff position, which is a clear strategic upgrade that we are looking at. So this is overall the views in terms of where the Indian implications are concerned. But a lot of sectors are buzzing today, and a lot of them have been upgraded or downgraded. We have Varsha joining us to give us a breakdown on the sectors which are in focus as well.
Right. Thank you, Anushi, for that. So clearly, if I were to talk about Bernstein, let's start with that. What are they saying is they have upgraded healthcare due to the limited impact, but they've downgraded IT to equal weight given the US recession risk that they are seeing. That's what Bernstein has to say. But speaking about Nuvama, let's see what Nuvama has to say. They are overweight when it comes to private banks, insurance, consumer and telecom, but they're underweight when it comes to, industrials, and then you have metals, PSUs, and they've recently downgraded IT to underweight due to high valuations that the sector has seen. While let's see what Prabhudas Leeladhar has to say about this. So they are actually, they've given out a list of sectors, about their views. So starting with textile and apparel. So tariff edge actually create an opening for India in US market, according to Prabhudas Leeladhar. And Indian exporters have this competitive advantage over Bangladesh, Vietnam and Thailand as per PL. Now, speaking about the footwear segment, let's see what they're saying. Tariff shock is actually an opening space when it comes to India, according to Prabhudas Leeladhar. And also the firms like Nike will actually may look to shift sourcing to India, what the brokerage is expecting. While in light manufacturing, let's see what are they expecting. So tariffs on rivals will open door for India when it comes to toys, textiles and leather. And also India could emerge as a preferred alternative across several light manufacturing segments that the brokerage is betting on. While on automobiles and auto parts, if you see, they see limited direct impact on automobiles and auto parts, while it actually levels the playing field, could preserve India's competitiveness in some segments, according to brokerage. On electronics, let's see what they're saying. So on electronics, they are basically, so the iPhone-led surged 26% tariff is a hit, but India still is favored over China, according to brokerage firm. And on machinery exports, basically, so this is under pressure, and Indian exporters now face a steep cost disadvantage versus domestic supplier, as per Prabhudas Leeladhar. On chemicals, they have actually mixed outlook as tariff hits, but India may gain versus China in key niches. And lastly, on gems and jewelry, they are seeing high risk sector as 26% tariff threatens India's $10 billion industry.
Right. So that's with regards to what brokerages are making out of an impact in terms of sectors. But overall, if you see, apart from that, clearly we did speak to two guests, that is Rahul Arora as well as Vijay Kedia, to understand the impact from here on. Let's quickly hear into that conversation as well.
So if you're going to go into a situation by FY26, you have banks, IT and FMCG broadly going to give you 8 to 11, 12% kind of earnings growth. Even Reliance add to that probably a 10, 12% earnings growth. You tell me how the index is going to move if you value companies on FY20. It is not possible. Now, that is why you are seeing that the entire sell side and buy side has moved to FY27 at the start of FY26, because you're not going to be able to, justify companies on FY26 valuations. Now, look at the auto sales numbers that have come in. PVs are struggling. Yes, luxury two-wheelers like Eicher and Bajaj Auto and the likes have done well. Exports have done well, but domestic is struggling. So what are you left with, right? And I think if you look at the last 2 years, the road awardments that the NHAI has done has been very poor. In fact, the NHAI has not met its own target. So cement growth comes into question, whether you are actually going to get 7-8% kind of growth in cement. Now, the only question is, how far does the market want to look out, FY27, 28, and then start justifying valuations? According to me, since you bought up the small cap index yourself a few minutes back, I think most small caps in India are still at least 20 to 25% overvalued on a 3 and a 5 year mean. Most of them are still trading at 1.5 to 2 standard deviation above mean, or at least 1 standard deviation above mean. Now, does that mean the market will correct? I don't know. But is there a case for the Nifty to visit 20-21,000? I think there is a very strong case.
नहीं, मेरे को लगता है शायद उनको भी खुद पक्का पता नहीं है कि वो क्या करना चाह रहे हैं। वो तो कभी डंप करते हैं, कभी पंप करते हैं, तो उनका कभी जंप करते हैं, तो उनका अपना अलग ही एक उनका हिसाब किताब चल रहा है। लेकिन ठीक है, अल्टीमेटली जो वो बोलते आए थे कि हाँ मैं इस तरह से इम्पोज करूंगा, उन्होंने जो भी है उन्होंने टैरिफ लगाया और इंडिया को थोड़ा सा बख्शा, उन्होंने थोड़ा सा कम टैरिफ लगाया है। इसके लिए आपको खुशी मनानी चाहिए, क्योंकि उसमें कोई विशेष फर्क नहीं पड़ा। आई होल्ड सम फार्मा कंपनीज आल्सो, आई विल कीप ऑन होल्डिंग टू इट। एंड तो मेरे को लगता है सर गवर्नमेंट इज आल्सो फोकसिंग ऑन इंफ्रास्ट्रक्चर, एज यू सेड द लार्ज सेक्टर। आई थिंक इंफ्रास्ट्रक्चर शुड डू वेल। पावर सेक्टर एक्चुअली इतना स्कोप है पावर के अंदर में, चाहे वो पावर फाइनेंस की कंपनियां हो जो पावर को फाइनेंस करती हो या लोन देती हो या जो भी हो, या ऐसी कंपनियां, उनके अंदर में भी बड़ा मेरे को स्कोप लगता है। पावर से रिलेटेड जो कंपनी है, ये सब हमारी डोमेस्टिक थ्योरी है, सब डोमेस्टिक हमारी ये सब स्टोरी है। इसके अंदर में कोई फर्क नहीं पड़ता है कि इसके अंदर में चाइना क्या कर रहा है या यूएस क्या कर रहा है। तो हमको थोड़ा सा सेफ होकर चलना है, एज यू राइटली पुट इट आउट। So maybe index wise, I'm not very bullish. I don't see that index is going to, we are going to see a new high in next 2 years. So I don't know about 3 years. So I am not in that camp. So I think index should consolidate here and individual stock should do according to their merit. And one more thing I would like to add here. As I had so many on so many platforms, I had said that nowadays after 2003, bull markets are longer and bear markets are shorter. I think this bull market made a top in September 2024. From that, just I don't have any money, pakka data मेरे पास में नहीं है, लेकिन I have seen after 2003 that this जो bear market आता है, it gets over in 9 months. So accordingly, एक खाली तुक्का के लिए मैं बता सकता हूँ कि I think so maybe by June this 2025 or maybe next 2-3 months time, this market will make its bottom. That obviously nobody knows. But more or less मेरे को ऐसे लगता है index will consolidate and individual stocks will have their own territory or will chart their own story.
Two interesting views coming in from market experts. With that, it's a wrap on this special edition of Trump tariff war from Anushi and myself. But lots more lined up on the other side. Please stay tuned to NDTV Profit.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Real estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
Hello and welcome to Profit Buzzers. This is Anushika Pakharia and with me is Hiral Dadia. Hiral, it's quite an interesting day today, right? Trump reciprocal tariffs in effect. We are seeing how the markets are reacting currently. India seeing about a 27% of a tariff rate that we are looking at. But let's see how the markets are doing currently. If terms of where the Nifty 15 is concerned, we are looking at cuts of around 0.3% last half an hour or so. It has remained in that similar ranges at what we are seeing. Let's pull out the point contribution to a table to understand which are some of the stocks and sectors which are in the downtrend today. Firstly, if you look at the red pack, we are looking at all the IT names in focus: Infosys, TCS, HCL Tech, Tech Mahindra, all down in red. And this is considering the kind of impact that there is on the global discretionary spending, which would in fact impact the IT firms going forward as well. Whereas if you look on the green, we have something like a Sun Pharma, Power Grid, NTPC doing relatively well. Sun Pharma seeing around 14 points of point contribution. This is after there were no announcements in the pharma space that we are looking at. Big upgrade that we are looking in terms of where the pharma sector is concerned. But continuing with what's happening with the sectoral indices, let's take a look at that also. Nifty Pharma being the top gainer here, as well as, however, Nifty IT, as mentioned, is one of the top losers. So that is what we are seeing in terms of where the broad benchmark indices are concerned. If you look at Nifty Bank, seeing gains of around 0.26%. But here, it's the broader markets. It's the day for the broader markets, right? What is it that we are looking over here?
Absolutely. A lot of stock-specific action is what you're watching out for. You have the mid-cap index, which is down almost 0.4%. And if you talk about the small-cap index as well, that's trading in the positive. So divergent trends coming in there. But let's introduce our guests as well. We have Avinash Goraksakar as well as Osha Krishnan who are joining in. To start off with, firstly, welcome to the show, gentlemen. The first thing that we are going to discuss today is a Dabur. Now, the stock is expecting the company is expecting a subdued fourth quarter in terms of earnings. Firstly, let me head across to Mahima to get us the details. Mahima, stock under pressure, over 6%. What is it that they've said that is making the street nervous, and what brokerages are making out of it?
Right. So, the stock is under pressure, and this is because Dabur's consolidated revenue is expected to be flattish during Q4 FY25. And this is something that, a lot of brokerages have also been penciling in. They've also said that the operating margins will contract by around 150 to 175 basis points year on year. And this is the main reason as to why the stock is seeing so much pressure in trade today. One silver lining was that they've said that rural continues to be resilient and grew ahead of urban markets in Q4. This has not been the commentary so far in the past 3 or 4 quarters. Modern trade and e-commerce as well as quick commerce has maintained growth momentum. General trade, however, continues to be under pressure, and FMCG volume trend continues to be subdued in Q4 is the commentary coming in. Now, India business, food business is expected to post double-digit growth. FMCG is likely to decline in mid-single-digit growth. In terms of international business, the MENA region, Egypt as well as Bangladesh are likely to post strong performance, robust double-digit growth in constant currency terms. So, international business is something where the growth right now for Dabur is coming from. In terms of what the brokerages are making out of this business update, well, Citi has maintained sell and cut the target price to 450 from 525 earlier. Q4 update points to another weaker quarter is what they're saying. India business performance weak across category. International, again, double-digit growth and profitability under pressure. They believe a strategic refresh post the ongoing McKinsey review could be a key change in the business as well as the stock outlook. Nomura is maintained buy with a target price of 625. On the other hand, they are positive. However, they're saying that the Q4 is much weaker than expected. India business to show decline, as well as the overall EBITDA is likely to decline by around 10% is what the brokerage is penciling in. Lastly, Morgan Stanley has maintained equal weight with a target price of 475. They're saying Q4 another weather where disrupted quarter is taking place. It's a big miss, and consolidated EBITDA margin to be down by around 150 to 175 basis point is a big disappointment according to them. So this is the overall view as to how Q4 looks like for something like a Dabur, and that is why the stock is under pressure.
Right. Avinash, firstly, thank you, Mahima, for that. Avinash, your view in terms of Dabur and what's the counter impact you're seeing in terms of other FMCG players?
Yeah, I think good afternoon, Hiral. My sense is I think, you could see a negative trend for most of the FMCG companies because this kind of outlook definitely is disappointing. I think not only the volume growth is going to be tepid, but I think margins contracting by almost 150 basis points is definitely something the markets have not liked. and that is the key reason the stock has been battered down today. My sense is once the numbers are out, for the March quarter, you could possibly get some indication from the management commentary as to how they are looking forward for the coming financial year. Although, consumption is a theme which a lot of market analysts are positive, but I think the most important question is whether rural demand is going to pick up. My sense is that maybe at least for the next couple of quarters, Dabur could be an underperformer unless and until we see very strong volume growth and margin improvement coming in, maybe in the June or the September quarter. So there's no hurry here in actually buying the stock as of now. This clearly indicates that the management is not confident and has clearly indicated that numbers are not going to be good. So I think it's better to leave the stock as it is. We could possibly look at other consumption bets, in this space. This definitely can be avoided at the moment.
Right, can be avoided. Osho, what are charts indicating with a Dabur, and if not a Dabur, any other calls from the FMCG pack?
Very good afternoon, Hiran. Firstly, thank you for having me at the show. Well, yes, technically there has been a very strong breakdown in this counter, approximately 8% in the week, and the counter is retesting the lows that we have seen in the month of June in 2022. So 460, 450 is a very strong support zone, or that can be seen as a very strong cushioning zone for this counter. If there will be any further correction beyond the zone of 450, then it can be a devastating picture on the technical front. On the technical parameters, there is some room for the counter to go on the downside. So I'm expecting that 450 should be a very crucial zone that we need to watch for. If it breaches down from those levels, then it will be a very cautious move that we can be seeing in Dabur as of now. And coming to the other FMCG space, then overall the FMCG space is on a verge of consolidation, but majority of the counters are looking kind of a revival mode. So I'm expecting that Godrej Consumers is one of the pick that can be seen as a decent pick from this counter, not in a very aggressive manner, but one can start accumulating in a staggered manner from medium to long-term perspective.
Okay, so that's the overall outlook that we are looking for the Nifty FMCG pack. But another stock which is in focus is Hariom Pipes. We're seeing some strong up moves in the stock today, and this is after it came out with its Q4 business update. If you look at the total sales volume, they were up around 23% for the fourth quarter. While if you look at the FY25 numbers, again, we are looking at a 23% of a growth here. Their value-added product sales also contribution has gone upwards to 97% this quarter as compared to 81% last year. So it's a strong growth that we are seeing in line with what the company's guidance was for a 20% of a volume growth for FY25. So Avinash, I want to come to you on this counter. If you track Hariom Pipes, what is your view on this stock?
No, I think definitely, I think it's been one of those players where volume growth has been pretty healthy. And I think, it's been consistently showing a very healthy volume growth. Apart from this, I think they've been expanding their capacity also quite aggressively. So my sense is, I think with a bright kind of business outlook, commented by the management, we could see stronger Q4 numbers, and I think a very strong FY26 also, because they are having a reasonably good order book. I think most of these pipe companies, Anushi, are sitting on a very healthy order book, considering that a lot of government as well as private projects have been planned. And I think this has been the trend because, on the raw material side also, steel prices have been moderately soft. So this actually will also aid their margin improvement. So I think definitely from a longer term perspective, despite the fact that it's not a very large player, within the small category of pipe manufacturers, it definitely continues to do well. And we believe, numbers for FY26 also should be a lot better.
Okay, and Osho, what is your view on Hariom Pipes? What is the technical check on that?
Technically, the counter has been into a corrective phase, so there is no respite. But in the last 6 to 7 weeks, the counter is kind of forming a pace for itself. There has been a strong consolidation from the zone of 330 to nearly 400 odd level. So I'm expecting that if it breaches the zone of 400 on a decisive manner or on a closing basis, then we can see some kind of revival in the counter for immediate upside target of nearly 455. But for now, the counter is into a very strong consolidation zone, and one should wait for a breakout from the consolidation phase to start accumulating this counter for a decent target of nearly 455 to 460 in the short term period.
Right, so that's with regards to where Hariom Pipes goes. But moving on, a couple of stocks that are in focus on order wins is a BEL, though they have missed their FY25 guidance. Apart from that, Kirloskar Engines is another one. 270 odd crore is the kind of order that counter has got, and the stock is also trading in the positive. And you have an Interarch Building. They've got an order worth around 300 odd crores. The timeline is around 12 months in terms of execution, and overall, clearly their order books stood at around 1,300 odd crores. 5.5% is the kind of up move. Osho, let me come to you first. 3 stocks, what are charts indicating? Any picks from here?
See, basically, firstly, I'll start with BEL. Then BEL is one of the preferred pick from the space. I would be having a very bullish approach in this counter. Firstly, there has been a very decent traction in the last few couple of weeks, and now the counter in the last 2 sessions, there has been some kind of profit booking, but overall the technical structure is still very favorable for the bulls. So I'm expecting that on the lower end, near about 275 is a very strong support zone for the counter, and on the higher end, nearly 300, 310 is the immediate resistance level. But the time it breaches the zone of 310, then we can see a decisive upsurge in the counter. So I'm expecting that this, comparatively to the other counters, is looking very positive on the technical front, and one should focus on this counter.
Okay, Kotak has released a note on Angel One initiating a buy call on this counter. If you are looking at what the note is, again, they have seen solid scale and execution record, multiple growth variables at play. Along with this, they're looking at a 20% of a EPS CAGR over FY27 to 28 period. Coming to you on this, Avinash, what is your view on Angel One?
No, I think clearly, from a longer term perspective, Angel One is one of those companies which has been very aggressive on the online business front. Our sense is that, more and more technology is now going to come in the broking side. And as far as the customer acquisition goes, there's a lot of headroom to grow in the next, say, 2 to 3 years. As a capital market intermediary, I think, unless one takes a 2 to 3 year view, one cannot make a decent risk reward here. So I think, at the current price, if one were to get in, one needs to give a slightly longer time frame, because I think obviously on the retail as well as on the institutional side, volumes are definitely not growing as what the market had expected. But better technology is something which is a plus point for Angel One. So I think, probably on declines, one could look at this counter, but only from a long term, kind of business time frame.
That's an Angel One. But moving on, we have a Citi which has come out with a report on GMR. That stock is also seeing an interesting move. What they are saying is that the company is set for the next leg of growth. They have initiated coverage with a buy for a target price of 80. And the midterm growth outlook is pretty strong as per Citi. They are expecting the valuations to see a premium from here on. The traffic is expected to see a growth of around 8% on a compounded basis between FY25 and 27. And they're saying that the company will turn profitable in FY26, and the 27 earnings will be 6% above what the street is estimating. Osho, what are charts indicating with the GMR?
See, GMR is looking very positive, but obviously in the last 2 trading months, there has been a very strong surge in the counter from the zone of nearly 70 and is now hovering at 83 kind of a zone. So overall, the technical structure is very bullish, and it has depicted a reversal kind of a pattern on the daily and weekly time frame chart. So I'm having a bullish view in this counter with immediate target of nearly 85, but the support is approximately around the zone of 72 to 74. So one should wait for some kind of profit booking, because with today's move, there has been a very strong move, positive movement in the counter. So if someone is holding the counter, then it is advised to stay invested in the counter for a higher target of 85 to 86. If someone wants to add positions freshly, then one should wait for some kind of profit booking. I'm expecting that it should hover in a range of 74 to 86 in the near period, and any decisive breakthrough can provide more thrust or momentum in the counter in the coming periods.
Okay, so 85 to 86 is the levels that we are looking for GMR Airport in terms of where the target price is concerned. But another initiating coverage that we have is JM Financial on Inox India. Now with this, they've initiated a buy call on this with a target price of 1,240, which implies around a 22% of an upside is what we are seeing. Now do note that the company is one of the largest supplier and exporter of cryogenic equipment which is there. And if you look at it compared to its Indian peers, if we compare the kind of FY24 revenue it's making compared to its near competitor, we are seeing around a 4 times of growth over here. In terms of where the estimates are also concerned, 16% is the kind of revenue forecast which is there, along with a 16% of a PAT growth that is seeing. So Inox India in focus. Avinash, want to understand your view on this counter?
No, I think, Anushya, from a longer term perspective, Inox India is one of those companies which operates in a very niche space. And again, the kind of performance the company has delivered, I think fairly good numbers both on the revenue, on the EBITDA margins, as well as on the ROE side. the market obviously is valuing this business, on a growth momentum. So clearly, from a longer term business, a multiple of 35, 36 times looks okay if one takes the next 18 to 24 months. So I think, one can expect a decent upside provided the investment time frame is slightly longer term. It can be a good portfolio addition provided, the investor is willing enough to keep a time frame of at least 18 to 24 months.
Right, that's Inox India. But moving on, Bajaj Auto, TVS Motors, Eicher and Hero Moto have released their business updates as well. Puneet, over to you. A quick update in terms of what do you make out of it?
Well, definitely the monthly sales in terms of for Hero as well as for Bajaj Auto was slightly more disappointing. Bajaj Auto just 1% growth in this particular month of March, and while that was estimated by analysts, it's still a very low number compared to TVS, which is closest competitor in terms of product portfolio, which grew at 17%, and hence we're seeing that kind of reaction on Bajaj Auto as a stock as well today. It's down almost 2.5%, and TVS has been growing its scooter portfolio, so there's a clear differentiation there in terms of both these companies in terms of valuation as well as in growth going into next year as well. In terms of Hero MotoCorp, it's been a slow year again. The domestic motorcycle market hasn't been growing, and while they had a 12% growth which beat analyst estimates in the month of March, overall for FY25 it was a slow year nonetheless, and we could see some margin impact in this particular quarter as well because of higher discounting, especially during the last week of March, where we have seen Gudi Padwa as well as Navratri start. So could see, and Eicher was a clear outperformer this time. A growth of almost 33% for the company and over 1 lakh units sold for the company in this particular month. It's the 5th consecutive month where the sales have been over 80,000, which was the target in Q2 of FY25, where they wanted to focus on sales rather than EBITDA margins. So definitely a clear winner. So Eicher and TVS on the upside are clear big winners in terms of the two-wheeler space of sales for March.
Thank you so much, Puneet, for getting us the details. Osho, from the names that Puneet mentioned, anything that looks interesting, or would you have any sell calls?
See, technically, two counters are looking very positive to me. First one is Eicher Motor and second one is TVS Motor. Firstly, Eicher Motor obviously have seen a very strong movement from the zone of nearly 4,700 towards 5,500, that to be a very vertical in nature. So there is a possibility of some kind of cool off in the counter, but overall the technical structure is very positive. So one should stay invested in this counter and even can accumulate at some kind of a lower levels around the zone of 5,100. Now coming to TVS Motor, then this counter has also seen a decent traction, although there has been some kind of a lacking momentum in the counter, but overall the counter looks very positive on a longer term duration on the technical front. So I'm expecting that once it reaches the zone of 2,500, which is also coincides with the 200-day simple moving average, then we can see a decisive move in coming in this counter for immediate higher targets of nearly 2,700 in the short term perspective.
Okay, so that's the overall outlook that we're looking for the Nifty Auto and some of the clear picks over here. But thank you, Osho. Thank you, Avinash, for joining and sharing that perspective on various of these counters which are there. But with that, it's a wrap on this edition of Profit Buzzers. But do stay tuned in to NDTV Profit.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is, actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter.
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Real estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands.
Chronic trade deficits are no longer merely an economic problem. They're a national emergency that threatens our security and our very way of life. It's a very great threat to our country. And for these reasons, the United States will implement reciprocal tariffs on other nations. India, very, very tough, very, very tough. The Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. In other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charged anybody anything. But now we're going to charge.
Welcome. You're watching The Big Question. I'm Tamanna Inamdar. Marking what he has termed as America's Liberation Day, US President Donald Trump has unleashed tariff fury on the world in what is probably one of the most aggressive trade moves in recent history. The US president has slapped the entire world with reciprocal tariffs to counter what he perceives as unfair trade practices by key US trading partners. Under this new directive, a baseline tariff of 10% will be applied to all goods entering the United States across countries. 180 countries will be impacted in all. Additionally, a steep 25% tariff has been imposed on all foreign automobiles starting today. When it comes to country-wise tariffs, Trump has announced discounted tariffs on each nation matching each nation's tariff rates at half the level they impose on US goods. In the case of India, 27% is the tariff that has been slapped, vis-a-vis 52% charged by India on US products. Now remember this number, 52%, because I'll come back to it. The methodology for calculating this figure is what is in question. Just for reference, India's weighted tariff rate on US imports is 12%, as opposed to what the US charges on Indian imports, which is 3%. So how have we come to 52%? There are many theories out there, but no clear one. One theory doing the rounds is that this is just basically the deficit between any two nations divided by the amount of imports from that nation. In India's case, that figure comes to 52%, half of it 26 or 27%. The move now delivers a major trade blow to India, which was hoping for exemptions. Several key sectors like electronics, gems and jewelry, iron and steel are expected to take a hit. Pharma has been spared, for now at least. Now, what happens next remains to be seen. We're already in the middle of a negotiation of a bilateral trade deal with the US. The trade deficit between the two nations, of course, has been widening for years and has reached $45.7 billion in 2024. Trump has made it clear that these tariffs will remain until the so-called threat is resolved. As for the rest of the world, countries have started hitting back with their own countermeasures, driving up the possibility of a fresh global trade war. The European Union, for example, is saying that the tariff announcement is a major blow to the economy and is preparing its first set of counter tariffs. Similarly, China and Canada too have said they will impose their own tariffs. With countries now beginning to retaliate, the big question is, are we seeing the start of a global tariff war? Now, to speak on this and more, let me welcome my guest today, Pramit Pal Chaudhary, Practice Head South Asia of the Eurasia Group. Joining us today, Brian Coulton, Chief Economist at Fitch Ratings, is with us. We're speaking with Jim Rogers, veteran international investor. Jim, great to have you on the show. And Anup Vadwan, Farmer Commerce and Trade Secretary, speaks with us today as well. Welcome to all of you, and thank you so much for joining us here on NDTV Profit. I'm going to start with your take, Jim, because up till yesterday, there was a sense that the announcements may be watered down compared to what was expected. Today, that view seems to have changed.
Well, part of the problem is Mr. Trump has no idea what he wants. He only figures it out when he watches television every morning. And unfortunately for us and for the world, Mr. Trump does not know what he's going to do, and he figures it out as he goes along. I'm experienced enough to know that trade wars are bad, but for some reason, Mr. Trump thinks if he's going to have a trade war, he will win. He will not.
Okay. What happens in terms of the reactions you see across the world, Jim? Just a quick follow-up there, because the fears are ranging from a global trade war to a possible downtick in global GDP to the possibilities of a recession. How do you see this panning out?
We'll probably have all of the above. I'm sure we're going to have a recession in the United States. It's been the longest period since we haven't had a problem since 2009. That's the longest in American history without a problem. So I know a problem is overdue, and I know it's coming.
Okay, so, some strong words there. Brian Coulton, I want you to break this down. First of all, if you have a take on how the US administration has come to these figures of reciprocal tariffs, because they are half of what they claim countries are charging them. And that number is a mix of tariff barriers and non-tariff barriers. Have you been able to figure out what the algorithm is?
Yeah, they published some econometric formula, which is based on some trade equations with some elasticities, and they basically calculate from those equations how much you need to raise a tariff rate to balance trade, right? That's how they've done it. So these numbers have no relationship whatsoever to the actual tariffs charged by India on US imports. As you quoted at the beginning of the show, the simple average MFN rate charged by India is 12.4%. That's what US exporters face when they export stuff to India. That is higher than the rate the other way around. That's 3.7. But this 52% number is an econometric fabrication. But that's what they've used, and we've ended up as a result of this with an outcome that is worse than anybody's worst case scenario for US trade protectionism. This is an absolute shocker.
You know, you're the second person today who I've heard saying this on our channel, Brian. This is worse than the absolute worst case scenario. I just want to, and you've called it a shocker, I just want to come back to you on that. What was the worst case scenario and why is this the absolute worst? Is there any glimmer of hope that this will be reversed in some sense? It's a start of a negotiation, etc.?
Well, the worst case scenario that everybody had in their mind was, let's take Trump at face value, the things he was saying before the election. And he was talking 60% on China, 20% on the rest of the world, and 10% on Canada. So, you know, we're now looking, we think, at 12 to 15% on Canada, probably 65% on China. We're still trying to work out exactly what the number is, but we think it's probably now 65% on China. And then we've had this whole suite of 25 to 35% rates charged across East Asia. So this is, you know, we were worried that we were going to go back to the 1930s. It looks like we've already gone back to the 1910s. The 1930s is looking mild. This is before that. This is worse than the 1930s.
How does this then play out? How does this then play out? Let me come to Pramit Pal on this before I come to the India question specifically in the next leg of the conversation. Let's just set the tone over here and what's happening globally. Pramit, is this politics playing out? Is this an earnest, some might call it misguided, but an earnest attempt to make in America again? What do you think is going on?
Reasonably clear. The MAGA philosophy, if you wish, or ideology argues with some degree of reason that America became deindustrialized because of over-financialization, an excessively strong dollar, over global, should we say, also excessive international commitments, both in trade and security, and that America needs to rejig or rebalance its economy, in particular to create jobs for the working class and manufacturing. Now, there is some truth in all of this. The question is, how do you change or rebalance the economy? And there is where I think most people would disagree with what Trump is doing. Tariffs in particular are not going to be the instrument by which he can do this, at least not in my opinion, because it will almost certainly trigger inflation, and supply chains, especially with countries like Mexico or Southeast Asia or even China, are so deeply intermingled, nobody's going to move back jobs, build steel plants in the United States on the basis of press conferences and executive orders made by a president who may have only about 2 more years of actual political impact. So, but he believes that that's what he has to do. And so he'll continue. The real game, I think, for countries around the world is, do you have a path? Trump seems to see tariffs as leverage. In his book, The Art of the Deal, he talks about how he negotiates. I first get leverage on the other person, and then I push and push and push until I get what I want. So tariffs are his leverage. He uses them to beat people on the head or nations. His then game is, does he go for the big deal that he always talks about? India's gone into that strategy. It said, okay, let's go for a big deal. So that's why go for bilateral trade agreement right from the start. And that's basically what India will be looking at. Is not that the tariffs matter that much right now. Okay. It's whether we can fold them into a larger agreement over the next 6 to 9 months.
But then my question is, how do you go from 3 to 27%, the midway mark? And this is the Indian context. I'm going to come to Anup Wadhwan because, Mr. Wadhwan, we had the opportunity of talking about this before. We spoke about this yesterday, and now we have more clarity. From the Indian perspective, you want a bilateral trade agreement. Maybe you'll fold all of this into it. But even if you have a standard of 26, 27%, by the way, the reason you're looking at 2 figures is because the president talked about 26%. The White House, output, or what they have put out on their website, says 27%, which is why you're seeing 2 figures out there in the Indian context, in case viewers are wondering. So there's a bit of confusion there. But Mr. Wadhwan, for us, even with a bilateral trade agreement as possibly indemnifying us from all of this, Indian perspective, with 27% as the benchmark, the room for negotiation narrows down, doesn't it?
Yeah, actually, I think those are 2 separate things. He's applied these reciprocal duties on a certain principle, and then as Mr. Chaudhary mentioned, he's trying to draw people onto the negotiating table and extract a deal out of them which favors him. So his instrument for extracting that deal from us will be the bilateral trade agreement negotiation. So these are two, in a sense, separate tracks. So once you strike that deal with him, then, hopefully and logically, of course, there's no logic in the way these things are being done, these 27% tariffs will go away, and whatever is decided in the bilateral trade agreement, they'll come into force. So the question is, how do we deal with this interim phase where you're facing these very, very high tariffs and, at the same time, you are supposed to negotiate a bilateral trade agreement in good faith? How do you deal with it in the interim? And I think most countries, EU, China, etc., have decided how they deal with it. They'll put their own retaliatory duties.
You don't see India doing that, Mr. Vardhan? Do you see India doing that at all? Or retaliatory tariffs is not a path we want to go down? Should we even look at that path?
In my personal view, that is certainly a path we should go down. That's a standard trade response.
Okay.
In President Trump's first term, also, the moment he put those steel and aluminum duties, we tried to persuade the Americans on, how unjustified those duties were on security grounds. And then we put our, retaliatory duties. It is something which is accepted and standard in, the trade terms. And I think certainly that will be an option. And then, every country lives in its own political economy, its own political economy imperatives are there. And I'm sure those imperatives will be there on our decision makers also. And I'm sure these retaliatory tariffs will be on the table and may well, come into play. Decision makers also, and I'm sure these retaliatory tariffs will be on the table and may well, come into play.
That's it. So Jim, just trying to understand, if everyone says, okay, we see your tariffs and we raise your tariffs, then Trump comes and says, I see your raised tariff and I come back and raise it some more. Where is all of this going? Where is all of this going? There is still some hope for some reason out there, optimism that this will all, at the end of it, settle down. This is not the way the world can work. Is that optimism unfounded, and where does this go if retaliatory tariffs pile on top of retaliatory tariffs? Jim Rogers, the question for Jim Rogers.
Oh, okay. Well, listen, I'm delighted to hear that you're optimistic that it cannot work. But you're right, it cannot work. And it's going to lead, if India responds or anybody responds, then it just escalates. And I mean, the world has seen this before. It's never been a good scenario. If people start trade wars and raising tariffs, it always ends badly. And this will end badly too. I mean, just if you don't understand what I said, get out your history books. This has all happened before. And every time it happens, people escalate, and then we all regret it. You ask, when will it end? It will end when everybody says, oh gosh, how did we do this? How did we make such a mistake? And then they will start changing. But in the meantime, there's a lot of pain everywhere.
What do you think is the outlook for equity, Jim? Let's talk about US equity, and then let's talk about emerging markets like India as well.
Well, I have sold my equities in every country in the world except China and Uzbekistan. Because
seriously? When? As of when? Ahead of all of this?
Oh, yeah, about a month or so ago. No, I've gotten out of everywhere, as I say, except China and except Uzbekistan. I would like to own India for the first time in my life. I'm keen on Delhi. Delhi seems to understand how the world is supposed to work. But the stock market's been very strong. So I don't own shares anywhere except the two countries I mentioned.
Okay.
And I will explain to you that I expect that we're going to have very bad times in world investment markets, perhaps the worst in my lifetime, because the debt is so unbelievably high everywhere, especially the U.S.
Okay, so that's Jim Rogers right now saying he's exited all equity everywhere except China and Uzbekistan, would like to come into Indian equity as well. From an Indian perspective, Brian, let me come to you on this. How do you see this panning out? I mean, some of the conversation since this morning that if you're looking at emerging markets, at least 27% seems less than what Vietnam is being tariffed at. It's lesser than China. Does India become a relative sweet spot, or is this all, sort of clutching at straws?
Look, there's no winners from a global trade war, right? So you may be slightly less of a loser than your partner, but is that net a good thing? I don't know. Let's not get carried away with how much India's gonna benefit. I suppose if you're looking for silver linings, India's got quite a lot to offer. It's a massive market. The US would like to have more access there. Not all these trading partners have that carrot to dangle in front of the US. So maybe there's some grounds for optimism, but it's a bit early to be talking about upsides. I mean, let's just step back and think about what's happened in the last 24 hours. This is a real blow to India, and I know exports of goods are not so large as a share of GDP in India, but a pretty big share of those goods do go to the US, and the rest of the world is going to be a lot weaker after this than was previously expected. So there are going to be knock-on effects on India from this. And if we do get into a retaliation scenario, as was being discussed, that potentially pushes up prices in India. So that's a trade-off that the authorities will have to think about very clearly. But I don't see this being a source of upside at all for India.
Yeah, okay, no, that's a bit of a reality check there. Pramit, I'm wondering what happens from here on. Does the world become more inward-looking, individualistic? From an Indian perspective, economy-facing companies, businesses that are focusing on India's own inherent market strength, etc., that becomes more important going forward. And does the world try to figure out how to trade with each other without the US in the picture?
Well, I think that for India, the game right now, as I said, to the BTA, we already have lined up sectoral negotiations at a rapid pace over the next several weeks. I do not believe India will retaliate. In fact, I think most Asian countries have decided not to retaliate. The Europeans and the Canadians have said they will. They have said they will. They have not actually done anything yet. But for India, it makes no sense to retaliate at a time when they are in the midst of the negotiations. Second, I think, yes, what we are seeing is the breakdown of the WTO. What is clear in the negotiations that India had with America was basically when India would say, if we concede this tariff to you, remember India has tabled a 0-for-0 tariff for 70% of all manufactured goods, really exempting only agriculture. And this has been supported by Indian industry. The American response was, why should China benefit from this? And India said under the MFN status of the WTO, and the American negotiators, we don't support the WTO anymore. It's dead. So your WTO is going to fall apart. It'll crack on the seams, and very quickly, rapidly, country after country will sign agreements with the United States in which they will basically ignore the MFN's rule. If that happens, and I think it will, we'll start to see not so much as individualism, but you will start to see localized supply chains. You will start to see supply chains that focus on certain regions of the world or countries that you are willing to work with. A lot of governments I'm already speaking with already say, we're already working on our plan Bs. In particular, how many FTAs, plurilateral, bilateral agreements do you have that will continue, that will be your backup as the WTO starts to fall apart? Those are the things that we're going to see happening. And those supply chains have been shifting already. We can see that rapidly, for example, in semiconductors and electronics. But they'll start to spread in other places as well. I think the real question will be connector countries like Southeast Asia, which have acted as sort of intermediaries in global supply chains. If they are unable to come to an agreement with the United States, and America remains the final buyer of most of the products that they produce, they will suffer badly because they don't bring more to the table in terms of either final products or demand, or having indigenous capacities. But we'll see how that plays out. But that's a game that will play out over probably several years, not just one or two.
We're speaking about this in terms of a game the stakes are high, but there's going to be some very, very real impact at the end of this. And that's when I want to come to you on, Brian. It's perhaps early for assessments because, like you said, this is worse than the worst case scenario. But the knock to global GDP, the knock to emerging markets, the knock to the United States, is there anything that you're penciling in or seeing in right now or you can share?
Well, look, we published a forecast a couple of weeks ago where we assumed that the US tariff rate would go to sort of 17, 18% for a bit and then come back down again. And on that basis, already we were cutting our US growth forecast to about 1.5%. Remember the US exceptionalism. Remember that one? Like the last 2 or 3 years, the US economy's been growing at about 3%. Been doing really, really well despite the apparent disaster that the Trump and the team seem to be trying to articulate that he's fixing. Growth halving to 1.5% would imply unemployment rising, but after these numbers, I think we're going to have to look again. I think the risk of US recession is rising quite significantly. The shock to East Asia is much bigger than we had penciled in. The shock to Europe is bigger than we penciled in as well, and that comes against the backdrop of a pretty weak economy. So. We'd already expected global growth to slow to well below trend, just above 2%. But I think we're looking at something significantly worse now. And maybe I can just come back on the previous speaker's point about the end of the multilateral trading framework of the WTO. I think that's an absolutely spot on perception. But think about what that's going to mean. I mean, the beauty of the WTO MFN tariff was that everybody knew what the tariff was for all goods going into that country from everywhere, right? It's a simplification mechanism. Although there was lots of products, but everybody selling those products knew what the tariff rate was. We're going to be moving to a world where there's different rates for different countries. It's going to be the cost of doing business globally is going to go up very, very significantly, and that's not going to be good for global growth in the medium to long term.
That is one of the risks. Does this really end up in liberation of the US economy, or does this now herald a fresh round of tariff wars? Negotiations, you have to watch this space. Suffice to say, from all asset classes and investment purposes, you're going to see a lot of turbulence in the days to come before the dust clears. Meanwhile, thank you so much to all of you for joining us today on the show, and thank you to all of our viewers for tuning in as well. We'll take a very short break, but we're right back with all the latest on NDTV Profit.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Real estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to
Right, if someone told us at the start of today that we'd be down just about 0.25% to 1/3%, we would have taken it. Welcome, you're watching India Market Close. I'm Harsh Saita, with me is Mahima Vajrajani, and that's exactly where we are at. Let's look at the quick factors that are playing out at this point. Indian markets are holding up in trade in relative terms post the Trump tariffs. Now, therefore, certain sectors which are in focus on the back of Trump tariffs, the Nifty Bank is in the green, which is the positive. We are looking at IT, where there is plenty of pain, 4% lower on IT, pharma outperforming through the day today. The other one was auto, which was in focus. The Nifty Auto Index, the breadth is positive. The Nifty Auto Index is down just about 1%. A lot of the pain likely already built in where auto is concerned. We'll discuss all of this and more, but let's quickly look at where we are settling in at. 23,200 being held. Let's look at the intraday chart as well, and you'll see that there is strength, there is resilience pretty much. At the start there was some volatility. We've bounced back from the lows of the day after that volatility, and thereafter we've seen a fairly flattish and sideways move, especially for a predominant part of the day. We've been fairly range bound. 23,150 was the low point, 145. Thereafter, we've bounced back and bounced back fairly well. We're now nearly 130 points from the lows, but we were at that low for a very, very brief period of time. So that to be kept in mind as well. Let's look at the heat map. And within that, we look at all of the pockets that we spoke about. You look at something like a power grid doing very well today, not a surprise. Domestic facing, and therefore you're seeing that kind of reaction, and NTPC also shining on a day like this. But pharma stocks are taking a grip, especially with regard to some of the top gainers of the day. Sun Pharma sitting pretty there, a Cipla also among those that are doing well. And Ultratech, you'll see a lot of domestic facing and pharma dominating at this point in terms of the gainers. In terms of the losers, it's more US facing, and tech essentially under pressure because consumption in the US likely under pressure, and we'll have conversations about that as well over the next hour to hour and a half. But that's how the Nifty 50 is shaping up. Let's look at the advanced decline as well, and thereafter let's look at sectors. There you go, that's how the advanced decline is shaping up. Bread definitely in favor of the positives, which is surely a big plus. And now it's been a couple of days where we've consistently seen the breadth favoring the greens, and therefore that's the other positive. Now it's on sectors. The realty index largely flat, but the PSU banking index is what's shining today along with Nifty Pharma. In fact, PSU banks now doing better than the Nifty Pharma in trade despite no tariffs on pharma. So surely domestic facing doing better today. Look at healthcare, no surprise there. Defense, all domestic facing. Nifty Bank, Nifty Media, Nifty Energy, all of those largely domestic facing sectors doing well. What's not doing well? IT, auto, metals to a certain extent subdued in trade. But that's how it's shaping up. Mahima, with regard to specific names, what's on your radar?
Right, so some counters which are really feeling the heat of Trump tariffs, something like an Avanti Feeds, because seafood exports is a big chunk when it comes to Avanti Feeds in terms of their revenue, down by about 14%. Garver High-Tech Films is also seeing some pressure, not on the back of tariff, but it's down by about 16%. All IT names under pressure, as Harsh mentioned earlier as well, Persistent, Coforge, Signity, KPIT, all of these counters, down anywhere between 7 to 13%. Something like a Dabur India is also down. It came out with its business update today, and well, they've said that the revenue will be flat in Q4. They might see a margin contraction of around 150 basis points to 175 basis points, which is why the stock is seeing significant pressure. Chemical names like SRF is also seeing pressure on the back of Trump tariffs. Something like Blue Jet Healthcare is down by about 3% Cyient Limited down by about 3%. But some counters which are doing well, textile companies doing pretty well in trade today, and this is because the tariffs that have been implemented on other Asian countries are much higher than that of India, which is considered right now, which is being perceived as a positive for India overall. Vardhaman Textiles up by about 15%, Trident up by around 8%. Something like a CSB Bank is also up by 7%. Tejas is up 9%. Restaurant Brands is up 8%. A lot of brokerages are turning positive on the QSR space, and the stock is buzzing on the back of that. Gokaldas Export also up by 7%. Indocount, again a textile name, up by about 6%. Something like Utkarsh Small Finance Bank is also doing well in trade today. It's up by about 6%. And pharma names, of course. There's Aarti Pharma, there's Neuron Lab, there's Jubilant Pharma, all of these counters buzzing in trade today positively because no tariffs on pharma. Well, so this is with respect to some important names that are definitely buzzing in trade today. But Harsh, take it away with the guest as well.
Yeah, absolutely. So let's do that, in fact. Let's get right to it. In terms of the technicals, let's pull up the Nifty 50 and let's welcome in Kush Bora, founder kushbora.com, to talk to us about exactly that. Kush, on the Nifty now, we're certainly not breaching the levels that we've spoken about earlier this week. You've highlighted that 22,900 is that critical support zone, and if we breach that, then there could be concern. Till that point, you've said it's a buy on dips. Does that position change at all? Any fresh levels you're looking at, and what should we look at in terms of the upside now? Because if one were to look at it, today was the critical day, and if we've not moved in significant fashion today, then likely are we starting to look at upsides?
Hi Harsh, good afternoon, and excellent line of questioning, very comprehensive. Look, the number, just a small correction, that number is 22,800, that line in stand that I'm talking about, but it's more of a zone. It's 22,800 to 23,000 that we're looking at as the support zone. As far as the buy on dips, theory goes, I think, today can't be a better example than today, right? We did open lower, markets took support, and, now rebounding. Even though we've not turned green on the Nifty, I think, this has more to do with our local events, mainly the expiry, that is playing out today. If you recall, you could play my commentary that I made yesterday, and it will still apply. With 23,300 call has that congestion, and the 23,200 put has that open interest build up. And if you see, the Nifty is acting just within that range. So yes, very much buy on dips. However, I would like to just point out one caveat, which is the momentum is missing. Now we could very well attribute this. So as I was saying, that one thing that I want to point out is that it could be attributed to the tariff upcoming or now gone, but the impending tariff decision that was waiting. what's happened is the markets have not made higher highs for the last 6 sessions if you don't count, a 2-3 point high. So which is suggesting that perhaps the momentum might perhaps be fizzling out. But as I said, I was actually attributing that to the upcoming expiry event, or rather the upcoming tariff event, which is now behind us. Give it a day or two. If we are able to cross the previous day's highs, I think we're all in good stead. Momentum will return, and all of the buy on dips theory, will be proven once again correct, and will hold in good stead. Still maintaining a very positive view. It's just that I'd like to see a close above the previous day's high to get the momentum going for Nifty. Bank Nifty, on the other hand, is doing fabulously, holding to the 200-day moving average, and now knocking on the doors of a 51,700, 52,000 resistance mark. So both the indices are a buy at the current juncture, with stop losses around the key support zones, 23,000 for the Nifty and about 51,000 for the Bank Nifty.
Okay, Kush, very quickly, the other piece of interest is something like a power grid. It's inward facing, of course, on the fundamental side, but just the way in which the stock has moved, and in the last maybe 25 odd sessions, the stock is up 18%. That's no mean feat for a Nifty 50 company, PSU. What's your view with regard to a power grid now at 297?
So I think, Harsh, this theme will start playing out very selectively. I was listening, to some of the other guests also on the channel, all through the day. And I think one theme that was coming across is that now more and more domestic facing themes will start to get more traction, and power definitely falls in that camp. As far as power grids move goes very specifically, you're right, it's seen a very good jump over the last month and a half, but now the 300 resistance level is acting up. So if I did have a trading position, I would book it out right now. For any fresh position, I would actually wait for this, 300 closing, that barrier to be crossed, and then the stock could see momentum, and that's when you go and add further. On the whole, the setup is pretty neat. The 300 resistance is acting up. That's the only small hurdle in the entire up move.
Your top picks for the day, Kush?
Since we are talking about power, let me start with one of the picks, which is from the power space, GPIL, Godavari Power and Ispat. After a while, a lot of these names have started to show traction. This stock too has crossed multiple hurdles. 190 was a big resistance for the stock for the last about 2.5 months. The 200-day moving average around the 197 mark was also a resistance. It cleared all of those on the back of very high volumes. Now on the way up, 212, 219 are your targets. 192 is a good level, as support, so you place your stop loss there. I've got a short idea today, given the texture of things, and that is on Crompton Greaves. It's been in that downward pressure for a while. The resistance of 365 has acted for the last 3.5 months. Short positions also building up in the future segment. So from a short sell idea, 336 and 331 are your targets. 346 is where you place that stop loss.
Okay, great time to continue to talk power. So let's bring on board for this conversation Harsha Upadhyay, CIO at Kotak Mahindra AMC, to talk to us about exactly this, because they are launching a new energy related mutual fund. And of course, basis the document, it's a long-term fund in that sense. But Harsha, the thought process, of course, as I read, is to try and capture the larger upside that's there in power over the next maybe 10 to 15 years. But what's giving you the comfort in terms of timing? Why do you believe this is the opportune time? It's not like a year back, things were different, and therefore just trying to understand what the view is.
Good afternoon. Very good question to begin with. Yes, I think the valuations now are very, very attractive for a long-term investor to invest into energy sector. In fact, we had this approval from the regulator for quite some time. We were waiting for a good entry point in terms of the overall valuations. In the last 6 months or so, not only the market has corrected to lower levels, we have also seen energy sector correcting quite a bit. And we do believe that at these valuation levels, most of the valuation risk is behind us. And for a long-term investor, this could be a good entry point. And as we all know, energy is an integral part for any nation's growth. And as India continues to grow in terms of its economy and the affluence that increases in the country, and also the focus that comes on the new age businesses as well as the traditional manufacturing businesses, the energy intensity is going to definitely go up from current levels, and that's what we are playing for as a long-term investor.
And Harsha, how should you look at the baskets here, and where do you see value? Do you see it within the Gencos? Do you see it within transmission distribution? Do you see it within components? Or do you see it within financing? Because you've seen valuations fall in all of these. Or is renewables the sector? How do you view this? Where are you most bullish on?
Well, as a theme, we would be looking at opportunities across subsegments of the energy sector, which covers oil and gas. When we say oil and gas, all aspects of oil and gas sector would be covered under that. We would also be looking for opportunities within the power sector, both traditional as well as renewables power. And also within power, not only generation, but also distribution as well as transmission opportunities. Along with that, there are several allied sectors which benefit from growth in the energy sector. For example, capital goods sector. And across all the themes that I mentioned, the valuations are very, very reasonable at this point of time, especially after the correction that we have seen in the sector as well as in the market over the last 6 months or so. So I would say it will be a diversified exposure within the available subsegments of energy sector to begin with.
Mr. Upadhyay, hi, Mahima also joining in. You did mention that, valuations right now are looking attractive in some pockets. I just want you to, throw some light on as to which pockets are you finding valuations attractive right now? Is it the data centers, or is it the EV space, or is it the transmission space where you think that it's the right time to enter? And overall also, I want to understand as to how the composition of the fund will be like.
As I mentioned, all the subsegments that are under the energy theme would be available for investments. I will not be able to specifically mention the range that we have thought out for each of these subsegments. Of course, the fund is open from today and will be open for subscription for another 2 weeks. And post that, in about a month's period, we will be getting the money deployed into the market. So depending on the relative valuations at that point of time, some of these sectoral allocations could also change. And that's the reason why I would not want to really predict how the allocations would be. However, the entire power sector is something that we are very, very positive about, both traditional as well as renewable energy space, and across the board, generation as well as transmission distribution have a lot of opportunities. The entire sector is likely to see capacity doubling over the next decade, and that means that not just generation but also transmission and distribution will have a lot of opportunities for growth. And similarly, all the power equipment players who are supporting this kind of a growth will also be beneficiaries along the way. So there is an entire gamut of power sector and allied segments that will be benefiting from this particular up move in the energy segment. Similarly, within oil and gas, we are particularly positive on oil marketing companies now. Given that global growth is quite muted as we go ahead, it's very likely that crude is going to remain where it is, or probably take a knock and probably go to lower levels. If that were to happen, then the profitability of oil marketing companies would also get a boost. So, and the valuations already are at reasonable levels with reasonably high level of dividend yield as well. So overall, I think there are a lot of opportunities across the value chain of energy, and that's what we would be trying to invest into at this point of time.
Harsha, if I can digress a little bit, because you were one of the few people who called out in early October that valuations looked stretched, and I'm talking about the larger market at this point. We've seen a correction. You're constructive energy. Are you also starting to get constructive about other pockets and spaces?
Yes, if you look at the large cap space, for example, currently the valuations are almost at around 15-year average valuations. While no one knows exactly where it will bottom out in the short term or in the medium term, but generally, if you're an investor and if you're investing at average levels that has been seen in the historical past, and if you hold on for 3-5 years, the valuation risk is very, very minimal. So to that extent, I would say the valuation risk in large caps, at least after the recent correction, is very minimal. However, in mid and small caps, it may not be so as yet. There is still some premium that we are seeing in terms of current valuations vis-a-vis average valuations. And also, the earnings growth over the next couple of quarters would be key for mid and small caps to continue holding on to this kind of a valuation premium. So I would rather wait for the earnings season to really get a clarity in terms of mid and small cap segment, or would wait for further correction in the valuation, either a time correction or a price correction to make the same choice. However, within equities, I think large caps look much better from a valuation perspective.
Understood. And since we're talking in a zoomed out fashion and talking about markets, Harsha, curious to know the entire issue around tariffs and global geopolitics, as well as everything to do with global trade. Is that noise, or and therefore would you term it as noise, or would you be genuinely concerned at this point?
No, I think we need to really be concerned at this point of time, because the benefits of globalization that we saw over the last several decades seemingly is coming to an end. And what we are going to see is a new world where there will be restrictions on trade. There will be a lot more uncertainties, and also growth definitely will take a backseat, at least until the entire scenario kind of reaches a steady level. So overall, I think there is going to be some amount of demand destruction in the immediate term until people figure out how to conduct business in the new scenario. And also there will be different winners and losers. So of course, depending on what kind of tariffs are there on different geographies, etc. So the competitive advantage that many of the businesses had just because of a certain geography may not be available going forward. So I think a lot of moving parts, and also we may not have seen the last of statements on the tariff itself. We need to wait and see what other countries would react to, and react in terms of their own tariffs or policies, and also whether there will be some more changes that you can expect from the US itself. So overall, I think the uncertainty definitely has increased in recent times and will continue to remain so for the next few weeks as well.
Point taken. And therefore, of course, energy is one pocket which will, to some extent, be insulated from all of that uncertainty and volatility, and therefore the NFO. But talk to us about other sectors which could be defensives at this point in this very uncertain time. Would it be more domestic facing, FMCG, banks? Would those largely drive in terms of return momentum?
There are many domestic focused businesses. For example, large banks are something that we like at this point of time.
Sure.
The valuations have been reasonable for quite some time now. And we are also seeing a little bit of easing in terms of the regulatory scenario for banks. We do expect with the revival in the economic growth that we are expecting, the credit growth should also improve going forward. So overall, this seems to be a reasonable exposure at this point of time. Similarly, another domestic focused segment would be cement, which is almost completely domestic in nature. For example, the entire raw material is in the country. The entire production is used in the same in our country itself, and there are very little foreign currency or global linkages in that sense. So which also should see a reasonable uptick in growth as government starts to spend again this financial year. So overall, I think there are many domestic focused sectors which can provide you that kind of a insulation in a market which is nervous about what's happening in terms of trade and other barriers on the global side.
And Harsha, from a consumption perspective, do you believe that to start to bounce back likely Q1 FY26, or will that take a little more time, domestic consumption?
It's a dark horse at this point of time. We do expect things to revive, but it may be a little more gradual than what everyone has anticipated at this point of time. But definitely the tax cuts or a boost to consumption. We should also see a reasonable monsoon this year. If that happens, then rural economy, which is showing a little bit of green shoot, should also improve as we go ahead. So overall, things may start to look up gradually over the next few quarters, even for consumption. And that's again is largely domestic in nature, although there could be a little bit of linkages in terms of the raw materials, etc. On the foreign currency side, etc. But overall, I think it's still a more domestic focused business.
You know, Harsha, banks have been on the back foot since a long time. You are positive, the consensus view seems to be positive for a while now. Do you believe there's